All right. Hi. Good morning, guys. Good morning, good afternoon, good evening, wherever you are. I hope you're doing good. Can you please confirm on the chat box if audio, video, everything is all right? Okay. Good. Nice to see a bunch of enthusiastic people here. I know you guys are a little nervous, and you're supposed to be that way. We just a few days before the exam. So here's what's going to happen. First 10 to 15 minutes, I'm just going to tell you how I've planned to spend these next 5 days with you, because I know that your time now is extremely precious, right? So my responsibility is to make sure that you guys get bang for your buck. You guys get a lot of value for the time that we are investing together. So first 20 minutes, we would essentially discuss on how to make use of this crash course, what to expect, what not to expect, how you would be using these videos over a period of time. And once all that is said, then we are going to get started with the content right away. So let me share my screen now. Okay. So you guys should be able to see my screen here. So first thing, most of you would probably already know, but it's a 5-day long course. It's going to be almost the entire day. We would be spending about 8 hours every day. This is going to be 10 a.m. to 6 p.m. India time, live for next consecutive 5 days. Right. So those people who are watching it live, of course, you do this with me here. Those of you who are not able to do it live, maybe you're reviewing it in the future, you need to look at 5 videos. The sequence of these videos or these sessions is going to be like this. So today is day 1. I'm going to do corporate finance and FRA, financial reporting and analysis. Day 2, we would do equity and derivatives. Day 3, fixed income ethics, quant portfolio management, economics and alternative investment. Okay, so that's roughly the schematics in terms of how we are going to progress. It's going to be a comprehensive crash course. I'm going to try and touch almost every possible learning outcome. We would also fit in numbers in between, especially the areas that I feel are important conceptually, as well as the potential testability on the exam. So we would also do number-based calculations. We would discuss on theory. I would also highlight some of the important points for you. Now, the way I want you to do this, is what happens is, now I have been doing this. Crash course for a while. Generally, a shorter version of this. Today is a more comprehensive version. When I start on day 1, people are enthusiastic, and everyone wants to start in, and the first couple of hours go really well, and then the difficult part starts coming in, right? Then you start encountering areas which are tough, which are challenging, and then suddenly you feel, okay, everyone else knows how to do this, but meko nahi aata hai, but I don't know how to do it, right? So then you feel, okay, you know what, let me go back to books, or let me go back to the main videos, and let me just do that part, and maybe I'll do the crash course later. Okay, so please do not do this. Your efficiency would be substantially higher if you stick through this next 5 days. It's going to be tough. I'm not telling you that it's going to be easy, but what I can tell you is that this is going to be worth it, this 5 days that we spend together. So even if there are areas where you feel that, I'm not comfortable with them, what I want you to do is simply get those markers or flags and put them on top of your books and just highlight those learning outcomes. If you have the markers, great. If not, you can order them now. or simply write them down on a piece of paper, right? That this learning outcome I was not comfortable with. So for example, let us say, we're studying corporate finance today. Okay, so let's say we reach to cost of capital, and you're not comfortable with levered unlevered beta, right? Will you just go to the books and start doing it again? No. Right now, you just put a flag on it. Okay, you would say that this is I'm not comfortable with. You would wait for me to finish the topic, and then you would start participating from the next topic onwards. And then at the end of the day, your responsibility would be to work on all the flags. Right. So at the end of the day, you would go and work on all the areas you're not comfortable with. So by tonight, these two subjects are completely over for you. Okay, so that's the game plan. So please make sure any point during the session today or in the next 5 sessions, do not leave in between. It would be tiring, exhausting, but if you go through this entire process, it is going to be worth it. So please hang on, please stick through the entire session. Now, how are you going to use this crash course, or how are you going to make use of these videos? So first, you guys are doing it live with me. Maybe some people will watch the videos later on. So you do it once. Okay, what that once will do is it will tell you, okay, these are the areas I'm weak with. These are the areas I'm comfortable. This is what Utkarsh asked us to remember. So we remember most of it. Then after you've done the crash course, you try and write maybe 1 or 2 mocks. Okay, just to see that whether you're able to apply the knowledge that you've acquired here and the concepts that you've revised. So you try and do 1 or 2 mocks, and I feel very confident that if you sit through this crash course completely, your scores in the mocks will improve. Right, you would start feeling better about yourself. And then in the final 2 to 3 days before the exams, right, because that is the time when everyone is panicking. People wonder, what should I do, what should I not do? So last 3-4 days before the exam, you can revisit these videos one more time. They're going to remain on YouTube. They are yours forever, so you can watch them. You can watch them as many times as you want, and especially in the last 2 days, last 2-3 days, you can also consider them watching on 1.5x or 2x. Even though we're doing 8 hours of session straight, there will be some breaks in between, right? So post this session, we will be deleting those. We will be deleting those videos, the breaks. We will be deleting on the unnecessary time, so the size of the video will condense. Plus, YouTube has this functionality where you can, have a faster playback speed. So this is what you're going to do in the final 2-3 days. All right, that's roughly our game plan. So what you need to have, you need to have juice notes with you. If you have them, it's great. If you don't have them, it's okay. But if you don't have them right now, you want to get them. They're extremely cheap right now in India on Amazon. They're just 1,800 rupees. That's like $30 US. It's the same on the FinTree website if you want a PDF copy. It's not necessary to have them, but if you do have them, you're going to feel a little more comfortable. All right, so that's an optional thing. Again, my intention is not really that you would go and buy them, but intention is that these will really help you. So you figure out if you really need them. Have these post-its. Throughout the session, I'm going to ask you to write down important concepts. Okay. Especially, I would be using this 5-star mechanism. Okay, so 1 to 5 star. And when I give star to a particular concept, it just means I individually feel that it has a higher probability of being tested. Okay. Now, I do not have any idea in terms of what would actually be tested, but I, as an instructor, as a trainer who understands this curriculum, I feel that there's a higher probability of being tested. So throughout the session, I would be giving you some star concepts. So if you have this, you can write them down and then keep them on your wall, and it's a little easy revision. And finally, how do you get your doubts or queries resolved? If you remember in my introductory video, I told you that we would be helping you with all your queries till your exams. So all your queries, you'd be allowed to post in the comments of these YouTube videos. Okay, once the live session is over, then I think it takes about 20-30 minutes for YouTube to process the whole thing. Then you would be able to comment on the video, and entire support team of FinTree, including myself, we would be basically answering those queries in the comment box. Okay, we'll try and answer as many as we can. So the support is open for you. You just have to ensure that you put comments in the respective video. Okay, which means if it's a corporate finance video, don't post derivative comments. Okay, we would not be able to handle it. So post respective comments in the respective video. I would be taking notes during the session. These notes during the session would be posted in the description. So if you feel that you want to access the PDF that I used, not the Juice Notes PDF, but the notes that I'll be writing, you can access that by downloading that link in the description. It will come few hours after the video is live. I mean, after the video is posted. And here is what I want you to do at the end of the day. Okay, especially for India time. Our sessions are 10 to 6 p.m. right? So we finish at about 6 in the evening. Take a little break, give yourself 30-40 minutes, grab a nice cup of coffee, maybe listen to some music. But once you feel that I can probably do a little more work, then what you're going to do for the rest of the day, throughout the day, the areas that you identified in your flags or in your markers, right? As I told you earlier, that whatever areas you don't understand, just put a flag on them and revisit them later. So at the end of the day, you're going to go and work on those areas. If required, you'd go and view the main videos, or you'd refer to the curriculum, Kaplan, whatever you're referring to, go and revisit those areas once. And if you did not have many of these areas, then you're going to practice questions from CFA curriculum end of the chapter questions. Okay, so these are the questions that you're going to go through. And again, my suggestion for practicing these questions is use a horizontal revision technique. Okay, so again, what is a horizontal revision? And throughout the day, I will elaborate much more on that. But what I want you to do is, let's say we have capital budgeting, we have cost of capital, we have working capital. When you and I, when we generally, practice or learn, what we do is we do question 1, 2, 3, 4, 5, we finish all the questions of capital budgeting. Then we do working capital. Okay. But in the final days of your revision, this is not the right way to approach. The correct way to do it is you want to do them horizontally. So maybe pick up 2 questions, let's say question number 2 and 3, and then do question number 2 and 3 of all the readings that we've done throughout the day, right? Mix them up, because that's how actual exams are going to be. And then once you've done with question number 2 and 3, then maybe go and do 5 and 6, pick them up randomly. So at the end of the day, you're going to practice questions horizontally. You're going to work on your flags, and that's more or less on how you're going to make use of this content. Right, so I hope you guys are excited, because I am. And with this, now I would like to get started with your first subject. We're going to start off the session today with corporate finance. The first reading that I want you to take you through today is capital budgeting. I'm not going to strictly follow the sequence of the curriculum. I'm just going to first work on what my understanding of the curriculum is, and then we will start doing the other content step by step. All right. So capital budgeting, again, this YouTube chat, it can be, it can at times help you or at times distract you. So my suggestion to you is use the chat box when I'm asking you queries. Otherwise, try and ignore it, because at times there are too many random things happening and people do their own thing on the chat box. So every time I ask you a question, you try and answer that on the chat box. Otherwise, try and ignore it, because it could be a little distracting as well. We want to make the most of the time that we have at hand, okay, in the next 5 days. So let's get started. Let's start having fun with capital budgeting. The first thing that we want to do here, just to kind of get ourselves warmed up, is this whole business with NPV. Just as a warm up, still early in the morning, I'm going to write down some cash flows for you just to get you started. Let's say we have cash flows of 100, 150, 200, and 300. These are my inflows. And let's say that I have done an outflow of 300. Now, based on this information, assume a discount rate of 10%. You're going to calculate what would be the NPV of this project, which I think you're pretty good at. You're going to calculate what would be the IRR of this project. You're going to calculate what would be the payback period. You're going to calculate what would be the discounted payback period. Okay, I hope that you guys have heard of this before. Okay, I hope you're not hearing it for the first time. NPV, IRR, payback period, discounted payback period, and then you're going to calculate what would be the NPV at IRR. If I use IRR as the discount rate, what is going to be the NPV of the project? I want you to keep on posting your answers on the chat box now, as and when you're done, step by step. In the meanwhile, I'm going to get some water for myself. All right, so the way we're going to do this, again, trying to optimize on our time. The way we're going to do this, we're just going to plug in all the numbers in the cash flow function of the calculator. So you have to press the CF button, then you hit the second clear work. 300 negative for the first one. 100 cash flow. Don't forget to press the enter button. A lot of people do that. 150 enter. I'm doing it on my mobile phone. 200 enter. 300 enter. Then hit the NPV button. It gives you an I. So you enter 10 there. Don't do 10%. Your calculator understands it's 10%. Just enter 10, right? So just say 10, enter, and you get NPV. Press downward arrow, press compute. So the first answer I'm getting here. The first answer that I'm getting here is 270.04. I'm going to press downward arrow. It gives me NFV. We don't need that right now. Downward arrow, it gives me payback period. Let's press compute. So payback period is coming out to be 2.25 years. Discounted payback period. If you have a professional calculator, it does it directly. If you have a student calculator, there's a little bit of manual calculation there. That you'd have to do it separately. I'm going to just do it on the calculator now. Discounted payback period is 2.5665. Now NPV at IRR, I don't need to do the math. I know that this is zero, right? That's the whole definition of IRR. IRR is that rate at which my NPV is going to be zero. So it ends there. Let's look at the IRR button now. So I'm pressing the IRR button. I'm going to press compute, and that's getting me 39.80. Okay, so that is 39.80, and there you go. These are your answers. Now, those of you who got all of these right, give me a yo-yo on the box. If you got all of these right, congratulations, good start. Give me a yo-yo on the box. Good. Very nice. All right then. Building the momentum. You're doing good. I'm happy. Good job. Let's jump on to question number 2. Now, there are some people who are struggling. Okay, I know there are some people who are struggling. There are some people who miss the keys. What do you guys need to do? Take a post-it or take a flag and write down that I need to work on. I need to work on the calculator keys. I need to work on how to use the cash flow function. There are some people who are struggling with discounted payback period. So write down, I need to work on discounted payback period. The job of this crash course is to help you understand what areas you're not comfortable with so you can work with them separately. Okay, I have videos on almost all the topics, either on FinTree LMS or on YouTube, so you can look them up later on. All right. Now I'm going to take you to the second question. We want to optimize our time as much as possible. Second question. Second question is my first 3-star concept for the day. I personally enjoy this quite a bit, and I feel there's a good probability, something like this might show up on the exam. So now what we have here is we have 2 projects. Okay, let's say we have a project A, and we have a project B. Now at time 0, the investment that we need at time 0 for project A is -1,000, and for project B, it's an investment, right? So negative, and here we're going to have let's say 1,400. Now these are my cash flows for the next few years. Time 1, time 2, time 3. This should be good enough. Time 4. Let's say I'm getting a 500. I'm getting a 600. 600 one more time, maybe a 700 here, and here I'm getting a 700, 800, and 1,000. Now with this information, okay, what I want you to do is calculate what would be a crossover rate for project A and B. Second, calculate what would be crossover rate for project A and B. Second question, calculate NPV at crossover rate. NPV at crossover rate for A and B. Extremely important concept. You want to have this. You want to understand this. NPV at crossover rate in A and B. Third, draw the NPV profiles of both the projects. Okay, so if you have a notebook, that would be really nice. I want you to draw the NPV profile and select a project on the left of crossover, and on the right of crossover. Okay, the fourth one is a little tricky one. I would say the fourth one is probably a notch above most of the questions on CFA level 1. Like that's my guess, but it's a fun question. Okay, so select a project on the left of crossover and the right of crossover. On the right of crossover. Let's see if you can handle it. We'll try and do this in 2 minutes. If you can do this right, you've done a good job. Like you really know the content well. Okay, you've understood this reading. Rakesh, don't need a discount rate for crossover rate. So discount rate is not really necessary to solve what I've asked you to solve here. Discount rate is not necessary. Okay, but I'm going to explain you how to do this. I am just giving you a little time to think about it yourself. Otherwise, then I'm going to do it myself. Come on, guys, keep on posting your answers on the chat box. Don't give up. Let me give you a hint. Okay, maybe that hint will help you. Crossover is the rate at which NPV of the two projects is same. Crossover is the rate at which NPV of project A and NPV of project B is same. Okay, that's your hint. Let's see if you can think through this now. These are the two main number oriented questions in this reading. If you are able to do the question number 1 and 2, more or less calculation wise, the first reading is done for us. All right, I'm going to show you how to do this. Observe now. First concept, everyone, I want each one of you to listen to this carefully. All right, probably a few days from now at you're sitting in your exam center, maybe you'd have to do this. All right, so please listen to this carefully. First, it could be a theory question just on the sentence that I'm giving you. What is a crossover rate? It's a rate. Everyone would listen to this carefully. It's a rate at which NPV of two projects. NPV of the two projects is same. So it's basically some discount rate at which NPV of both the projects is going to be same. NPV same, that's your crossover rate. That's it. Now, how do you calculate this? Very easy technique. Okay, very easy. You don't have to remember fancy formulas or mathematics, nothing. Simply take the difference of the cash flows and calculate IRR on that differential cash flow. Take the difference of the cash flow, A minus B or B minus A, doesn't matter, and then simply calculate the IRR, right? That's it. So I'm going to do this for you. I want you to observe this carefully now. So if I take difference of the cash flow, and let us do it this way, B minus A. Okay, so what I'm going to do is I'm going to do B minus A cash flow. Do you always have to do B minus A? No, you can also do A minus B. It doesn't matter. It's the same thing. Okay, so please observe. please see how we do it. So it's B minus A. If it's B minus A, how much extra money do I have to spend in B? I have to spend 400 negative extra, right? Now, how much extra do I get in the first year? 200, because 700, 500. How much extra do I get here? 100. How much extra do I get here? 200. How much extra do I get here? 300. So these are my delta cash flows, right? These are my incremental cash flows that I'm getting on project B. And once we've done this, then how easy is this, right? Then work with these cash flows. Minus 400, 200, 100, 200, 300, and insert these cash flows in your cash flow function. So some of you were struggling with cash flow function earlier. I'm going to do it one more time. You can do this with me. Press the cash flow button, then press second and clear work. You have cash flow 0 on your screen, 400 negative, enter. Press downward arrow, you get cash flow 1, 200, enter. Cash flow 2, cash flow 200, enter. Cash flow 3, cash flow 3, 200, enter. Cash flow 4, 300, enter. Just enter your cash flows, all right? Once you have entered the cash flows, then calculate an IRR of these cash flows. So press the IRR button, press compute. When I press IRR button, press compute, the rate that I'm getting, and I hope you got the rate. And if you did, give me a yo-yo on the box, a big loud yo-yo, because you did impressive job. The IRR is 31.25. I'm just rounding it off. 31.2. Okay, let's go up to 4 decimals. 2474%. Right? That is your crossover rate. That is your crossover rate. Okay. Now, what is the meaning of this rate? What is the meaning of this rate? This is the rate. This is the rate at which the NPV of two projects is going to be exactly same. Okay. Now, the first part we've kind of done, and I think we are okay with it. And I see plenty of yo-yos on the chat box, and that's impressive. Good job, guys. Now, what is going to be the NPV at crossover rate? Okay, what's going to be the NPV at crossover rate? So we don't know what the NPV is, but we know that if I use this rate to calculate NPV, then the NPV of A and B is going to be same. So you guys help me with it. Give me an NPV of project A. I don't want to do it. I'm sure you've done it. Just give me the number. NPV of A at 31.24. NPV of A at 31.24. Tell me how much is that? And is it a plus number or a minus number? NPV of A, is it 230.56? All right. And if I calculate NPV of B at 31.24, if I calculate NPV of B at 31.24%, it's going to be same. It's going to be again 230.56 or few decimals here and there. All right. That's the beauty of this rate. It's some sort of a magical rate, at which NPV of two projects are same. All right. I hope the B part is also okay with you. At crossover rate, the NPV is going to be same. All right. So first two are under control. Okay. I hope you're grasping it. Now the third one, where we have to draw the NPV profiles. Okay. Now this gets a little tricky. This gets slightly tricky. I'll tell you why. So let's do the third one. Now on the exam, of course, you don't have to draw it, but you'll have to do some interpretations. Okay. So I'm going to give you some idea on how to think about it. So first, what is an NPV profile? It's a graphical representation, okay, of NPV of the projects at different rates. So on the y-axis, we will have NPV. On the x-axis, we will have discount rate slash IRR. Discount rate slash IRR. Okay, that's how NPV profile looks like. Now, where this NPV profile intersects right here, this is called as an intercept. Okay, so this is a y-axis intercept, at times called the vertical intercept. So y-axis intercept. This is called as a x-axis intercept. X-axis intercept. Okay. Now, as I said, 3-star, good probability of being tested. One easy question that can come up on the exam few days from now when you're in the exam hall is they will ask you how do you calculate y-axis intercept? Okay, how do you calculate y-axis intercept of NPV profile? So your answer is going to be y-axis intercept of NPV profile here is nothing but simply total of the cash flows. Is simply going to be total of all the cash flows. Time value of money, no. Just take a total of cash flows of that particular project. And then they will ask you what is the x-axis intercept. And your answer would be, boss, x-axis intercept is nothing but just the IRR of that project. Okay, that is it. That y-axis intercept is total of cash flow. X-axis intercept is IRR. So let's look at project A now. Okay, let's look at project A. Let me take a screenshot so I don't have to rewrite this. Okay, I'm going to plot those numbers somewhere here for quick reference. Okay, so project A, look at my cash flows here. What do I have in my cash flows? If I just take a total of these numbers, all right? If I just take a total of these numbers, and I don't care about time value of money. So if I just do minus 1,000 plus 500 plus 600, if I do it like this, plus 600 plus 700, can you guys help me out? Can you tell me how much is this number? So let's say how much we have. We have positive 100, such. So we have 1400 here. Okay. And let's take a total of these numbers. So in fact, let me just do it for the first one now. So we have 1400 here. So I'm going to write down that for project A. Okay. This line, let's convert this to a black line. Project A is 1400. You guys help me with IRRs simultaneously. Okay. So this total is 1400. Now, can you please tell me what is the IRR? What is the IRR for project A? Can you help me out, please? IRR of project A. IRR of project A is how much? IRR of A is 44.02. Okay. So there you go. That's your graphical representation of A. I hope I've taken the total correctly. Okay. So that's your graphical representation of NPV IRR profile of A. Okay. Now let's do it for B. Let me bring in a new color for B. Let's do a nice green on it. Now B, let's take a total. Okay, let's take a total of B. Let's see how much is that. Total is 1800. Okay. Total is 1800. So the B graphically is now, I have very limited with my very mediocre skills, but wish I could do this a little better. But let's say B will come in something like this. Okay. So B, the green thing is a B1 now. This is 1800. And what would be the IRR for B? IRR for B is 40.40. 40.40. Okay. Great. Now, what is the crossover rate? The crossover rate is this point. The crossover rate is this point. Okay. The crossover rate is here. And let's see what crossover rate we calculated. Our crossover rate came out to be 31.24. So that is somewhere here. Now, this is, my scales are completely messed up, but doesn't matter. We're just trying to learn here. So this is definitely not to scale, but you'd still get an idea. Is everyone okay with NPV-IRR profile, like in terms of how it is calculated? So now the NPV-IRR profile drawing is done. We know that this is the crossover rate. Okay, we know this part. We know that this is the crossover rate. Now, what they will do on the exam maybe, and this part, I want you to listen to this very carefully. Okay, I want you to listen to this very carefully. They will say, okay, fine. What if the discount rate is on the left of 31.24? What if the discount rate is on the left of 31.24? Then which project will you select? Okay, and your answer is going to be simply the one NPV profile which is higher. The NPV profile which is higher is the one that I want to select. So if your discount rate is on the left of 31.24, what do you see? Whether the green line is above or the black line or the red line is above? Which line is above? Correct? The green line is above. So up to this point, the project that you want to select is, up to this point, the project that you want to select is the green one. Okay, the project that you're going to select is the green one. So this is going to be your selection. So select this project. Why? Because it is giving me higher NPVs at those level. But the moment I move from 31.24 and the moment I move in the other direction here, okay, in this area, then which project do I want to select? Then the project that I want to select is going to be the red project or the black project here. So let me take this black one, and this is the project that I'm going to select now. Because it is above the green line, it's giving me a higher NPV. All right, that's how you want to think of this. This is a potential theory question. Okay, so you should be able to answer these with ease, comfortably, if you know how to think about them. All right. Now, those of you who understood this completely, those of you who understood this well, give me a yo-yo based on your level of understanding. The better you understand, give me more yo-yos on the chat box or in the comments. And those of you who feel, I'm not so confident, write it down, do it at the end of the day. Just write down that I need a little more work on crossover rates and then do it at the end of the day. You can be generous with your yo-yos. Good. Thank you, Vasu. All right, very nice. Thank you very much. Good. So the numerical part is over. We've built good momentum. We've spent about 20-25 minutes in doing this, but it's worth it. This is the core of that reading. Everything else is manageable. So let's go through the theory super fast now. Okay. So I'm going to make use of the juice notes to take you through the theory. I'm going to focus only on the important sections. So how do you, do capital budgeting, you generate ideas and blah, blah, blah. Nothing fancy in the learning outcome A. We can easily ignore it. Different types of capital budgeting, fair enough, no big deal. Principle of capital budgeting, important. Principles of capital budgeting, important. Let's see what are the key principles of capital budgeting. Okay, this is my 1 star. Okay, and I told you every time I give you stars, it's a good idea to write them down or take a screenshot, whatever works for you. But if I were you, what I would have done is for every star concept, I would have written them down on my post-its, and it would be extremely helpful for me later on when I want to get revise the whole content, especially day before the exam. So basic principles of capital budgeting. Number 1, we do capital budgeting based on cash flows, not on accounting income, right? Decision happens on cash flow. Opportunity cost is important. Even though we're not paying money, but there's an opportunity cost that needs to be considered. Timing is to be considered. We know that. Taxes are to be paid. We know that. No problem there. Then ignoring financing cost as a cash outflow, important. Even though in reality, I am not paying interest, right? I'm not actually paying interest, but like I am paying interest, but in the cash flow world, I'm not going to deduct it. Why? Because that interest is considered as a part of my cost of capital. So you don't want to double count the same stuff again and again, correct? So I'm repeating one more time. Interest as an expense is not to be deducted from your cash flows when you're doing NPV calculation. And then some cost is to be ignored, the cost that you've already paid. I say this jokingly all the time to CFA candidates. Once you pay your exam fees, whether you don't study doesn't matter. That's a sunk cost for you, right? That money is gone. Now, you cannot do anything about that. I worked in consulting world. So before I got into teaching, and in what we used to do in consulting is we used to charge our clients a bomb. We used to get them, take fees and tell them, to do, what not to do. Now the fees that they paid us was sunk cost. That was not relevant for their decision making, right? Because it was paid. Now there's nothing that can be done about it. So ignore sunk cost. All right, externalities, important concept here, cannibalization. I want you to know cannibalization, could be tested. Easiest example to remember cannibalization, Coke versus Diet Coke. When Diet Coke was launched, they knew it was going to eat up some of the business of the traditional Coke, right? So that is your cannibalization. It needs to be considered when you're modeling the numbers. Then conventional, unconventional cash flow, potential theory question here. What do you need to know? If my cash flows are minus and then plus, so that's a one sign change, right? From minus to plus, I changed my sign once. Okay, again, I want you to be focused, everyone. I know, the fatigue starts creeping in. You're maybe a little tired. I'll give you a break very soon. Just listen to this carefully. When I move from minus to plus, okay, here, cash flow changed once, and then it remains plus plus. So if my cash flow changes only once, no problem. I'm dealing with a conventional cash flow. But minus to plus and then plus to minus again, right? So it changed more than once. And if it is changing more than once, then we have something called as the unconventional cash flow. And the thing with unconventional cash flow is you're going to have difficulty with the problem of IRR. Either you'll have no IRR or you'd have multiple IRR. All right. So there could be a situation on the exam where they give you the cash flow and they ask you to identify whether it is unconventional or conventional. It's easy, straightforward stuff. All right, these are some of your definitions. We've already done work on them: NPV, IRR, payback, discounted payback. A few important theory points that I want to bring to your notice. That payback period is a poor measure of profitability. Discounted payback period is also a poor measure of profitability. You don't want to use these two metrics to check your profitability, right? It doesn't make sense. If you want to look at your profitability, NPV, IRR are better metrics. But these are great metrics, payback period and discounted payback period for liquidity, because they tell you that how quickly the money is going to come back to you. 2 साल में पैसा आ जाएगा. Within 2 years, you would get your money back, right? So they are great for liquidity, not so great for profitability. So that's one potential theory question. Second potential theory question, discounted payback period will always be higher than payback period, assuming positive interest rate, right? So uh, if my payback period is 2 years, maybe my discounted payback period would be 2.2 years. It will take me more time to get the money back. And finally, one theory question here. Okay. Profitability index. What's your formula? Present value of inflows divided by present value of outflows. So a potential question that can come up is, if my NPV is positive, okay, then what can I say about profitability index? You tell me. If my NPV is a positive number, what can I say about my profitability index? Will it be more than something or less than something? What do you think? If my NPV is positive, my profitability index will be, tell me, my profitability index will be more than 1 or greater than 1. Because my inflows are higher than outflows, so automatically profitability index would be greater than 1. Good job. Good job. All right. Next, NPV IRR profile. They will ask you, what is your y-axis intercept? So now we just did it. Y-axis intercept is your NPV. Y-axis intercept. Sorry, what is your y-axis NPV? Y-axis intercept NPV at 0 discount rate, which means just the total of the cash flow. What is the x-axis intercept? X-axis intercept is IRR. What is the crossover rate? Rate at which NPVs are equal. The rate at which NPV of 2 projects are equal. That's your crossover rate. How to calculate crossover rate? Difference of the cash flow. Compute the IRR. Straightforward. We just did an example. You should be okay with that. NPV IRR disadvantages, advantages. Let me highlight one important theory point for you. That one of the benefit of IRR is it gives you information on margin of safety that NPV does not. Okay, remember this. Maybe write it down. Let me give it a star. IRR gives you information on margin of safety, which NPV does not. Now, what does it really mean? It means, when my IRR is 30 and, let's say WACC is 10. I know there is a huge difference. I have a margin of safety. It looks like a good project. But when my IRR is, 30 and my WACC is, 29.5, then I know that I'm, at a risk, right? I don't have enough margin of safety. So IRR gives you that information, which NPV does not. So remember this one potential theory question here. Then next one, what's the relationship between NPV and stock price? It's a theoretical learning outcome. Like, I see this completely useless, especially in current markets. Like it's been strange what is happening in the markets, right, in the last few days. But if NPV goes up, if then analyst people are sitting and, that's what the learning outcome says. Analyst people are sitting and doing calculations, and then they would do proportionate calculation, and they will just say stock price will also go up. Okay. So I'll show you a quick example of how we've done this in the juice notes. Imagine you're doing a new project of $300 million. Okay. And you're doing a new project of $300 million. And you feel that my inflows would be $400 million. Okay. So what would be your NPV? Your NPV would be 100 million. Now, your number of shares that you've issued are 50 million. So per share, 100 by 50, you're getting a per share NPV of 2. So if your current stock price is 25 plus 2, 27. Okay, it happens only in textbook. It doesn't happen in real world. But that's what they've given us in the learning outcomes. So fine, we'll learn this. All right. So 100 by 50 million 2, and then you add that 2 to 25, you get 27. Okay. And with this, the first reading is over. Are you enjoying this? Give me a yes, no. How is my speed? Give me okay, go fast, go slow. Answer two of my questions. Are you enjoying this? Yes or no? How is my speed? Either tell me go fast, go slow. Okay. All right. Thank you then. So let's jump on to the next reading. Next reading is going to be on cost of capital. So again, we will do 2 or 3 numerical questions first, which I will set them up for you, and then we will do theory. It's okay to take a small 2-minute break if you want to go and get yourself a cup of coffee or whatever. In the meanwhile, I'm going to set up your questions. It's going to be a long day. I know you might get tired. It's also okay to I'll recommend walk a little bit if you have some place around you. If you have a device that you can move around, just try and enjoy this session. It's let's try and make this as fun as possible. And I want to mix numbers and theory in such proportion so that it doesn't get boring. So cost of capital, I'm going to take about a minute to set up your questions. So you have a quick 1-minute window if you need super quick break to go and get your cup of coffee, whatever you need. All right, so my first question is set up. Uh, One question kind of touches on every small part of this reading, uh, and then of course there are some other finer calculations as well. But this is kind of the core. This is it's not Neo. It's some other dog. This is the core of the reading. Okay, so first, what I want you to do is I want you to do a cost of debt calculation. A cost of debt calculation based on this information. Then I want you to do a cost of preference share calculations. Then once you've done with cost of debt, cost of preference shares, you'll have to do cost of equity. Cost of equity, I want you to do three separate calculations based on the three models we have in the syllabus. We have CAPM model, we have Gordon growth model, and we have bond yield and risk premium model. Okay. For BYRP model, you're going to use the bond yield that we get in cost of debt section. Okay. I hope you've understood this. Let me leave this on your screen and you start now. Get started. You'll have to give me 1, 2, 3, 4, 5 answers. Post all your 5 answers on the chat box. You can get the first answer posted, then the second answer posted. Keep on posting your answers, please, everyone. Do the math, get me the answers. Keep on posting your answers one by one. At any point during this session, you feel there are some concepts I do not know, just write them down and move on to the next part of the crash course. Do not leave it halfway. Otherwise, you would never be able to finish it. Sit through. I know it's psychologically difficult, especially when you see other people giving the answer. Doesn't matter. Okay, just sit through. Whatever you do not know, write it down, finish the course, then go and revisit whatever areas you struggled with. Meanwhile, I'm going to try and get myself a cup of coffee. I'm going to solve this now. Now, if you are able to do it, great. Otherwise, just watch how it is being done. First, cost of debt. To do this, we have to use the TVM row. The buttons on your calculator would be like this. Okay, everyone, please observe carefully. Now stop doing what you're doing. Now it's the time we do it together. Okay, so just stop doing what you're doing. Listen to me carefully now. Everyone, please. Face value 1000, payment 50. The in bond calculation, the sign of your face value and payment should always be same, because that's the money you receive. Some people change the sign. You cannot do that with these two values. Only for bond calculation, I'm saying. Face value 1000, payment 50. Present value 920 negative, because that's the money I'm paying, right? So that money goes out. Now N, you guys help me out. What should be my N? Should I keep it 6 or should I keep it 3? Come on, help out your teacher here. 6 or 3, what do you think? What do you think should be the right N? 12, right? Semi-annual bond, 6 years, so you get 12 payments. Now, tax rate, we don't use it right away. We just do compute IY. Compute IY. So I'm going to do it quickly on the TVM row. I'm going to do it on the TVM row here. 1000 future value, 50 payment, 920 negative, present value 12N, compute IY. I'm getting 5.95. That's my IY. Is that my YTM? Is that my YTM, or do I need to do something? Is that my YTM, or do I need to do something? Okay, I mean, this SA was semi-annual. My apologies. I just assume that you guys will pick that up. My apologies. It was semi-annual, SA, semi-annual. All right, but I'm sorry. I just assumed that you guys will pick that up. So compute IY 5.95. Now I'm going to do what I'm going to do is I'm going to multiply this with 2 to get my YTM. The answer doesn't change drastically, but it does change a little bit. So multiplied by 2, and I'm getting 11.90. So there you go. That's my YTM. Okay. Even if you do an annual thing, it doesn't matter. The answer will not change drastically. It will be there. Now, is this my effective cost of debt? Should I stop here? Is this my effective cost of debt? No, because we have to take the benefit of taxes there, isn't it? So effective cost is going to be 11.90 multiplied with 1 minus 20 percentage. 1 minus 20. So this number I'm just multiplying with 0.8, and there you go. That's my final answer. My final answer is coming out to be 9.5227. So let me round it off to 9.52. Now, those of you who got this right, give me a large, loud yo-yo on the box. And congratulations to you for getting this right. And those of you who did not, it's okay. You learned how to do it. Next time you do it, make sure you do it right. All right, so this is done. So cost of debt is out of our way. We're okay with that. Let's do cost of preferred stock. All right, let's do cost of preferred stock. Now, cost of preferred stock, first thing that I need to do is I need to calculate what is my preference dividend amount. What's my preference dividend amount? Like in amount terms, what amount I'm getting. I might make a mistake. You guys help me with that, please. If I make a mistake, you would help me with that, please. 850 into 12 percentage. 850 into 12 percentage. Am I doing this right? Am I doing this right? Am I doing this right? Maybe no. Maybe no. You're right. I cannot use market value to calculate preference dividend. That's stupid. I'm being stupid today. I should take 1000 into 12 percentage. So that's 120. So preference dividend आया 120 रुपया. Preference dividend is 120. Now this preference dividend, I'm going to calculate cost of preference shares. I'm going to calculate 120 as a ratio to 850. And let's see how much 120 as a ratio to 850 is. So 120 divided by 850, I'm getting 14.11. And should I make tax adjustment? So the answer is no. No tax adjustment. Preference dividend are not tax deductible. Preference dividend are not tax deductible. So 14.11 is your final answer. All right. So all the champions who got this right, give me a yo-yo. If you did not, but if you know now how to do it, give me a yo-yo, please. So cost of debt, cost of preference shares is out of our way. I hope you guys are comfortable with this. Let's jump on to the CAPM, CAPM. What formula should I use for CAPM? The cost of equity under CAPM is equal to risk-free rate of return plus beta. And this beta we have to do a little bit of work, multiplied with RM minus RF, which is nothing but equity risk premium. Okay, RFR plus beta into RM minus RF. Now, what's my RFR here? 5%. Beta given to me is 1.5. Return on markets, 16%. Risk-free rate of return, 5%. Let's plug these numbers in. Let's see what we get. So we get 11 into 1.5 plus 5 would get 21.5%. Okay, if you get this right, congratulations, but no big deal. Even school kids would do it. I mean, come on, CAPM, everyone knows it. Now, Gordon growth model. How do you do it? Gordon growth model. The formula that we want to use under Gordon growth model is KE is equal to help me out. What should be my numerator? I think it should be D0 divided by P0. Maybe I'm making a mistake. Maybe you're going to help me out. Tell me where I'm going wrong with this. D0 by P0 into G. Correct, right? D0 by P0, D0 by P0 plus G. Now, no, it should be D1. It should be D1, right? So we want to have D1 by P0 into G. How do you calculate G? I hope you remember the formula. Return on equity into retention ratio. Return on equity into retention ratio. Return on equity given in this question is 20%. So 20% multiplied with retention ratio, luckily for me, is given as 60%, right? So 20 into 60% is going to be 12%. So 12% is my growth rate. Now, how will I calculate D1? So D1 I will calculate, and again, I think I'll appreciate if you help me out here. D1 would be D0 into 1 plus G. D0 into 1 plus G. Now, what's my D0? My D0 here is 5. 5 into 1 plus 12%. Bari punches sat. So that would be 5.6. So now everything is in place. And now we are good to go. So let's write down 5.6 divided by 100 plus 12%, 17.6%. So 17.6 is my final answer under Gordon growth model. I hope this is going well. I hope you're enjoying this. I hope this is making sense. Those of you who have done this right or have understood this now, give me a yo-yo, please. Good job. Good job. Okay. Happy to know you're building momentum. Happy to know you're picking up. Okay. And if there's anyone who feels itna achhe se nahi aaya, if there's anyone who feels, okay, you know what, I'm not so confident with it just yet, write it down. Write it down on one of these post-its. Keep it aside. You can always do it later on. Right? But just sit through the whole crash course. Make sure you go through the entire content. Okay. BYRP. BYRP. Let's see how we do this. Bond yields plus risk premium. Very easy, but people make one mistake. I'm going to do it. You tell me what mistake I made. Bond yield is my YTM. Okay, so YTM we're going to take as above as in this one. So this YTM was 11.9. Okay, so I'm just going to take this 11.9 in this calculation. 11.9, 11.9. And to this, I'm going to add risk premium. And my risk premium is going to be 6%. Maybe I'm making a mistake. Okay, maybe, and you guys are going to correct me. You guys are going to tell me where I made the mistake. So 11.9 plus 6%, and that's it. It's giving me 17.9%. Now tell me where I made the mistake. Tell me where did I go wrong? 17.9. Where did I go wrong? Where did I make the mistake? Where did I go wrong? Must have made a mistake somewhere. The answer is no mistake. There is no mistake. In fact, what people would do is in this BYRP model, the bond yield plus risk premium model, this is they will deduct the tax rate. Okay. I wish I could bark back. This is where they would deduct the tax rate. You don't want to do that because here the intention is to calculate cost of equity. So it's very simple. Like think of it from a pure Bania logic that people who are investing in bond don't care about taxes. People who are investing in bond, they're getting 11.9. Okay. Uh, they're getting 11.9. I'm an equity investor. I need to get more. What's my risk premium? 6. So 11.9 plus 6, 17.9. End of the story. So in bond yield plus risk premium, take the total YTM. Please do not adjust that for tax rate. If you do, for example, a wrong answer would be 9.52 plus 6. And this is going to be one of the options on the exam. Okay, there's a good chance. If I were to write your question, I will keep this as one of the option. Don't do it. This is wrong. This is not the way to do it. Take total YTM plus add risk premium. End of the story. These are your few main calculations in this reading. Okay, cost of capital. Now, are you guys comfortable with this? Just give me a yes if you feel that you're comfortable with this. Okay. So let's do a little more. Okay. We are early in the morning, early in the session. So before I give you the break, let me extract as much value I can as possible. So I know probably you started feeling a little tired. Okay. But let's push ourselves a little bit. Let's do one last number question, then probably 1 or 2 questions, and then I'll give you a break. Okay. So I know you're tired, and I know maybe you feel like I need a small break, but let's do one question. Let's do this one, or maybe a couple of them, and then I'll let you go for a smaller break. Now, I want you to remember, how do you calculate beta? So beta formula. Okay. So formula of beta is covariance between x and y divided by variance of x. Okay. In the context of this reading, it is covariance between a stock and a broad market index. So let me just say market, covariance of stock and broad market divided by variance of market. Okay, that's your formula of beta. Now this formula could also be further simplified. Okay, and how are you going to simplify this? Covariance between stock and market. I can further simplify this as correlation between stock and market multiplied with standard deviation of the stock multiplied with standard deviation of the market, and variance of market is nothing but standard deviation of market and standard deviation of market. So once I write the formula like this, then what happens is, then I'm left with the remainder term, and look at how the remainder term turns out. Okay, correlation between stock and market multiplied with standard deviation of stock, standard deviation of market. Now, what I've seen is in some of the mock exams, the question writers, they like to play around with this concept, okay, on beta calculation. So what they will do is they will intentionally, because some people, they just memorize the formula, but they kind of forget what is the intuition of this. So I'll give you a question, a very small one, but understand what's happening here. What they will do is they will tell you that, we have this XYZ stock, let's say an Indian IT company called Infosys. All right. So let's say, I'm just making up random, Infosys. It has a correlation with market. Okay. It has a correlation with market of, let's say, 0.6. All right. And then what they will say is, they will say Infosys is twice as volatile as market. That's it. And then, then the RFR and market would be given, and you would be required to run CAPM on this. Now, people who've memorized the formula, what they do is they say question mein to standard deviation diya hi nahi hai, right? They'll say this question doesn't have standard deviation. So what do I do now? So you need to understand, even if standard deviation is not given, what they have given you in this question is the ratio of stock by market. So it's fine. When they say Infosys is twice as volatile as market, that means this quadrant, this quotient here is 2. So your answer simply becomes beta is equal to 0.6 multiplied by 2, 1.2. All right. So this small trick you need to be aware of. Maybe, maybe it gets tested. It would not be an independent question, but I think it would be combined with the CAPM. All right. So you should be able to handle this small variation, just a small trick. I hope you're comfortable with this. Now, I'm building on to momentum. Okay. Building on to momentum, and let us do the pure play calculation. Okay. Let us do the pure play beta. I'm not giving you breathing space in between. Our job is to kind of get through as much content as possible in the limited amount of time that's available with us. Let us say we have beta of a competitor. Okay, we have some competing company. So a competitor's beta is, let's say, 2. Debt as a ratio to capital, of competitor, debt as a ratio to capital of competitor is, let us say, equal to 40%. Then we have debt as a ratio to equity, of uh, our project, the project that we are working on, okay, debt as a ratio to equity of our project, let's say is point 2. All right. Tax rate for both, assuming a common tax rate, it's let's say 40%. Now, based on this information, what I want you to calculate is, I want you to calculate what would be the asset beta, what would be the unlevered beta, what would be the unlevered beta, what would be the equity beta, and what would be the relevered beta. I want you to calculate 4 numbers for me. All right, asset beta, unlevered beta, equity beta, relevered beta, using the pure play model that we had studied, and hopefully you've gone through it. Again, from exam perspective, this is a potential question to be tested. So for me, I'm going with a 2-star with this. Get started. You have a minute to do this. Aditya, nice to see you participating. All right, guys. I'm going to solve this for you now. Okay. So if you are able to do it, that's great. If you are not able to do it, that's okay. Stop doing what you're doing and just uh, look at how I'm solving this. I'm going to give you a trick. It's a very easy trick to do these questions. It's some sort of a flowchart based technique generally works. So let's just have a lighter color here. All right, so the way you're moving here in this, instead of memorizing the formula, I'll give you an easier way to think about it. Your starting point is you start with the competitors beta. Okay, you start with competitors beta. Then you run through a process called unlevering. Okay, you want to unlever, and the way you're going to unlever is by dividing. Okay, so you remember that every time I want to unlever, I'm going to divide. Then what you reach is you reach the asset beta. Asset beta is also called unlevered beta. You've removed the impact of debt. Asset beta is also called the unlevered beta. Then you have removed the impact of debt. Then you want to relever it. Okay. And when you want to relever it, you're going to multiply it. And then what you get is the equity beta. Or at times they also call it as the project beta. Okay, so just different words, same concept. If they throw this in along with a CAPM question, use this beta. Okay. Now, how are we going to do this? So let's start doing it. The competitors beta, which is given to us in the question, is 2, right? So it's 2. So we start with 2 being the starting point. So let's have 2 here. The competitors beta is 2. Now, how do you get unlever, or how do you unlever this? So you said 2 divided by, divide, right? 1 plus the debt equity ratio, 1 plus the debt equity ratio multiplied with 1 minus 3. So in fact, let me just write it down here itself. 1 plus debt equity ratio adjusted for taxes. So into 1 minus the tax rate. Now in this example, what do we have? We have a debt to capital ratio, correct? What is the debt to capital ratio given of the competitor? 40%. So when we are trying to unlever, we use the competitor's data. Okay. So debt to capital given is 40%. Now, what does it mean? In a very simple language, if my capital is $100, then out of that, debt and equity, debt is going to be 40, equity is going to be 60, which means if I want to convert this ratio to a debt to equity ratio, I can simply do 40 divided by 60, right? 4 by 6, which is same as 2 by 3. So that's how you get the debt equity ratio here, which means this calculation is going to look like this: 2 divided by 1 plus debt equity ratio 2 by 3 multiplied with, what is the tax rate given? 40%. So multiplied with 60 percentage. All right, let's see how much do we get. I'm going to do this along with you. I have the Texas mobile app here with me. So 2 divided by 3 into 0.6 plus 1. First, I calculated the denominator. I'm taking an inverse of that and multiplying that with 2. So I'm getting 1.4285. Can you guys confirm if this is the correct number? 1.4285 is my asset beta or unlevered beta. Now, once I have 1.4285, then what I want to do is I want to relever the beta. So 1.4285 multiplied with, okay, multiplied with 1 plus, again, debt equity into 1 minus t. Same stuff. 1 plus debt equity into 1 minus t. So 1.4285 multiplied with 1 plus, let's see what we have here. The debt equity ratio is given as 0.2. So 0.2 into 60 percentage. So 0.2 into 60 percentage. Let's see how much we get. So 0.2 into 60 percentage plus 1 multiplied with 1.4285. You guys help me out with the number, please. Please confirm if I'm doing this right. The final answer that I'm getting is 1.59992. Okay, that is your process of starting with competitors beta. Then first you want to unlever it and then you want to relever it. All right, those of you who got this right, or those of you who have understood this now, please give me a yo-yo on the box. This is an important concept. You want to know how to do this from an exam perspective. All right, very nice. So keep the momentum going. Don't feel tired. It's all psychological. You know, you guys are not tired yet. These are just wrong signals. We want to push ourselves today as much as we can. 5 days of hard work, but the day we get results is going to be worth it, right? We want to see the word congratulations. We want to see the words pass when we get the results, and we're going to make that happen. Okay, so even if you're feeling tired, try to push yourself as much as you can. A lot of times is mostly psychological. Okay, we set unnecessary boundaries for ourselves. You should be able to do this with me. All right, now this is more or less what we have for the. This is more or less what we have from a calculation perspective. Let's do the theory now. Okay, let's get done with the theory of this reading. So again, next 2-3 minutes, uh, be super alert. I'm going to identify the important points for you. Okay, cost of capital. I've opened the juice notes of FinTree. Let me just go full screen on this. No. All right, cost of capital. So what do we have? Equity, preferred stock, debt. You guys know the basics. We don't need to go on the basic stuff. How do you do the WACC calculation? You just do the weighted average, correct? Uh, so weighted average is also fine. There's nothing to worry about. How do you calculate cost? We've done calculations. We know that debt, we take a tax shield on the debt. Uh, how to determine weights in the capital structure? Okay, how to determine the weights in the capital structure here. So to determine the weights in the capital structure, you want to use the market values. Remember this. For example, they will tell you that we have bonds which have a face value of, let's say, 1,000, and we have a market value of 900. Okay, on the exam, and then they will say equity maybe a face value of 10 and market value of, let's say, 1,000. Now, when you want to calculate weight of debt, okay, please use the market value. Face values don't mean anything. So use the market value. So you will say total capital 1,900. Okay, total capital 1,900. So weight of debt 900 divided by 1,900. Weight of equity 1,000 divided by 1,900. All right, that's how you're going to calculate the weights in the capital structure. I hope this is clear. Let's move on. Then we have something called as the marginal cost of capital schedule and investment opportunity schedule. Now here, the theory questions that could be asked to you is when you keep on using this opportunity cost schedule, right? What you're doing is you're putting in higher IRR projects here. Okay, so these are the projects where IRR is higher, but your cost is going up incrementally. So where do you stop? You stop at a point where you have maximized the total NPV of your projects. And where does it come? Just a minute. It comes at this particular point. Okay. So again, from a theory question perspective, this is something that you want to remember. What you want to remember is, you want to remember that this point here, okay, this point here, the point of intersection of investment opportunity schedule, downward sloping, and marginal cost of capital schedule, upward sloping, the intersection of that is where you are going to put in your money. That's your optimal capital budget. Okay, so I'm going to move on with this now. Now, what is the role of WACC in determining NPV? A lot of people will overlook this learning outcome, but actually there's a small trick here. Okay, let me show you what that trick is. Again, there could be an easy theory question set up on this. What they will say is, they will say, on an average, the WACC of a firm is, let's say, 18%. Okay, for most of the average risk projects. But we have a new project at hand. We have a new project at hand, and this new project happens to be riskier. So then, what should be the WACC? And your answer is going to be that if 18% is what we use for average risk, and if you're trying to do a project that's riskier, then your WACC is going to be higher than 18%. Okay, so WACC is not a constant number. It's not that you have a big firm and you use 18% for everything. It doesn't work that way. For different level of risk, the WACC needs to be adjusted. So project gets risky, you use higher number. Project gets safer, you use lower number, right? So remember this. All right. So look at this. Project with greater than average risk, use a discount rate that is greater than the WACC. All right. Cost of debt, you guys know it. Cost of preferred stock, we've done. All these formulas we've done. You should be okay. Pure play method, we've done. There's a little bit of theory around beta, but I don't think that's really worth the time here. This part we need to do. Now, what is this? What is this country risk premium? So if you are, let's say, if you are an investor from the US and you're trying to invest in India, what happens is you're exposing yourself to an incremental level of risk, which is the country risk, correct? So you want to incorporate that country risk premium into your calculation. So there are a few formulas you would want to remember. One is country risk premium is equal to sovereign yield spread. What is a sovereign yield spread? It is the difference between the YTM of the two countries multiplied with the ratio of standard deviation of equities and standard deviation of debt. If you don't remember this part, it's okay. Which country, that becomes too much. Just remember this. I'm going to take the difference of the yield of the two countries, multiply that with the ratio of the standard deviation. So that's my country risk premium. Once you get your country risk premium, simply come back to the CAPM formula and look at the CAPM formula now. Risk-free rate of return plus equity risk premium or market risk premium into beta, right? In bracket, add up country risk premium there. Okay. And then you have your cost of equity ready. Now I'm going to give you a quick number calculation on this so that you feel a little more comfortable with what's happening, but I'm going to do it myself. Okay. I just want you to observe how I'm doing it. Let's say that, let's say the difference between, difference between YTM of, let's say Brazil and the US is 3%. Now, what is this 3% called? This 3% is called sovereign yield spread, difference between the two yields. Spread means difference. So 3%. Now, standard deviation of equity markets is, let's say, 5%, and standard deviation of bond markets is, let's say, let me make up 2.5%. Now, based on this information, we can calculate country risk premium. Country risk premium would be 3% multiplied with ratio of these two. Equity markets go in the numerator, the debt markets go in the denominator. So this becomes 6%. Now, what to do with this? 6? So let's say your cost of equity model is RFR plus beta multiplied with equity risk premium, right? What you do is you modify this model and you say equity risk premium plus country risk premium. That means in your equity risk premium, you add this 6%, and then you do rest of the calculation, you're covered. Okay, this is your country risk premium model. All right, so hopefully you're comfortable with this point as well. Simple concept, but just remember this formula, country risk premium formula. Moving on. Last 2 points in this trading, and then you're getting your well-deserved break. Next one is marginal cost of capital, and here you would have a concept of break point. Okay, again, I'm going to do this break point for you. I just want you to observe how I'm doing it. You would be given an equity schedule. Okay, you would be given a debt schedule. You would be given an equity schedule. You would be given a debt schedule. All right. Now your equity schedule would be like this. If you're raising money between 0 and 99, 100 to 199, and let's say 199 to 200 maybe, your cost of equity will increase. It would be 12%, 15%, 18%. If your debt schedule is like this, you're raising between 0 to 49, 50 to 99, let's say 100 to 149, and maybe let us say 150 to 199. Your cost of debt would be 7, 8, 9, 10%. And then they will tell you that there is a firm which wants to do debt as a ratio to capital target ratio, okay, of let's say 30%. Okay, and then based on this information, they will ask you. Based on this information, they will ask you what are the break points. Now, I want you to listen to this very carefully. If you listen to me carefully, you would not have to do this on your own. Okay, this will be done, but you have to be alert, extremely alert. Probably a few days down the line, you're doing this in your prometric centers. So first, what is the meaning of break point? It is basically the total capital raised, okay? Total capital raised at which your WSCC increases, your cost of capital increases. Like, for example, my total capital is 100, but if I go from 100 to 101, it's going to become expensive, right? If you want to have more capital, it's going to become expensive. Now, I'm going to give you a very easy technique to calculate these breakpoints. What you want to do is, this is your equity schedule, right? And this is your debt schedule. Here, I want you to write down what percentage of money is being raised through equity. You tell me, if my total debt as a ratio to capital is 30, what percentage of money is coming from equity? The money that's coming from equity is 70%. And the money that's coming from debt is 30%. Okay. Now, how do you calculate the breakpoints? So you go and look at the points at which these intervals are starting. The points at which these intervals are starting. So your first interval is starting here at 100, correct? Now, because of that 100, see, up to 99, your cost was lower. But if your equity goes from 99 to 100, your cost goes up, right? What you need to do, and it's very easy if you're listening to me carefully, what you need to do is take this 100, okay, and divide that with this 70%. This is the total capital at which your WACC will go up because of equity. Okay, so 100 divided by 70, help me out with that number. 100 divided by 0.7, I'm getting 142.85. 142.85. That's my first breakpoint. What is the interpretation of this number? Interpretation is, if I'm raising money up to 141 amount, my WACC would be lower. But the moment I cross that 142.85, my equity will cross 100 and then my WACC will go up. So that's the easy technique. Take the starting point, divide with 70%. Take the starting point, divide with 70% again. Okay, so 199, I should have made this, I made a mistake here. I should have made this as 200, right? Sorry, 200. and this should be 299. It should be 299. My apologies for this. So 199, 200, 200. Again, I'm taking the starting point 200 divided by 70%. 200 divided by 0.7, that is 285.71. Then I have to do the exactly same thing on the debt front. Take this 50, take this 100, take this 150, divide that with 30%. Simple technique. 50 divided by 30%, 100 divided by 30%. Now, and 150 divided by 30%, whatever the numbers, it doesn't matter. Okay, I'll probably just do one of them. So 166.67. And then I will have these 5 breakpoints. Okay, breakpoint 1, 2, 3, 4, whatever these numbers come out to be. So I'm doing into 2 to this. So 3, 3, 3, 3, and into 1.5. This would be 500. No, is it 500? 4, 500. Yeah. So these are my breakpoints. So what are my breakpoints? I have total of 5 breakpoints. Okay, I have total 5 breakpoints. Let's write down which breakpoints are those. The first one is 143. I'm rounding it off. After 143, I have 167. After 167, I have 286. After 286, I have 333. And after that, I have 500. So if my capital is less than 143, my cost is lower. But the moment my total capital, I'm not saying equity or debt, I'm saying if my total capital goes beyond 143, cost goes up. Beyond from 143 to 167, one cost, but beyond 167, cost goes up. 286, 333, 500. This is because of debt. This is because of debt. 286 is because of equity, the cost of equity going up. 167 is because of the debt, and this is because of the equity, and that's it. These are your 5 breakpoints. Okay, so I hope you're comfortable with this. And if you feel that you're not 100% sure, write it down somewhere, revise that after the end of the session. All right, and now the final point of the cost of capital reading, and then we take a nice break for ourselves, which is the treatment of the flotation cost. Now, what's a flotation cost? Very simple. When I'm issuing equity, when I'm issuing bond, I have to pay some fee to the investment bankers, I have to incur a legal cost. So that is referred to as the flotation cost. Now, what you're going to remember is this. The flotation cost is not to be added to cost of equity. It would be very tempting. They will tell you cost of equity is 13%, flotation cost is 2%. Okay, and what you'd feel is, you would feel, okay, let me add them up. Don't do it. Do not add flotation cost to cost of equity. Then what are we supposed to do? Treat it as a initial cash outflow while doing NPV calculations. Treat it as an initial cash outflow while doing your NPV calculations. That's your treatment of the flotation cost. And with this, the reading is finally over. We've done 2 large readings in corporate finance. The next large reading is working capital, and then the remaining stuff is very easy. We'll be able to do it fast. Are you guys comfortable with my speed? Are you enjoying the session? Are you feeling that you're getting value for your time? Comfortable with the speed? Is the speed okay for you? Good to know that. Good to know that. Very nice. So now, thank you very much. Time value of money 100%. Thank you, Tushar. Jezil, thank you. I appreciate. Okay. Now, those of you who feel that, I am maybe a little fast, like there are some people where you would feel that, maybe I should explain a little more. See, I'm trying to maintain a balance for all of us so that, because we have people with different level of preparation. What I want you to do is, if you feel that there are some concepts we didn't understand, please write them down, do them at the end of the session. Okay. Read through the books and resolve your queries. As I said, we will be answering all your queries on the YouTube comment section once the videos are live. So you will have those. You will have that opportunity of asking us questions. Kanishk, the mocks are already available. By the way, I hope you guys know that we have opened up mocks free of cost for all the candidates on the FinTree site. If you want to write CBT format mocks, you have to write to support@fintreeindia.com. Write on support@fintreeindia.com. The notes, Tejas, will be provided. Whatever I'm writing on my screen, it will be available in the description at the end of the session today. So all these notes that I've been writing, you would get access to them. Don't worry. Will the time be enough to complete FRA? So Suraj, we have the whole night for ourselves. I think the time will be good enough to finish FRA. But if it takes time, it takes time, right? Maybe I can extend the session by a couple of hours. But we will make sure that we do it nicely. We'll make sure that we cover it comprehensively so that you feel comfortable. All right, so let's take a break. It's going to be a 20-minute break. I'm going to just a minute. Yeah. So it's going to be a 20-minute break. I'm going to put on a timer. Okay, I'm going to put on a timer for you. Once 20 minutes are over, you guys come back and then we will start doing subsequent readings. So just give me a minute. Timer 20 minutes. So you can see the timer. Once 20 minutes are over, you guys can come back. We will have another break in about 90 minutes after this as well.
Alert from low battery.
I'm ready when you are. Ready? So again, you know what? Let me just repeat one more time. Got it, Harsh. Let me repeat one more time. Uh, why are we doing this? In these 5 days or in these 5 videos, I'm taking you through every learning outcome, giving you an overview of, this is what is there in the syllabus, and these are the potential type of number-based questions that we might do. So we'll do one. I'm not trying to teach you. I'm just trying to take you through these concepts one by one, step by step. Your job is to sit through this session sincerely and then make a note of, make a list of all the concepts that you felt during the session that you were not very comfortable with. And then the evenings and the early mornings that you get free after the session gets over, you're going to get through them. And then rest of the time you're going to use for practicing questions from the CFA curriculum, right? That's the game plan. What this is going to do is, after these 5 days, you would realize that your recall has gone up significantly. So a lot of times on the exam, we end up missing easy questions. We know what the answer is. Okay. Somewhere, like somewhere we know, okay, I know how to do this, but yaad nahi aa raha hai. I don't know. I know how to do this, but I'm not able to recall. You would not miss those type of questions if you are going through this session sincerely, right? And that's my objective here. My job is to make sure that we do not lose out on those easy recall based points. So what we've done so far, we've done 2 readings. We've done capital budgeting and we've done cost of capital. Now in the next couple of hours, maybe a little less time, I will try to do in the same sequence. We will do leverages, then we will do working capital management, and then we will do corporate governance. Okay, so we will try and go through the important concepts of each of these readings. So the first one that I'm going to start with after the break is leverages. So that's a starting point here. Measures of leverages. It's an easy reading. We should be able to wrap it up super fast. All the queries that I'm not able to answer during the session, please wait till the end of the session. Once video is live, post it on the chat box. We will try and answer all your queries. Okay. Second, these notes that I'm writing, it should be available for download in the description of this video later on. So you would get access to these notes, not the juice notes, but the ones that I'm writing. Okay. So measures of leverages. Measures of leverages. Let's build on to the quick concept. What's happening in measures of leverages? We have sales. From sales, we deduct the first type of cost. Now in corporate finance, we look at cost a little differently. You help me. What type of cost should I deduct here? Sales minus what? Sales minus minus the, come on, help me out, sales minus the variable cost. So sales minus variable cost, I get a number not explicitly, called as such in your text, but when I deduct the variable cost, the cost that changes, with my manufacturing scale, we get a number. We generally call this number as contribution, which is sales minus the variable cost. This number is referred to as contribution. Now from contribution, I deduct the next cost, okay, in the sequence. Help me out here. What kind of cost should I reduce, or what kind of cost should I deduct here? I should deduct operating fixed cost. Operating fixed cost. So contribution less operating fixed cost, and then I get a number. Do you remember what number is this? When I do less operating fixed cost, I get a number called EBIT, earning before interest and taxes, which is also my operating profit, by the way, right? Which is also called the operating profit. Remember, Kshitij, we are not doing an accounting income statement. We're doing a decision-making income statement, a corporate finance income statement. So sales minus variable cost contribution, less operating fixed cost EBIT, less, help me out here, less what? Less the other fixed cost, which is that financing fixed cost. The financing fixed cost, nothing but interest. Financing fixed cost is nothing but interest. So when I deduct the financing fixed cost or interest, I get EBT, earning before taxes. And then when I deduct taxes from it, then I get my net profit. Then I get the final number, which is earning after taxes, or the net profit. All right. Now, the way we want to think of leverages, and this is a really useful way to think of it, is there is a connection between your sales and your EBIT. And then there is a connection between your EBIT and your EAT, right? Once you learn to map out that connection, this reading is done for you in one single flow chart. All right. So how do you map out those connections? How do you build a relationship between those connections? So let me get a nice red color here. So the relationship works this way, that the relationship between sales and my operating profit is given to me by degree of operating leverage. Okay. So for example, let's say if my degree of operating leverage is, let me make up a random number, let's say 2. Okay. What does that 2 mean? Like, what is the meaning of that 2? The meaning of that 2 is, if my sales go up by 10 percentage, if my sales go up by 10 percentage, my operating profit will go up by 20 percentage. If my sales will go up by 10 percentage, my operating profit will go up by 20 percentage, because I have a leverage of 2. If I had a leverage of 3, it would have been 30 percentage. In the same way, the relationship between your EBIT and your EAT, the relationship between your EBIT and EAT is given to you by, help me out, given to you by what? Given to you by degree of financial leverage. So let's say degree of financial leverage, let me make up a random number, 3. Okay. So if EBIT is going up by 20%, okay, if EBIT is going up by 20%, because of that 3, my net profit will go up by how much? EBIT went up by 20%. Because of that 3, my net profit will go up by 60 percentage. Okay. So that degree of financial leverage is playing out for me. So take a step back and look at the larger picture. See how magical this thing is, right? And especially if you learn to use that for investing, your sales went up only by 10 percentage, right? Your sales went up only by 10 percentage, but your net profit, your earning after taxes, went up by 60 percentage. So if I build a direct relationship between the two, okay, if I build a direct relationship between the two, a direct relationship between sales and net profit, that direct relationship, it's called degree of total leverage or degree of combined leverage. degree of total leverage or combined leverage, and how much is that going to be? I start with 10% here. I end up with 60%. That means the relationship is 6, the degree of total leverage, right? Now, what are the formulas for calculations for each one of them? So let's look at the formulas. Let's make sure we remember this formula as well. So you guys help me out. Degree of operating leverage. Degree of operating leverage, what's your formula? Degree of operating leverage. How would you calculate degree of operating leverage? You would say contribution divided by EBIT. Contribution divided by EBIT. That's your formula for degree of operating leverage. If I make a mistake, you're going to correct it. Okay. In case if you feel some formula is going wrong, tell me on the chat box. I'll fix it for you. So degree of operating leverage is contribution by EBIT. Degree of financial leverage is, maybe I'm making a mistake, correct me here, EBIT divided by EBT. EBIT divided by EBT. And degree of total leverage simply is going to be degree of operating leverage multiplied with degree of financial leverage. Right? So these are the three main formulas that I'm working with here. And you kind of want to remember these formulas. Okay, so which are the formulas we're working with? Just a minute. So first formula for you, contribution divided by EBIT. Second formula for you, EBIT by EBT. And the third formula for you, DOL into DFL. Okay. Now what I'm going to do is, I'm just going to give you one question, but a comprehensive one, where in a single question, we will cover all the possible calculations that might show up in this reading. It will take me maybe a minute to frame that question. But once we practice that, you're going to feel very, very comfortable with how we've done this. Okay. So here's the question now. Let us say we have sales price per unit of some product is, let's say, $20. Variable cost per unit is, let us say, 12. Quantity sold is 1000. Operating fixed cost 8000, 4000, 2. Operating fixed cost 4000. Interest 1000. Interest 1000. Tax rate 25%. Okay, this is the basic data. Now I'm going to start with a series of questions on this data. Question number 1. First, you just prepare the income statement the way we just did. Okay, please prepare the income statement. Then calculate DOL, calculate DFL, calculate DTL. Third, if sales go up by 7%, will be the impact? What will be the impact on A, EBIT, in fact, A, contribution, B, EBIT, C, EBT, D, EAT. If sales go up by 7%, what would be the impact on contribution, EBIT, EBT, EAT? Fourth, calculate. And fourth question, by the way, is going to be my pick for this reading. So I'm going to go 4-star on this. I feel there could be this question has a slightly better probability. So calculate, just let me finish doing this question. Operating break-even point, calculate total break-even point, quantity to be sold, quantity to be sold to earn, quantity to be sold to earn operating profit of 8,000, quantity to be sold to earn EAT of 10,000, especially the last question. Okay, I really love this one. If you get the last one right, you've actually prepared really well for this reading. All right, I think these 4 questions kind of cover the whole landscape of what we have in this reading. Get started. You have a minute. Let's see if you can handle this. I'm trying to put the whole thing on my screen. Hopefully you can see everything. All right, get started, guys. You have a minute to do this. This is going to make sure that you're comfortable with this reading. All possible calculation-based questions are covered here. Keep on posting your answers on the box. Okay, as and when you do it, keep on posting your answers, please. Throughout the session, you come across anything that you're not comfortable with, anything that looks difficult, please do not give up. Write it down somewhere, visit those concepts at the end of the session, but keep on, adding new concepts and keep on revising the concepts with me throughout the day. You have a minute, otherwise I'm going to do it myself. Maybe a couple of minutes at tops. Keep on posting answers, please. When you start something new, at the beginning, it looks like, it's so big, how I'm going to do it. For example, these crash courses, your syllabus, it looks so vast, right? So when you try to think of all of it together, it becomes too much. But if you just break it down into smaller parts and try and not think of the whole thing, just try and think of the next step, it becomes very easy. Just one reading at a time, that's it. Right now we just think of the question that we have at hand. We don't really worry about anything else. Just one reading at a time, step by step. We keep on doing it. Before you know, your syllabus would be over and you would be much more confident than what you are as of now in next 5 days. Keep on grinding, keep on putting in the efforts, even if you're tired, doesn't matter. Give your best, give you 100%. Come on, I want everyone, each one of you to give me an answer on the chat box. Doesn't matter, it's right or wrong. You're struggling, that's okay. All right. I'm going to solve this for you now. Okay, I'm going to solve this question. Now what I want you to do, okay, now what I want you to do is just stop doing what you're doing and do this along with me. Okay. Uh, I know you've reached, very close, but I want you to do this with me now. Okay, just stop doing what you're doing, just focus on the screen. Step number one is, of course, I'm building my income statement. Sales. This is going to be, sales is going to be 20 into 1000. So my sales is going to be 20,000. Sales 20,000. Variable cost, 60% of this. Is that correct? So variable cost would be 12,000. 12 into 1000. Then we get this magic number called the contribution, which is going to be 8,000. Operating fixed cost 4,000. Operating fixed cost 4,000. So I will get EBIT, earning before interest and taxes. That's going to be 4,000. Interest is given as 1,000. So I will get EBT of 3,000. EBT of 3,000. Taxes of 25%. So that becomes 750, I guess. Please correct me. Earning after tax becomes 2250. All right. So this is my basic income statement. Now let's see if we can calculate DOL. So degree of operating leverage, contribution divided by EBIT, contribution 8,000, EBIT 4,000. 8,000 by 4,000, that's going to be 2. DFL, EBIT divided by EBT, EBIT divided by EBT. So EBIT divided by EBT, 4,000 divided by 3,000, 1.33. Degree of total leverage, degree of combined leverage, DOL into DOL into DFL. So that's going to be 2 into 1.33. Is this coming out to be 2.66? Is that correct? So 2.66 or 2.67. All right. So we've been able to answer the first two. Now the third one. If the sales go up by 7%, what will happen to the contribution? Okay. So now listen to me carefully. The percentage change in sales, okay, percentage change in sales is always same as the percentage change in contribution. Percentage change in sales and percentage change in contribution is always same. So if my sales is going up by 7%, fair enough, my contribution will also go up by 7%. I don't know how many of you got this trick right, but if you did, that's impressive. That means you're thinking mind, right? You're getting this right. And if you didn't, know it now. And why is that? Because the distance between sales and contribution is variable cost, correct? And that variable cost is a fixed proportion of sales. So therefore, 7%. By how much EBIT will go up? So we'll have to use a DOL formula. So we will say percentage delta EBIT, okay, percentage delta EBIT by how much EBIT will change is equal to percentage delta sales multiplied with degree of operating leverage. So 7% into 2, this becomes 14%. It will go up by 14%. Now, another thing you need to know is percentage delta ABT. A lot of people don't know this. I know, I can imagine at least half of the people who are participating in this session are probably have not thought through this. But percentage delta EBIT is same as percentage delta EAT, because the difference between earning before tax and after tax is tax percentage, right? And tax is again a fixed proportion. So this is always same. And how I'm going to do this is percentage delta sales into degree of total leverage is equal to percentage delta EAT, earning after taxes. So आपका sales ऊपर गया 7% है, your sales went up by 7%. Your total leverage came out to be 2.66. So let me just do this quickly here. So that's going to be 7 into 2.66. I'm getting the answer of 18.62%. 18.62%, which is the answer here. Okay. I hope you guys got this right. And if you feel that you're not very confident with this, write it down, do it at the end of the session. Write down that you were not comfortable with this particular question, do it at the end of the session. That's fine. Now, how do you calculate operating break-even point? Here's your formula. Operating fixed cost. Okay. Again, don't do it. Please look at the screen so that even if you got this wrong earlier, you'd at least know how to do it on the exam. Operating fixed cost divided by contribution per unit, or operating fixed cost divided by contribution per unit. Okay, now let's see how this thing plays out. Let's look at operating fixed cost. My operating fixed cost here is 4,000. So my numerator of this formula is going to be 4,000. Contribution per unit is nothing but difference between the sales per unit and variable cost per unit. So sales per unit is 20, variable cost is 12. So per unit, I'm earning 8 rupees of contribution. So 4,000 divided by 8. And how much is that going to be? 4,000 divided by 8. 4,000 divided by 8. That's going to be 500 units. So 500 units. It's a quantity answer. Okay, so you've got answer in quantity, 500 units. What would be the total break-even point? Operating fixed cost plus interest divided by contribution per unit. Operating fixed cost plus interest divided by contribution per unit. So 4,000 plus 1,000 divided by 8. Interest was 1,000, right? So 5,000 divided by 8. I'm getting 625 units. Okay. So 625 units. Important from exam perspective. Learn to distinguish between operating break-even point, total break-even point. In total, you're also covering for interest. In operating, you're just worried about operating fixed cost. Now, quantity to be sold to earn operating profit of 8,000. Quantity to be sold to earn operating profit of 8,000. Operating fixed cost plus desired operating profit. Operating fixed cost plus desired operating profit divided by contribution per unit. That's your formula. Okay. So operating fixed cost 4,000 plus my desired operating profit is 8,000 divided by contribution per unit 8. So we are looking at 1,500 units. So this is your next one. We're looking at 1,500 units. And finally, quantity to be sold to earn desired EAT of 10,000. Now, a lot of people would make mistake here. And it's a very subtle calculation. Okay, the last one here. What you need to do is a desired EAT of 10,000 is same as desired EBT. I know a lot of people are going to get this one wrong. Desired, and if you are getting this one right, you've actually prepared very well. And if you haven't got this right, I want you to look at this carefully so that if this question shows up on the exam, you know how to do this. Desired EAT is equal to desired EBT of 10,000 divided by 1 minus the tax rate. Okay, what's the tax rate here? 25%. So 25%. So let's see how much is that going to be? 10,000 divided by 0.75. So that is equal to 13,333 or 33. So a profit after tax of 10,000 is equal to profit before tax of 13,000. So अगर आपका profit before tax 13,000 है, if your profit before tax is 13,333, then you would pay tax of about 3,300 and your net profit will come out to be 10,000. Okay, so this is how you need to convert that. Then the formula that you use here is your operating fixed cost plus your interest cost, because you want to reach on the net profit level now, right? Plus desired EBT divided by contribution per unit. See, the formula includes desired EBT, right? That's why we have to do it differently. So what is my operating fixed cost? My operating fixed cost here in this question was 4,000. My interest cost was 1,000. My desired EBT is 13,333 divided by contribution per unit is 8. Let's see how much we get here. So plus 5,000 divided by 8. The number that I'm getting here is 2291.66. So 2292 units. 2292 units, which is your answer for the last one. I told you the last one is a 4-star. You want to be good at this. Okay, you want to make sure you need to know the concept, but you also need to know the logic through which I did these calculations. Now, those of you who have understood all the questions and got them right, give me a large yo-yo on the chat box. I'm really, really happy. If you understood this completely or you were able to do it by yourself. Come on, I'm sure we have few people here. I'm sure there is at least someone. There's at least someone who got this right. Yeah, we have a few people. Noel, Arya, Arnav, Anurag, Rakesh, Charu, Ajinkya, Samir. Great job, guys. Jezil, Bhagyashri, Rakshita, Sanaya, Prakash, Rohit, Shashank. Great job. Good. That's impressive. Ujwal. And Samit. Great job. Tejas. I don't know what that means, but I hope you're getting this. I hope you're learning this. And I know there are some people with us, some people who are feeling, I don't know this 100%. Maybe I got it, maybe I did not. That's fine. Write it down. This example, write down in your list the degree of operating leverage example. At the end of the class, go and revisit it. You'll be all right with this. Okay. So now with this example out of our way, let's go and finish theory of this reading. Let's go and touch every learning outcome and make sure we are comfortable with it. Okay. Now in theory, in the juice notes, we had built this beautiful pie chart. This pie chart means something. ध्यान से सुनना. ध्यान से सुनना in Hindi means listen to me carefully. So ध्यान से सुनना, please listen to me carefully. How do you know which company has more leverage and which company has less operating leverage, right? How do you want to think of it conceptually? So if there is one, let's assume both the companies have total cost of 100, okay? But in the first instance, out of 100, let's say 70 is variable cost and only 30 is fixed cost. So fixed cost is a very small proportion. We generally say it's a low leverage company, low operating leverage. But in the second instance, the variable cost is, let's say, only 20 and fixed cost is 80. So the proportion of fixed cost in your total cost structure is very high. These are the companies which we say are generally high leverage companies. Okay. So if you think of in business terms, if you look at a manufacturing company, one of the big fixed costs that manufacturing companies will have is depreciation. So if there is a company which has set up a large plant, okay, large plant, they're getting very high depreciation, but they have not started manufacturing as aggressively yet. So variable cost low, depreciation high, that's a very high leverage. Okay, those are relatively riskier companies to be with. So that's your intuitive way of thinking on leverages. Then these are your formulas, contribution by EBIT, EBIT by EBT. And then we can also look at them as delta EBIT by delta sales, and then delta uh, EAT by delta EBIT. Now, one more thing here. In fact, I would like to write that down in your notes. And I want you to listen to this carefully. I told you sometime back that percentage delta earning before tax, okay, the profit before tax is same as the percentage delta profit after tax, right? I told you this. Now, it is also same as percentage delta earning per share. Okay, so at times, intentionally the question writers will ask you on earning per share rather than asking on total profitability. But it's the same thing, right? This is nothing but per share profit. And of course, we are looking at percentage change. So per share profit and total profit, as long as the number of shares are constant, that is going to be same. So have that at the back of your mind. The question writer might test you on EPS as against the earning after taxes. All right, but it's the same concept. So you should be okay with that. Now we have already done this. ROE formula is net income divided by equity. So that's, that should be okay. We've already done all the break evens. There's not much left in this reading. We've covered everything. Okay. Now, degree of operating leverage or operating, the leverage reading is out of our way, and it's now time to jump on the next reading, which is working capital management. Are you comfortable with my speed? Is it going all right for you? If you're finding some areas difficult, please hang on. Don't give up midway. Approach it one reading at a time. Push yourself. Say that, let me do one more reading and then let me do one more reading. And before you know, our syllabus is going to be over and you're going to feel very confident about yourself. Just be patient and keep on grinding. All right, then how's the Josh? How's the Josh? Good. So now we are on working capital management. Very nice. Working capital management. Let's start. Again, I'm going to set up the numbers for us first. Okay, this has a little more. Josh means Jizzle. Josh means energy. It's how's the Josh is essentially it's basically a thing from like one of the classic movies in India. All right, guys. Working capital management. Here's our question number one. Okay, I'm going to be as comprehensive as I can be. Opening inventory 1,000. Closing inventory 2,000. Sales 5,000. GP margin, the gross profit margin 20%. Opening accounts receivable 500. Closing accounts receivable 0. All sales are credit. Opening accounts payable 1,000. Closing accounts payable 0. Opening accounts payable 1,000. Closing accounts payable 0. All purchases are credit. Now, ideally, I should not give you the purchases, okay, but I'm going to give it to you. But how to learn to calculate purchases, we will learn that in the cash flow class towards the later part of the day. So purchases, let me do my own math quickly. So 2004, 6,000, so total purchases are 5,000. And with this information, here's what I want you to calculate. First, you're going to calculate number of days. In fact, first, you're going to calculate inventory, accounts receivable, and accounts payable turnover ratio. Then you're going to calculate number of days in AR, AP, inventory. Then you're going to calculate operating cycle. You're going to calculate operating cycle, and then you're going to calculate the cash conversion cycle or the net operating cycle. All right. Should take you a couple of minutes. I will wait for you to try because I want you to practice. I just don't want you to sit and listen to this. I want you to make an effort, try and do it yourself. And if you're not able to do it, then I'll show you how to do it. All right. But give your best shot. Let's see if you can handle this. You have a couple of minutes. Come on, guys, pick up some speed. Make an attempt, please. Don't sit and watch everyone else do it. You'll have to do it yourself on the exams. Try and do this live with me. It's going to be immensely satisfying after the 5th day when we've gone through the whole syllabus. Okay. All right. Let's do it together. First set is let's set up our formulas, right? Once we get the formulas right, it's very easy to do this. So inventory, accounts receivable, accounts payable. How do you get the turnover ratios? So here you would say COGS divided by average inventory. Okay. In most of the cases, average will do the job. In some cases, you have to use closing, but unless otherwise mentioned, even on the exams, just work with average. That's the right way to look at things. Then accounts receivable would be credit sales divided by average accounts receivable. Accounts payable is going to be credit purchase divided by average accounts payable. These are my 3 turnover ratios. Then how do I get number of days? So number of days would simply be 365 divided by this turnover ratio, right? Divided by inventory turnover ratio. Here 365 divided by accounts receivable turnover ratio, and 365 divided by accounts payable turnover ratio. So that's your visual way of remembering formula. The turnover ratios goes in the denominator, you get your number of days. Now, once you have number of days, your operating cycle, so let's call this inventory as A, accounts receivable as B, and accounts payable as C. So your operating cycle is simply going to be A plus B. Okay, that's it. It's that simple. Just A plus B. And your cash cycle is going to be A plus B minus C. That's it. So you do this right and you have your answers ready. Okay. So let's start punching in the numbers into the formula. Let's start getting the answers. So what is the COGS given here? COGS is given here. My gross margin is 20%. That means 4,000, right? I mean, 20% is profit, 4,000 is COGS. So let's put in 4,000 here, 4,000. What would be an average of my inventory? So an average of my inventory would be an average of these two numbers. So that's going to be 1,500. So 1,500. So 4,000 divided by 1,500. Can you please help me out? 4,000 divided by 1,500 is how much? 4,000 divided by 1,500 would be how much? I'll also do it. 4,000 divided by 1,500. So I'm getting 2.67. 2.67. Now 365 divided by 2.67. right? 365 divided by 2.67. So 365 divided by 2.67. I'm getting about 136 odd days. So I'm going to round it off to approximately 137 days. All right. So that's my number of days in the inventory. Now let's do credit sales. Credit sales, all sales are credit sales. So total sales was 5,000. So sales 5,000. Average accounts receivable, it's going to be an average of opening and closing. So where is my opening and closing? Here, 500 0. How much is that going to be? That's going to be 250, right? 500 0. What's going to be an average? It's going to be 250. So average accounts receivable 250. So let's see how much. 5,000 divided by 250, that becomes 20. So my turnover ratio is 20. Then 365 divided by 20. So 365 divided by 20, my number of days, I'm going to keep it as 18.25 or just 18 days. All right. So that is my number of days in the accounts receivable. Let's look at accounts payable, credit purchase. What are my purchases here? My purchases are 5,000. So purchases 5,000, purchases 5,000. Let's write that down here. And average accounts payable is going to be an average of these two number. That is going to be 500, right? So 500. So what would be my ratio? Ratio would be 10. Then 365 divided by 10. So we're looking at 36.5 days. So this is in days. This is in days, right? This is in days. Now, once we have this, then let's look at operating cycle. Operating cycle would be 137 plus 18.25. So let's look at how much. 137. So I'm getting, help me out here, 155.25 days. So my operating cycle is about 155, 156 days. Then what would be my cash cycle? By the way, cash cycle is also called as, and at times they use these words interchangeably, causes confusion. Cash cycle is also called as, can you tell me what? Cash cycle is also called as the net operating cycle. Okay, it's the same thing, net operating cycle. So net operating cycle is nothing but the operating cycle, which I've already calculated, A plus B, that's 155.25 minus the number of days in accounts payable. Number of days in accounts payable are 36.5. Please help me do the math, please. How much is that going to be? 36.5 is going to be how much? It's going to be 118.75. And there you go. These are your answers. Let me try and zoom as much as I can. Now, those of you who got everything right here, give me a large, loud yo-yo on the box. Those of you who got these answers right, you're doing a great job. And also the ones who have understood this now. Good. Good. I'm happy. I'm happy you're keeping the momentum. I'm happy you're picking up. And I hope you're feeling comfortable with these calculations. These are brownie points on the exam. This comes up on the exam. You should have muscle memory for it. Tuck, 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 you get your answer. Opening and closing inventory, we took an average. Opening plus closing by 2. Average inventory is opening plus closing by 2. Vasu, that's some enthusiasm. All right. See, purchases were already given. Anurag, inward Y was not required here. Shivesh, but let's go step by step. All right. Now this reading is calculation intense. We have to do plenty of more calculations. At least two more calculations. The next one that I'm doing for you, this is my favorite pick. Okay. Uh, if I have to pick one question where I feel very confident that it might come, like, and I could be completely wrong, but this is just my personal thinking on this. I'm going to choose this question, the one that I'm doing next. Now, this question, which is a 5-star, is on annual cost of trade credit. Okay, it's a very easy question, but a lot of people get this wrong. Annual cost of trade credit. Annual cost of trade credit. Okay, and what they will give you is on the exams, you probably get something like this. Okay, let's look at this. On the exams, you probably get something like, let's say, 2 by 20, 2 by 20, net 100. Okay, and then only based on this information, you will have to calculate what is the cost of annual trade credit. Now, I'm going to give you only 30 seconds. If you've attended any of my sessions in the past, I've given you a magic trick to solve this, right? A super cool trick. You can solve it just like that. You have 30 seconds, do it. Otherwise, I'm going to explain what this means and I'm going to solve this for you. But I'm going to wait for 30 seconds. Give it a shot. All right, so I'm going to solve this now. See how this is to be done. What does it mean first? What is the meaning? Meaning is I have made purchases. Okay, let's assume it's an assumption. Let's assume that we made purchases. We have made purchases of $100. Okay. Now, what I'm offering to this person is that if you pay within 20 days, then you would get a cash discount of 2%. So that means you would get benefit of $2. Otherwise, pay entire amount on day 100. Pay entire amount on day 100. Okay. So if you pay within 20 days, you would get a cash discount of that 2%. And if not, then you'll have to pay the entire amount on day 100. Okay, that is the meaning of that 2 by 20. Now you want to convert that to an annual cost of trade credit. So here's your magic trick. Okay, what you do is simply draw a timeline. Just build a timeline like this. In your timeline, put in day 0, put in day 20, and put in day 100. Okay, day 0 is when you make the purchase, 20 and 100. Now on day 0, you make purchase of 100 rupees. Okay, now what option you have? You have two options. You pay on day 20. Here you pay 98, or you pay 100. Correct? Either you pay 98, you're getting a 2% cash discount, or you pay 100. That's your thinking here. Agree? So take these two amounts. All right. In your TVM row, make this as present value, make this as future value. Keep your N, and a lot of people would get this wrong. Keep your N as what fraction of year is that, right? What fraction of year is that? We have 80 days, right? So 80 divided by 365. So keep your N as 80 divided by 365 and compute IY and job done. No formula, no complications whatsoever. Really simple, really easy. 98 present value, 100 future value. Avoid error 5. Avoid error 5. Keep one of them negative, keep one of them negative, keep one of them positive. I hope you know what error 5 is. And do the math and tell me what answer you get. I'm going to do it myself. Okay, so 98, 98 negative present value, 100 future value, 80 divided by 365, 80 divided by 365 is N, compute IY. My answer is 9.65. Those of you who got the answer right, give me a yo-yo on the box. And let's get ready for the next question. Okay, I hope you're picking up. I hope this is making sense. I hope that something like this shows up on the exam, and I hope that you get this right. And then there would be a big smile on your face. And that's what we're working for. All right. Good job. Now, let's do a monster question. Okay. This is not going to be easy, what I'm doing now. But if you learn to do the way I'm going to show you, you're going to really enjoy this. Okay. This is actually not one question. It's actually 4 or 5 different questions combined into one. It's going to be a lot of fun, what I'm showing you now. Let us say we buy a T-bill. Okay. Let's buy a T-bill. Let's buy it for 940. Let's keep the face value as 1000, and let's make this a 90-day T-bill. Okay, now you're actually making a lot of money for 90 days. It's almost theoretical, but that's fine. We're learning, we're learning how to do calculations. Now, based on this information, I want you to calculate following numbers. A, calculate holding period yield. Holding period yield. B, calculate effective annual yield. C, calculate bond equivalent yield. D, calculate money market yield. And calculate bank discount yield. 5 yields. It's going to be fun. 5 yield. It's going to be a lot of fun, and there is a magic trick to it, by the way. Those of you who've studied this with me, you probably know what the trick is. We do some really stupid thing to memorize the formula, but then they become very easy. And if you've not, try and do it your way. Let's see. Let's try and get the answer for this. Okay, try and calculate these 5 yields, please. get started. This will take you 2 minutes. Should take you about 2 minutes. Come on, everyone. Don't slow down. Give you 100%. You know it, you don't know it, doesn't matter. Let's push ourselves. Let's push ourselves as much as we can, and let's make it happen for us. Make an attempt. Don't give up. Don't pause the video and start browsing juice notes. Push yourself. See if you can recall these formulas. See if you can recall the technique that we built, the technique of three mistakes, right? Memory technique that we built. See if you can do that. Come on, I'm waiting for you. Keep on posting your answers on the box, please, everyone. Most of the people, it seems like they've reached BY level. Come on, pick up some speed. Let's see if you can do this. 5 separate yield calculations. Tejas, are you still on HPY? Come on, pick up some speed, please. Suraj, Parth, Zero, Manisha. All right, I'm going to do this. Now you guys stop. Let's do it together. Okay. You stop doing what you're doing and do this with me. If you observe carefully how I'm doing it, I'm going to show you a magic technique. You would not really be required to memorize those unnecessary formulas. Okay. I mean, 5 yields is 5 formulas. They're completely useless. We can do this. We can do this with very simple logic. The trick that I'm going to give you, it always works. Okay. So the way you want to visualize these 5 formulas is just draw these 5 boxes. So I'm going to draw a box in the center, and then I'm just going to kind of, circle them with few boxes here. And, it kind of makes the whole visualization process easy for us. The calculation is easy. You repeat this calculation a couple of times, and then you end up building muscle memory for yourself. In the center, we start with holding period yield. That's kind of a starting point for any yield calculations that you want to do, holding period yield. Now, the only thing you want to remember is the sequence. Okay, so the sequence is you do effective annual yield here. Then you do bond equivalent yield. Okay, bond equivalent yield. Then you do money market yield, MMY. Okay, money market yield. and and then you do bank discount yield. So these are your 5 yields. This is a sequence. Now here's the memory technique. What you need to know is that because of the convention, in some of the yields we make some mistake. It's not actually a mistake, it's a convention, but mathematically it's a mistake. So the way it's going to flow is when you're on EAY, you make no mistake. Okay. Now what do you mean by no mistake? It means you do this calculation the right way. Okay. So what is the right way? Number one, you should use compounding, because when you're annualizing the yield, compounding is the way to go. There are 365 days in a year, so you should consider 365 days, and your base or the denominator, of any calculation that you do is the amount that you invested, right? You calculate returns on the amount invested, not on the face value. So your base here is 940. So when you are working with EAY, no mistake. When you come to bond equivalent yield, and if you remember the sequence, you would remember that there is one mistake that we make here. Okay, so the reason why we want to do that, so that we don't have to memorize the formula, and you don't have to memorize a mistake also. After a little bit of practice, it comes to you naturally. So the second and third, we are doing it right. We do use 365 days, and we do keep a base of 940. But the mistake that we do here is that we stop compounding. So here we have no compounding. So you have to do the math considering that there is no compounding, 365, 940 as the base. Okay. Then we go to money market yield and we make two mistakes here. Two mistakes. The first two mistakes in the same sequence. So what would be those mistakes? Number one, I am not doing any compounding. Number two, now I start using 360 days in a year, right? A convention that we use in finance. And then in step number three, I still keep 940 as my base, as my denominator. Okay. And in the final bank discount yield, and this is bank. So one easy trick here is, remember, bank makes all the mistakes. Bank makes a lot of mistakes, right? So what three mistakes are we looking at here? So your three mistakes are going to be number one, there's going to be no compounding. Number two, you're going to have 360 days. And number three, strangely, you're going to keep 1000 as your denominator, right? You're going to keep 1000 as the base. You're going to calculate returns on the face value. Now look at all of them together. No mistake, one mistake, two mistake, three mistake. Okay. And if you can build a conceptual framework, your calculations are very easy. Now see how the calculations work. Let's look at holding period yield now. Very simple. Holding period yield. How much did I invest? I invested 940,000 in 90 days, right? Now holding period yield is very simple. My 940 is becoming 1000. Okay. My 940 is becoming 1000. How much I'm really earning here? I'm earning 60 on an investment of 940. Finish. That's it. So easy, right? 60 divided by 940. Let's do how much is this? 60 divided by 940. How much is this? So 60 divided by 940, I'm getting 6.38 percentage. Okay, please correct if this is right. Please confirm if this is okay. 6.38 percentage. Now you want to play around with that 6.38 percentage everywhere. In effective annual yield, you have to use compounding 365 days and take the number forward. So how will you do it? Simply, you will say 1 plus 6.38 percentage raised to 365, compounding, right? So raised to 365 divided by 90 minus 1. And that gets you your answer. Now, if you're a kind of a guy, if you're a kind of a person who hates formula, like I don't like formulas myself, don't do the formula. We can do it the other way around. Then we can do it as simple Banya logic. We can say, okay, if I invest $100, okay, at the rate of 6.38 percentage for a period of 365 by 90 days, what future value will I get? Okay, that future value would be my annual income. So let me do it the TVM row way. So 100 is the present value, 6.38 is the IY, 365 divided by 90 equal to is N. Compute future value. I'm getting 128.50. 120. So my $100 will become 128.50, which means my answer here is 28.50 percentage. So that's your first answer. Straightforward. Now, when you come to bond equivalent yield, it's even easier. Just remember one mistake, no compounding. Okay, so do it like a school kid. How a school kid would do is, he will say for 90 days, I'm earning 6.38. How much will I earn for 365 days? That's it. For 90 days, I'm earning 6.38. How much will I earn for 365 days? Cross multiplication. So 6.38 into 365 divided by 90. Let's see how much is that. So 6.38 into 365 divided by 90 equal to, that's going to be 25.87. 25.87 percentage. So that's your bond equivalent yield. When you come to money market yield, same calculation, no compounding, but now only 360 days. So even easier. For 90 days, I'm earning 6.38. Okay. How much for 360 days? That's it. So 6.38 into 360 divided by 90. So here I will get 25.52 percentage. And the last one, here you make all the three mistakes, your denominator changes. So you will say for 90 days, I'm earning $60 on 1,000 as the denominator, which is 6 percentage. How much will I earn for 360 days? So 6 percentage into 90 by 360. And here you would get 24 percentage. And that's it. These are your answers. These are your 5 yields. Okay, so instead of memorizing the formula, I think this framework is very easy. Just do 1 or 2 questions by yourself. You'd realize that you'd never struggle with these calculations going forward. Now, if you've got these right, or if you've understood all of these, give me the usual yo-yo on the box. Yeah, thank you. I did the other way around. Huh? 360 by 90. This should be 360 by 90, my mistake. Good. Now, whatever parts you feel I'm struggling with, whatever parts you feel I need to, work a little bit more, write them down, do them at the end of the session today. All right, now there are 5-6 different ways. People are asking me if there are different ways. If you've already practiced using some other method, do it. Okay, whatever works for you. Now, this technique I generally find easiest because then I don't have to remember all those formulas. Effective annual yield, it's a pretty easy concept. You just add 1% plus 1 plus holding period yield and then scale it up to a year. But this is pretty cool, right? I mean, what you say is, I'm an investor, I'm investing $100. 100 is a random number, but 100 is easier. So 100 is the present value. Interest rate is 6.38. That's what I'm earning. But I'm investing for how many periods? Roughly 4 periods, because I'm earning this for 90 days, right? So 365 by 90 is your N. Compute future value. Future value came out to be 128.5. That means it is 28.50%. Practice a little bit, you'd get okay. All right, all the numbers in working capital is done. Let's get done with the theory now. Okay, so theory 1. Let's make sure we are comfortable with theory. What is working capital? You guys know it. I don't need to spend time there. Working capital definition, current assets minus current liability. Now, main sources of liquidity is your usual business. Emergency sources, secondary sources, you have to sell assets or restructure your debt. This is useless. Okay, ratios. Most of the ratios we did, but I want you to remember a few more. Okay, current ratio, current asset by current liability. Quick ratio, also called the acid test ratio. From your numerator, remove inventory. Why is that? Because out of your current assets, inventory takes the maximum time to get converted to cash. So inventory goes from the numerator. And cash ratio is simply cash and marketable security as a ratio to current liabilities. Okay, these are some of your important liquidity ratios. Cash conversion, net operating cycle, we've already done. So I'm going to assume that you're comfortable with this. These yield calculations we've already done. Cost of trade credit we've done. This is an important part. Okay, I'm going to give this a single star. This might get tested. You should be able to read this thing called the aging schedule. Okay, now what is an aging schedule? Let me just quickly write down a number for you. Just a minute. So let's look at an aging schedule. How does it look like? What companies generally do is in their annual reports, they generally provide this information. They will say, classify all their accounts receivable into following bracket: less than 90 days, 91 to, let's say, 180 days, okay, and 181 to, let's say, 365 days. Okay, this is just an example. Now, they will give you last quarter and let's say current quarter. Okay, and let's say last quarter we had total $2 million here, and then we had about $1.2 million, and then we had, let's say, just $0.8 million here. Now in the current quarter, this number has gone up to 3 million. This number is 1.3, and this number is, let's say, 0.7 million or 0.9 million. And then you would be asked to evaluate, how the accounts receivable of the company is moving. Okay, in which direction the accounts receivable company is moving. In general, what you want to do is now there could be a theory question on this. Okay, it doesn't always have to be calculation. There could be an easy theory question, but what you want to do is this last bracket is what you want to be a little careful with, because these are the guys who are taking more time, to pay you, correct? And instead of looking at absolute amount, absolute is important, but more importantly, you want to look at percentage. So what you want to do is take a total of this. So my total is how much? 3 mils. And what's my total here? 4.3, 5.2. And then you want to convert them to percentage. Okay, so when you want to do analysis, convert them to percentage. So this would be 2 by 3. So we're looking at 67% here approximately. I made a mistake, 4. So this is 50%. This is 50%. This is 30%. This is 20%. Okay. Then here, 3 by 5.2, 3 divided by 5.2. So here I have 3 divided by 5.2. So I have about 58 percentage round figure. 1.3 divided by 5.2, I have about 25 percentage, and 0.9 divided by 5.2, I have about 17 percentage, right? And the way you want to analyze this, you want to say that, I mean, numbers don't matter. Don't worry about it. I know I did a boo-boo with that 4. Just look at the concept that even though in absolute term, this number is increasing, but in percentage term, actually my last quadrant value has fallen down, right? So it looks like the accounts receivable are getting a little bit of better. So that's how you want to think of your aging schedules. Okay, hopefully you're able to build intuition. Even this value is getting lower from 30% to 25%. So again, we have a little bit of improvement, and this value has gotten higher. So that's okay. So that's how you're going to read the accounts receivable aging schedules. You should be able to handle the theory questions well on this. And if you've understood this, then congratulations, your working capital is also over. There is a last thing that we have to do, which is called the sources of short-term funding. Now, sorry, my throat is giving early warning signs. Generally, like my natural limit is 5 consecutive hours. So it's going to be a little bit of challenge in the next few days. But it's going to be fun. So in short-term funding, there are the idea with this learning outcome, right, in the curriculum is they want to basically want you to know what are the different ways through which you can raise money for short-term working capital requirement. Okay, now you can get that short-term money through line of credit. Line of credit means you have an open line with bank through whom you can borrow. You can have a banker's acceptance, especially exports and import type of transaction. You could also have factoring, which is nothing but selling your accounts receivable. And then you can also do non-bank sources. Now here they have a little bit of calculations. If you look at my main videos, like some of you who have access, I have calculation coverage on this. If you're comfortable with those calculations, revise them. If you're comfortable with your calculations, revise them. Otherwise, just let them go. Okay. Otherwise, just let them go, because the learning curve is going to be a little flatter. It will take too much of time for you to learn those calculations now. So just let them go. Just learn this conceptually, what line of credit is and what banker's acceptance is. If I had to pick a question from this learning outcome, this would be my pick. That from a borrower's perspective, what do I prefer? Do I prefer a uncommitted line or a committed line or a revolving line? Okay. So what you want to remember is revolving lines of credit are generally longer terms, and they are the most reliable category of lines of credit. Okay, the revolving ones. Committed ones are also reasonably reliable, but the least reliable lines of credit are the ones which are uncommitted. Okay. So as a borrower, you are the working capital guy in your firm. When you're negotiating with the bank, what do you want to negotiate with them? You want to negotiate and try and see if you can get a revolving structure. If not, a committed for next 1 year, 2 year, 3 year, whatever. And if not, then you go with the uncommitted ones. Okay, so that's roughly how you want to think of this. Okay, so with this, cost of capital is also over. Are you comfortable with the working capital is also over? Are you comfortable with the speed? Yes, yes. The answer is yes. Okay, great. Uh, so I wanted to finish this reading on corporate governance, but I don't think we should probably take a break now and then we should do it. So yeah, yeah, I need a break. I agree. I don't want to rush through corporate governance. I think we will not do justice to that reading. I'm not going fast. I'm going to stick to the current speed. I think you would let's maintain average speed. So let's have a 25-minute break. I'm probably going to try and eat something like, yeah, get your lunch. Don't eat too heavy. Uh, don't eat don't eat don't eat too many carbs. Keep it light. Get a nice coffee for yourself. A 25-minute break, and after the break, I will start with corporate governance. We will finish it, and then we will start with financial reporting and analysis. All right. So I'm going to see you in 25 now. I'm going to put on the timer. You come back on the same link. बोलते थे कि टारगेट I'm ready when you are. Guys, are you there? What's happening? For some reason, my chat box is not updating. Let me check. Just how do I get the chat box here? So sorry, just a minute. I'm not able to access the chat box. Maybe. And my mobile phone. Can you guys post something on the chat box? It just seems to have disappeared. But I don't know how to bring it back. Strange. Now, if I don't see your chat box, I have no idea what you guys are saying. Maybe I'm missing something. Let me just check. I'm going to Google to see how to get it back. Live video. Strange. Just a minute. If anyone of you know how to, sorry, this is very stupid. I'm supposed to know it, but I don't know. If anyone of you knows how to get the chat box back, can you please WhatsApp me? Okay, how do I do it? Okay, I've already received a lot of WhatsApp. It's working now. Okay. So So maybe I'm going to disconnect. Yeah, refreshing. Okay. Yeah, it came back. It came back. Yeah. All right, that's cool. Why does it happen? Good, good, good. I can see the chat box now. Very nice. Okay. Thanks, Sakshi, Rakesh. Thank you very much. I appreciate. Yeah, it is back. Jai Mata Di. Let's rock. Milind, not juicy notes, juice notes, and no one is going to share them with you. You would have to buy them. Please don't call them juicy notes. Juice notes is such a nice name. Juice notes, please, not juicy notes. Will this be saved? Yes, for the 1000th time. It will be saved. The video will remain on YouTube. You can access it whenever you want. Yeah. Or Sakshi just take the screenshots. That will also work. But okay. All right, guys. Let's start. So let's get started. Next 20 minutes, intense concentration, and we get done with this reading. Okay. Number one, first thing, everyone, we are not going to underestimate corporate governance and ESG. We are not going to ignore. A lot of candidates do it. In fact, in the break, a few guys WhatsApp me saying, "Sir, isko chhod do." A few guys WhatsApp me that don't do corporate governance. But see, the thing is, you cannot really predict what is going to show up on the exam. It never makes sense to leave a reading. Yeah, if there are few learning outcomes which are very tough, it's okay to leave them, but do not leave out the entire reading as a whole. Okay, so request to you. In particular, like what I feel is CFA Institute has a lot of focus on areas like corporate governance. They have a lot of focus on ethics, those type of readings. So it makes sense to spend a little bit of time. Now, what is your strategy for corporate governance? So your strategy for corporate governance is, there are about 11 examples in the CFA curriculum. Okay, these are your blue boxes. Okay, and then we have, I think, about 10 or 11 end of the chapter questions in the CFA curriculum. So 11 examples and 10 end of the chapter questions, and that's it. Okay, so you do them well. My guess is, if the question shows up and if you've done those 20 odd questions from CFA curriculum, you'd feel comfortable. What I'm going to do here in the next 15 minutes is I'm going to take you through the important concepts here. All right, from this particular reading. So let's fire up our juice notes and let's start going through the important pieces. You'd be surprised to know, but there could be easy theory questions, even just on the definition of corporate governance. So let's look at that carefully once. It's a system of internal controls and procedures by which companies are managed. Now, internal control is essentially your system of checks and balances. Okay, just something that you want to remember this particular definition. Now, there are two ways of approaching corporate governance. One is you say, I'm going to do everything right. I'm going to do everything right just for the shareholders. So my focus is going to be only on shareholders. Versus, I'm going to do everything right for my shareholders, for my customers, for my suppliers, for my employees, for all the stakeholders. Right? This is a broader theory. Most of the modern day companies focus on this. So it's not that you want to extract value from your customers and only benefit your shareholders. You want every stakeholder to be a winner out of the process. So that's your stakeholder theory. There is a question on this. Okay, so there is a question on this. You want to know this part well. Now, who are the different stakeholders? On the chat box, can we stop all that unnecessary discussion? Can we focus on the reading, please, everyone? We have exams coming our way. Who are my different stakeholders in the company? We have shareholders, we have board of directors, managers, employees, creators, blah, blah, blah. Out of these, you can, what is a one-tier board and a two-tier board? So in a single tier board, you have executive, non-executive are sitting in a single group, right? They are part of a single board, single team. In a two-tier, non-executive board members, non-executive in a simple language means the ones who are not your employees, the ones who are not company's employees, right? In generally independent. So non-exec board members are above and the company's management execs are below. So you want to know this. You don't want to miss on this easy theory point. Now, of course, a two-tier is generally a better framework compared to one tier. What's happening in a two-tier? The first tier, like the bigger, the more powerful tier are the non-execs. And it's obvious, right? They're not getting they're not getting salary from the company. So they will take decisions which are right for the stakeholders. And then below them, we have the second tier of board holders, the board members, which are the execs of the company, the executives. So remember this two tier. Okay, easy theory question coming your way. Don't miss it. All right, taking you further. Conflict of interest. This whole thing, learning outcome C, for me, this is a high priority section. It's verbose. There are a lot of words, but I can just going to help you focus on some of the important points. If I just have to pick up the most important point here, I'm going to go with this. Creditors and shareholders, at times even bondholders here. Look at what this says. It says the shareholders will prefer more risk. Shareholders will prefer more risk than creditors. It's logical. When company takes more risk, shareholders earn more money, but creditors, they don't earn more money. Their amount is fixed, like a bondholder. He's going to get his face value. So a bondholder will prefer company takes less risk, whereas a shareholder will prefer that a company takes more risk. Okay, so this is something that you want to remember really well. Again, moving forward, just different types of infrastructures, legal, contractual. You guys look this up. There's nothing much to worry about here. Learning outcome E, different type of mechanism to manage the relationship. First thing is voting by proxy. What does it mean? I think if you're an engineering student from India, I'm sure you guys know what proxies are. You guys or someone else was doing attendance for you all your lives. That's a proxy. It's same thing applies. If company is holding a meeting, I am not able to attend that myself. I can proxy someone else to attend on behalf of me. Okay, so that's your allowing voting by proxy, assigning one's right to vote to another. Someone else can do it for you. Now, in colleges, it was not allowed, but you still did it. In companies, it is allowed, but very few retail shareholders actually assign proxies for them. But in the US, the activism is a little more than this. Then two types of resolution, ordinary and special. Uh, Simple language, resolution is a mechanism through which companies take decision. Uh, if they're taking, usual decision, something in the ordinary course of business, it would be an ordinary resolution. But if they're deciding on something important, something which is going to change the course of how the business is run, then they go with special resolution. Typically, 2/3 of the voting or 3/4 of the total votes. Then majority voting and cumulative voting. This part is again important. Uh, Especially cumulative voting, I want you to look at this part. I know it's theory and I know it's not as sexy as doing numbers that we were doing earlier, but in fact these questions are more challenging on the exam than the other ones. Okay, so we want to be alert with this. Now, uh, how to think about this, right? So let me write a little bit here for you. So imagine, and I'm going to try and simplify this for you. Imagine we have 10 voters in a particular situation, and they have to take a few decisions. Now, 6 of them are basically one group, or let's say 7 of them, let's say 6 of them are one group. This is the management group, and let's say 4 of them are minority guys, they're small shareholders. Okay, now they bring in the first candidate. Let's say bring in the first candidate, let's say candidate A and candidate B. Now minority people will like to recruit candidate B, but the management will like to recruit candidate A. Who do you think is going to win here? Do you think the first group will win or second group will win? They have 6 votes, they have 4 votes. Who do you think is going to win? Of course it's going to be the first group, right? Why? Because they will have 6 votes. And imagine the next candidates, let's say between C and D, maybe again the same story. And what will happen is, in this type of mechanism, the management will always keep on recruiting the people they want, and these minority guys will end up having no representation on the board. Correct? The minority people, the small shareholder, people like you and me who have smaller representation in the company, they will not have any say whatsoever. So what is the solution? This is called the majority voting. Okay, so what is the solution to this problem? Cumulative voting. Okay, what happens in a cumulative voting? Minority shareholders have 4 votes. They will say, we don't want to vote, you choose whatever you want, let us save our 4 votes. Then the next decision, let us save 4 more votes, let's not vote on them. And then you save your votes, you accumulate them, you accumulate them, and then you use all your votes to recruit the people you want towards the end. Okay, and again, this is a little bit of exaggeration, but this is referred to as cumulative voting, where you accumulate your votes and use them later on. Okay, now what's important here is what is written in the juice notes in this box. Let's read this carefully. Shareholders can cast all their votes to one single board candidate or divide them among others. So which means shareholders are getting multiple votes. One shareholder will get probably 5 votes because there are 5 decisions. This can result in greater, look at this can result in greater minority shareholder representation. That means a smaller shareholder will get better representation with cumulative voting. I hope you've absorbed the concept. I'm moving on further. Now again, both tiers, we discussed a single tier board or a 2-tier board. 2-tier boards are generally a little bit better. Why? Because you have a supervisory board, which is not employees, and then you have a management board below that. Staggered board. What does staggered board mean? So a staggered board works a little bit like this way. Let's say you have board members, you have a board of directors of 10 people. Okay, you put a condition in your memorandum or in your article or in your charter. You say that in any year, only a maximum of only 4 people can be replaced. Okay, now what is the implication of this condition? That in a year, if you can replace only 4, any acquirer who acquires your company he will have to wait for 2 years to get his 8 people on the board. You need a minimum of 6, right, to control the company. You want more than 50%. So the company will be able to replace only 4 in the first year and then 4 more in the second year. So it's some sort of an anti-hostile takeover mechanism. This is referred to as having a staggered board. All right, then board responsibilities. Read through this stuff in terms of what board does, what board doesn't. We have different type of committees. Each committee will have their own set of responsibilities within the board: audit, governance, nominations, and blah blah blah. Now, few terms. Number one, activist shareholder. Um, we all know that, like, some of the famous popular examples. My favorite example here is, and those of you who've been doing sessions with me would probably know. Uh, so I might have shown you his website in the past. So this is the Carl Icahn's website. He is one of the active shareholder. And what this gentleman would basically do is buy shares in the companies, and then he would basically force companies to take certain set of actions which will unlock the value, right? So in one of the previous classes, I think we were reading this open letter to HP shareholders about the potential merger of your Xerox and HP, like the cost synergies that he was talking about in this letter. So who are these guys, right? Who are activist shareholders? These are the guys who would probably buy a small stake in the company, but they will try to unlock the value by forcing the company to take certain set of actions, right? Forcing the company to either certain set of actions could be either to shut down a particular business division, okay, or to hive off, like to spin off a particular business division, or fire certain employees, or get rid of CEOs, right? So these are the guys who will appeal to other shareholders, request them, can you please allow me to vote on behalf of you, proxies, and let's force the management to take certain set of actions. These are the guys called activist shareholder. Okay, then risk of poor corporate governance and benefit of effective corporate governance. Boring to read, but potentially testable. I'm going to highlight the most important 2 points with you. So if you're looking at a company with weak governance and managements are not motivated, they will choose lower than optimal risk, reducing company's value. For me, one of the example in India is this company called ITC, Indian Tobacco Company. Originally tobacco business, which is a boring business, growing at industry is growing at 2-3%, no growth, right? But a cash generating business. And what management has done in the last 2-3 decades is, they've taken that cash, right? They've taken that cash and deployed into some of the they've taken that cash and they've deployed into uh, some of the really stupid business, like hotels and businesses which did not make any sense whatsoever. So that could be an example of a weak corporate governance, management not thinking in the best interest of the shareholders. If there is a poor compliance, you'd be surprised to know a lot of companies in India, especially the smaller companies, they don't even do basic compliances with exchanges. So poor compliance with respect to regulation can lead to legal and reputational risk. We have thousands of examples in this category. So this whole corporate governance thing has become very important, and as an investor you want to be very careful of what are the practices with the company. Now just to help you remember something, there is a I cannot take the name, but there is an IT company based out of Pune. Okay, Pune is their Pune is the city where I live in. These guys do softwares for automobile segment. Okay, and I'll tell you who their competitor is. Their competitor is Tata Elxsi in some way. Tata Elxsi is another Indian IT company. Now, in my group, some of the analysts and some of the fund managers, they've been consistently telling me that you start looking at this company. It is going to post great numbers, it is going to make money for shareholders. But this particular company has a bad reputation because of the things that they've done in the past, especially the promoters. So because of that, and just because of that, a lot of people like me are staying away from the company, even if they're doing now. Like now they're okay compared to what they used to be in the past. But then you always have that fear, right? You always have that fear that maybe the management is hiding something from you. So from a corporate governance perspective, important to look at all those things. All right. Uh, Dual class structure, important. Dual class structure of voting, very important. What does it mean? Let's do an example. I think Lyft was the last one that I checked, but we have plenty of them. I think Dell is one of them. I'll tell you what happens with these. This is very popular in the US. Not so picked up in India yet. But let's say I am a promoter. Okay, I am a promoter. Let's assume I have 100 shares right now. Now, what I want is, I want to come up with an IPO. Okay, and I want this retail investors and these investors to give me money, and in return I'm going to give them shares. Okay, so I want to get money. In return, I'm going to give them shares, right? Let's say I'll give them 75% shares. So 75 shares. Now these guys own 75 shares. I will own 25 shares. If I have to take a decision, because I have only 25 shares, I will not be able to I will not be able to overpower these guys. What I want, and this is very interesting, what I want is, I want best of both worlds. I want to get money from them. I want these people to become owners, but I still want to be able to take my own decisions. I still want to be able to decide this for myself, decide company's action for myself. So what I would simply do is, and it gets very interesting, listen to this. I will create dual class structure. The shares that these guys get, let's call them class B, and the shares which are left with me. Okay, then this is a exaggerated or simplified example, but let's say this is class A. And then what I'll tell myself is, or what I will do in the charter is, I will say one share that I hold is equal to 4 votes. The shares that I have will have higher votes compared to shares that these guys have. And the moment I do that, everything else is same. These guys still own 75%. I still own 25%. I've got the money. But as far as voting is concerned, my shares will have a better voting rights compared to the shares of these investors. And what that allows me to do is, it allows me to have better control on my company. Okay, so this is referred to as the dual class structure. Potential theory question here. You're going to try and remember this. One class of shares may be entitled for several votes per share. Now, your curriculum has written this, and I doubt if that's true anymore. But since it's in the curriculum, we're going to kind of read through this. On average, companies with dual class share structure have traded at a discount compared to companies with single class shares. Okay, so in general, what this is saying is that markets don't appreciate these type of dual class structures. Generally, very popular with tech companies. All right, then jumping on to ESG, uh, environment and social consideration. Like, you want to look at companies which are, taking care of in general environment and social stuff. Now, you have two type of things playing out here. You have something called as a negative screen, right? Negative screen is, these are the companies I will not do. Negative means outside, like I've filtered them out, right? So I'll not do mining, I'll not do oil. Probably you would not do chemicals, right? All these companies which are pollutants, these are the companies you don't want to do. What would be a positive screening? This is also called best in class investing, by the way. Another word in your curriculum, best in class investing. Nothing but positive screening. You would say, these are the companies I want to do. This company is carbon neutral. This company is taking care of the pollution it is causing. It is planting more trees, or whatever it is. So because this company is good for the environment, good from a social perspective, I want to invest in these companies. So that's called positive screening. Impact investing, thematic, again, same stuff. Impact is you want to achieve something out of your investment process, and you're playing on some sort of a theme. So that's your thematic investing. Very interesting example. I heard sometime back, just as a small story. It will be fun to listen to it. There is this strange thing called rhino bonds. Okay, I don't know how many of you've heard of it. So I heard of it a few months ago. I was listening to a podcast when I came across these rhino bonds. So apparently, what happens is in certain parts of the Africa, the population of of the rhinos was decreasing very rapidly because of this illegal hunting, for rhino skin and whatever body parts which are valuable. So what these government organizations were doing, right, or these social organizations were doing, they were going to the government asking them for some sort of a fund, asking them for some sort of a fund, and they were using that money to protect the rhinos, but the money was not sufficient. So some genius guy came up with an idea. You know, what that guy did is he went to the super rich people in the West. He told them, "I'm selling these rhino bonds. You guys give me money today. I will go to the government. I'll tell them I'm trying to protect the rhinos. You pay me. Government will pay me money if I'm able to achieve results." Okay, and then he took money from super rich investors, tried working with those rhinos for a few years, and once the result was achieved, he went to the government. He said, "See, this is what I've been trying to do, or I have been able to achieve. Now government pays to this guy, and he takes that money and pays to the super rich people back." Right, so that structure was called a rhino bond. And of course, most of the investors who would invest into product like this, they're not doing it because they want to make money. A lot of them are actually trying to you know do impact investing. They want to make a little bit of profit, but their primary focus is have positive impact on the environment. Okay, so again, uh, what do I recommend you to do this? If you have studied this reading before, your life is easy. But let's assume that there is someone who's doing it for the first time. What do you need to do? Two things. First, after the session today, at the end of the day, go to the CFA curriculum. We have end of the chapter questions in the curriculum, and then we have blue boxes. Blue boxes means those examples. In total, we are looking at about 21, 22 odd questions. Okay, somewhere in ballpark in that range. Please, please go through them carefully. Okay, once you do those 22 questions, I think you'll start feeling very comfortable. Okay, then you would be able to answer most of the questions. And if you make a mistake there, right, in solving one of them, that means you don't understand that concept. Then go and read only that part of the curriculum or juice notes or whatever books you're referring to. That should do the job for you. And finally, with this, our corporate finance is over. uh, Took us about an hour more than what I was originally planned for, but it's okay, we did this well. These are the 5 readings that we worked on, and I hope you are comfortable with corporate finance now. What next? What do we do next? Break again? 1 year break of 1 year break? Uh, Shilpa, just Google that concept. It's pretty easy. Just read through the curriculum. Okay. All right. Let's take a 5-minute break, and then we'll start with FRA. FRA. Here's my strategy. No break now. Okay. Fair enough. Break cancel. Break cancel. FRA. Listen to my strategy carefully. It's a large subject, right? We have massive size in terms of number of readings. But I'll tell you how to optimize your time when you are. All right, got it. You guys got emotional with break. So, how to optimize your time on FRA? I'll give you a strategy that almost always works. The core of your FRA lies in these readings. Okay, these are the readings where the core of the crux of the subject matter lies. And on an average, what I would say is that in every reading, there are just 3 to 4 large concepts. So even though it looks like FRA is so big, but the heart of the subject, right? So how many readings are these? 1, 2, 3, 4, 5, 6, 7, 8. Even this is not a legitimate reading. It's just nonsense list of formulas. Okay, which anyways you learn if you're which anyways you're going to learn. So 1, 2, 3. They got excited with FRA. 4, 5, 6, 7. 7 readings into, let's say, 4 large concepts per reading on an average. You're looking at 28 key concepts. Okay, 28 uh, key concepts, and then everything else around it is manageable. Okay, it's small factoids. So from a learning perspective, if I can get hold of these 4 or 5 key concepts per reading, and then I go with other areas, then it becomes a little easier for me. Okay, and that's how I'm going to do it for you today. What I'm going to do is I'm directly going to attack onto the heart. I'm directly going to jump on to the key concepts of every reading. I show you this is what is important. This is how you do it. And once we've done the key areas, then we will go and start doing other learning outcomes. Okay, that's roughly the game plan. Now, my guess is I will take about 5 hours to do the whole of FRA. So I had originally scheduled to finish by 6 p.m. India time, like 3 more hours from now, but it's going to take time. Okay, and I don't care how much time it takes, and you should not care as well. Our job is to make sure that we finish this well. Our job is to make sure that we finish this in a very comfortable fashion. Okay, so that by the end of the day, you know that I'm done with this subject. Now, let us get started with understanding income statement right away. I'm going to keep on using the same PDF. This PDF would be available to you at the end of the day in the video description. Income statement. All right, so let's jump on to the heart of the matter. EPS. That's like the main calculation here, right? EPS. Who said that? Amit. Thank you for the idea. You're right. I should have saved it earlier. I'm saving it now. EPS, two varieties here. We do some basic EPS calculations, and then we do some diluted EPS calculations. I'm going to set up two big questions, okay? But two big comprehensive questions. First on BPS, second on DPS. And once we go through them, I think you'd start feeling very comfortable with the whole EPS business. Now, on the exam, you will not get such large comprehensive questions. You'd get a tiny subpart of it. But if you know how to do these two questions, more or less your EPS is well taken care of. Okay, so let's get started. The first question now. Let us say we're looking at a company. So first example on BPS. BPS stands for basic EPS. Let us say we're looking at a company which has a profit after tax of 200,000. Now, this company had, let's make a schedule for it. Let's assume a calendar year and financial year as 1st January to 31st December. Okay, so that's the year that we're going to assume. So date, action, and quantity. Now, on 1st of January, the common shares which are outstanding with the company are 10,000. On 1st of January, no, in fact, not here. On 18th of January, they decided to do a split. Okay, they decided to do a split. And what kind of split? One share into two. On 18th of January, they did a split, one share into two shares. Then on 1st of April, it's a new issue of preference shares. I'm putting in a lot of trick because I want to cover all the concepts in one example. So new issue of preference shares. What are the details? What quantity? Let's say a quantity of 1,000, face value of 100, and preference dividend rate 12,000. Preference dividend rate. So, okay, let me add one more zero to it. Quantity 10,000, face value 100, preference dividend rate 12%. On 1st of July, again we have new issue. Of common shares. How much? Let's say 5,000 shares. On 17th of September, we have a bonus issue. Of 70%. Okay, I'm going to make this complicated. I told you. On 1st of October, we have a buyback of 10,000 shares. All right, now based on this information, I want you to calculate basic EPS of the firm. This question could be broken down into potential 4 or 5 multiple choice questions. Okay, but let's see if you can handle this. I'll give you a couple of minutes, otherwise then I'll do it myself. Okay, I want you to pick up some speed. Those of you who might have studied this with me in the past, I give you a super cool multiplier technique to simplify this for us. If you use that, you're going to find this very easy. And even otherwise, if you studied, it's not such a difficult question if you know how to think about it. Get started. Your font is very small. It's just that I've written that. So you remember profit after tax of 200,000. So I'll try and increase this a little bit as much as I can. Yeah, that's the best I can do here. Anurag, a quick answer to your question is because they don't get us money. There's no money involved, right? We don't get any cash. That's a super quick answer to your question. But it requires a very deeper conceptual thinking. Come on, guys, I'm waiting for you. PAT is profit after tax. Cable, that's an impressive question. Oh, you mean what is the amount? I'm so sorry. Amount is 200,000. Amount is 200,000 profit after tax. All right. I'm going to do this now. I want you to stop doing what you're doing and just focus on this carefully. As I said, one question, but potential 4 or 5 MCQs out of this. So let's see how to deal with something like this on the exams. Okay, so let's build a nice, pretty table here. So we'll have dates. Okay, now I want you to look at the screen carefully. Once you understand this, you do it easily on the exam, especially with the trick that I'm showing you now. So first date. So the first thing that's happening on 1st of January, we've 10,000 shares. So let's write that down. 1st of January, we have 10,000 common shares. Okay, common shares. Now, whatever I write in this table, that is only anyways is going to be for common shares. I'm not going to write preference shares here. So 10,000 common shares, 1st of January. Then on 18th, we have a split. Okay, on 18th, we have a split. So you're doing 1 into 2. One share you're splitting into 2. Then on 1st of April, preference shares, I'm not writing that here. On 1st of July, we have a new issue of 5,000. On 1st of July, we have a new issue of 5,000. Then on 17th of September, we have 70% bonus. 17th of September, we have a 70% bonus. Okay, I'm just writing it down sequentially. Of course, on the exam, you don't have to write it so well. But I'm just doing it so that when you revise, it's a little easier. 1st of October, buyback 10,000. 1st of October, buyback 10,000. Okay. Let me write down somewhere. It's a buyback. It's a buyback. Now here's the magic trick. Okay, a trick will never fail you. The first thing that you do when something like this comes on the exam is just multiply them with the time outstanding. Everyone, don't do anything. Look at my screen carefully, please, so that you don't miss on those small tricks. So what is the time outstanding? January to December, 12 months. So we'll do 12 divided by 12. July to, see, I didn't do anything to split just yet. Just yet. July, how many months? So from July till December, we're looking at 6 months. So 6 by 12. Bonus, I'm not doing anything. Okay, bonus I'm keeping on hold. Buyback, first trick. Buyback, do it the same way, just make the number negative. Okay, but do it the same way. So buyback 10,000 happened on 1st of October, November, December, 3 months. So into 3 by 12. So this was my step number 1. 12 by 12, 6 by 12, 3 by 12. This is out of our way. What next now? Next is we start dealing with these split. So the split that happens on 18th of January, okay, for this, everything that happens above this in the timeline, I hope you're listening to me. Everything that happens above the 18th of January, I'm going to have a multiplier of M1. So here there is only one corporate action happening. So I'm going to have a M1 multiplier for that. Then for bonus, which is happening on 17th of September, all the corporate action which is happening above that, I'm going to have a multiplier of M2. Everything above that. So what is happening above that? I have a M2 here, and I'm going to have a M2 here, a multiplier 2. Okay, it's that simple. That for bonus and for split, I just multiplied them with M1 and M2. Now, the question is, How do you get your multipliers? How do you get your M1? How do you get your M2? Here's your technique. Your technique is going to be, M1 or any multiplier. The simple formula is going to be number of shares in your portfolio after divided by number of shares before. It's that easy. Number of shares after, number of shares before. For example, what do you think would be my M1 here? What do you think would be my M1 here? Before split, I had 1 share. After split, I will have how many shares? Come on, help me with this. After split, I will have how many shares? 2. So my multiplier is 2. Right? After divided by before. Now, what would be my multiplier for 70% bonus? Okay, what would be my multiplier with 70% bonus? If I have 1 share, okay, and if I get 70% bonus, how many shares do you think I'll have now? If I have 1 share and I get 70% bonus, what do you think how many shares I will have? Then I will have 1.7 shares, right? So 1.7 shares. So this is my multiplier 2, and of course this is 1.7 with the same logic, and that's it. It's that simple. Number of shares after divided by number of shares before. Okay. Now let's do the math. You guys help me out. Okay, let's do the math here. You guys please help me out with this. So let's see what we get here. 10,000 into 2 into 1.7. 34,000. 5,000 into 6 by 12 into 1.7. 5,000 into, let me also fire up my calculator parallelly. 5,000 into 0.5 into 1.7 is 4250. 4250. Then look at this. There's no multiplier here, right? And there should not be, because all the corporate actions happen above this. So this would be a negative. This would be a negative 2,500. And there you go. Job done. So easy, right? So easy. Job done. 34,000 minus 4250 minus 2,500. So 34,000. Help me out with this. Plus 4250 minus 2,500. And I'm getting 35750. That is going to be my denominator of this calculation. Okay, I hope you've understood this. Now let's work on the numerator of the formula. Now I had installed one trick there also. What is the formula for BEPS? The formula for BEPS is profit available for common shareholders. Common means your equity shareholders. Profit available for common shareholders divided by weighted average number of common shares outstanding during the year. Sorry, I don't have the patience to type this. Write this. Weighted average number of common shares outstanding during the year. Good news is this WANCSODTY, whatever that thing is, we've already done it. It is 35,750. 35,750. What is going to be my numerator? Numerator is going to be profit after tax minus the preference dividend. Okay, because we have to pay preference shareholders first. Profit after tax is given as 200,000. This is 35,750. How do you get preference dividend? Look at this carefully. How many preference shares did we issue here? Here, the number of preference shares issued were 10,000. Okay, so we had 10,000 preference shares multiplied with. What was the face value? 100. What was the dividend rate? 12. So face value 100, face value 100, and preference dividend rate 12 percentage. And I think that's it, right? I think that's it. So preference dividend rate 12 percentage. Maybe this is what I should do. So this should get me what, 120,000. That's it. Am I missing something here? Am I missing something here? Maybe I'm missing a trick, right? Maybe that trick is very popular on the exam. Maybe you would have to do the same trick a few days from now when you're in the Prometric Center. What is that trick? The trick is you have to adjust for the time period of the issuance. You did not issue these preference shares at the beginning of the year. You issued these preference shares on 1st of April. So why would you pay them dividend for the whole year, right? When you've issued them in the middle of the year, you pay them only for 9 months from 1st of April, for the 1st of April to the December. So which means you have to do 9 by 12, the time period adjustment, correct? And then 120,000, the time period adjustment. My guess, this number would be 90. Please help me if I make a mistake here. So that will be 110,000 divided by 35750. I'm getting an answer of 3.078. So I'm going to round it off to 3.08. And there you go. That's your answer. Now, those of you who got this right, give me a large yo-yo on the box. Because if you did this, I'm proud of you. You've really mastered the whole EPS calculation business and you got this right spot on. Good job. Good job. So you're doing this comprehensively. You've really figured out how to deal with this stuff. Very nice. And I hope you've understood this. I hope you've understood this. The whole EPS, how many stars for it? 5-star. Good. My guess is there will be at least one question on the EPS. Okay, that's what my guess is. There will probably be at least one question from this EPS. So you have to do this. See, Vinay, on the exam, the whole thing will not come. Some sub part of it will come. Okay, the whole thing is not going to be tested. A very small fraction of it will be tested on the exam. If you know how to do this, I think you should be able to handle it within the time period. This is the shortcut. There is no other way. This is the fastest way to do these questions. All right. I hope even those people who did not know how to do this earlier, but at least now you feel comfortable. Is that a fair assumption? Can you guys give me a yes? Especially those people who did not know how to do it earlier, but if you're feeling comfortable with this now, you'd get this PDF later on, download it, read through it carefully, make sure you understand, practice a few questions, you'll be done with it. Let's jump on to a larger question now. Good. I'm not giving you a lot of breathing space, one after another. Next one is going to be diluted EPS. This one is really challenging. Okay, this one is challenging, but I'm going to give you tricks and we're going to try and make this easy for you. Now, Uh, Now what we will do is we will set up a large question, okay, and in one question we will try and do all the three subparts of it. So we will do all the three subcomponents of it. So let us say we have a pact of 500,000. With number of convertible preference shares outstanding, let's say is 1000. Before that, I'll have to do number of common shares. Number of common shares 10,000. Face value of these convertible preference shares is 100. Preference dividend rate is 12%. Tax rate 20%. Number of convertible bonds outstanding 1000. Face value 100. Interest rate 18%. Number of ESOPs outstanding, I'm sorry, I'm loading up all in one go. Number of ESOPs outstanding 10,000. I'm also putting in some tricks here, common tricks on the exam, the tricks that the question writers love. Closing market price, let's say is 120. Average market price is 100. Exercise price is 60. Okay. Now, based on this information, what you need to do is calculate just two easy and sweet numbers for me: BEPS and DEPS. Don't give up halfway. I'm telling you, actual exam isn't as difficult. Okay, what we're doing is we are operating at a higher level. If you guys can do this, you're going to get through the exam questions just like that. Okay, so I want you to focus. Even if you don't know this, you can learn on the go. Let's say there's someone who's not done this before. That's fine. Try to learn as much as you can. It's on your screen. The tax rate is same, Nimisha. Generally, the question will give you tax rate only once. It doesn't vary based on the product. Get started, guys. Drupal, warrants and ESOPs work the same way, so we don't have to have warrants. All conversion ratio, assume 1:1. Conversion ratio, assume 1:1. Conversion ratio is 1:1. Do BEPS, do diluted EPS. Now I'll wait for about 3-4 minutes. Then I will try and do this myself. Let me write down conversion ratio for both 1:1. Same for both the places. Some people are on steroids here. Akshay has already got diluted EPS. How are you doing it, sir? Ganesh has got the answer as well. Wow, that's impressive. Someone is asking for schedule of the videos. I'll recommend you go and look up the introductory video I did a few days ago. It has all the information. Or the first 20-30 minutes of this video will also explain. Thank you for that, Akshay. But you still have to tell us the truth. What are you drinking? Pallavi, that's impressive. Very fast. Rakesh, Bhageshri, 8902, Anand Singh. Good job, Ujwal, Shashwat Desai. Come on, pick up some speed, please. You have maximum 1 more minute. Otherwise, I'm going to do this. All right, we've got answer from Neeraj, Abhishek, Nandini. All right, I'm going to solve this now. Jazz, you're way too early for this. Bookmark the video, save the link, come back a few months down the line. Even better, subscribe to the channel. I'm going to solve this, guys. First, I'm going to work on the BEPS. Okay. Now, what I want to do is I want you to stop doing what you're doing. Okay. Just don't do it. Just sit back and relax and see how I'm doing it. Okay. Again, there are a lot of small tricks. I don't want you to miss them. But once you see this, and then, of course, you can go and practice yourself. I'm going to work with the BEPS first. And that's how I want you to do it. Okay. BEPS. Number of common shares go in the denominator. Number of common shares are 10,000. So number of common shares 10,000. Profit 500,000. Profit 500,000. That's it. 500,000 divided by 10,000. That's it. That's it. No. We have to deduct the preference dividend as well. Even if they're convertible, doesn't matter. For basic EPS, we have to deduct the preference dividend. Don't miss that on the exam. Okay. Now, how am I going to calculate the dividend? How is my dividend calculation is going to work? So let's look at that. I have 1,000 preference shares, face value 100, 12. I have 1,000 preference shares. I have 1,000 preference shares. These are the quantity. So let's just write down quantity here. Face value is 100. And the rate, the preference dividend rate is 12%. These are for one whole year. So this is going to be 12,000. And then let's see how much we get. 500,000 minus 12,000 divided by 10,000. How much is this? 500 minus 12 divided by 10. So we're looking at 48.8. Is that the correct answer? 48.8. Am I doing this right? Is this the correct answer? 48.8. Is my calculation okay? So 48.8 was your first answer, basic EPS. Okay. Now, there is one step which I think you would not be required to do on the exam, but you have to do this if you want to solve question like this. And that step is to test whether the security is really dilutive. Okay, so there's a test that you need to do. On the exam, I don't think you'd be required to do this. But here, in order to make sure that I'm doing this right for you, I will have to do that test for each of the item. So I'll tell you an easy test, okay? Right now, how you want to compare is you want to think from the shoe of equity shareholder and the bondholder, equity shareholder and the bondholder, and you have to think of an employee. This is a test. This is a test that you need to do. Okay. I'm kind of trying to simplify this for you, but this is an equity guy, a common share guy. Okay. And this is let's say a preference shares guy. Now, because conversion ratio is 1:1, this is a little easier. Per share, this guy is getting how much? This guy is right now getting how much? 48.8. Per share is getting 48.8. And this person is getting per share how much right now? Per share he's getting, look at this, 100 into 12 percentage. Per share he's getting 12. Now ask yourself, okay, will he convert himself? He's getting 12, whereas the common guy is getting 48.8. Do you think the 12 guy wants to go to 48.8? Yes, of course, right? So when the answer is yes, we say that the security is dilutive. You have to do that test. It's necessary to figure out whether the security is dilutive or not. So in this case, we will say yes, the security is dilutive. You want to do the same test. For the here equity, and this is a bondholder. Okay. So again, this guy, how much is he getting per share? Per share is getting 48.8. How much he's getting per bond, which is equivalent. So per bond, how much is he getting? per bond he's getting, let's see how much, 100 into 18 percentage, right? 100 into 18 percentage. So 100 into 18 percentage, but on an after tax basis, you have to do this for bondholder on an after tax basis. So you also have to multiply that with 1 minus 20%. Now it doesn't matter in this example, but it's important that we do it right. Okay, so 100 into 18% into 0.8 equal to, so you're looking at 14.4. And then you say, okay, this guy is getting 48, this guy is getting 14.4. Will he convert? Will he convert? Yes, of course he will convert, right? So these are dilutive as well. Okay, so these are also dilutive. Now this was for convertible preference shares. This was for convertible bonds. And let's quickly look at ESOPs. Now in ESOPs, okay, I want you to remember this. Please listen to me carefully. In ESOPs, there is a good chance on the exam, okay, on the exam, they will give you this thing called closing market price. Okay. Ignore it. It's always a trap. Closing market price is always a trap. So don't use closing market price. What are you going to use? Average market price. You're going to use average market price. So employee has exercise price of 60, average market price of 100. Okay, you ask, will he exercise? Will he exercise? This is a dilution test. Will he exercise? The answer is yes. So then again, this is dilutive. Okay. So luckily for us in this example, because I set it that way, all the three items are dilutive, which means even if I wouldn't have done this step, I would have still got the same answer. All the three securities are dilutive. So now let us do the final calculation. Let us do the final calculation. It's a lot of fun. If you know, like once you practice 2 or 3 questions, you start enjoying it. So let's do the final set of calculation now, which is going to be diluted EPS. Okay, look at the technique. Look at how I think. I promise you, you would find it very easy once you learn to think this way. This is actually very easy once you figure out how to think about it. So what I recommend is, and I hope you're listening to the every word that I'm saying now, because this is the trick. To calculate DEPS, what I do is I start with formula of BEPS. To calculate DEPS, I start with the formula of BEPS. So what is my BEPS formula here? 500,000 minus 12,000 divided by 10,000, right? So 500,000 minus 12,000 divided by, wait a minute guys, my battery. $500,000 minus 12,000 divided by 10,000. This is my current status. Now what I'll do is I'll start treating these items one by one. Okay. So first I'm going to ask myself, what if the preference shares are converted? Then what happens? What if the preference shares are converted? Then what happens? Okay. So how are we going to do this? Then if preference shares are converted, do I still have to pay this preference dividend? If preference shares are converted, uh, do I still have to pay this? No. So this will not be deducted in the numerator. See, in your book, it says, in your book, it says add 12,000, that becomes a little confusing. What I recommend is I'll say that do not deduct this 12,000. Okay. And here, add the number of shares that you would convert, 1,000. So this is your treatment for convertible preference shares. This is your treatment for convertible preference shares. I hope you're comfortable. Now let's do bonds. Now for bonds, if I convert bonds, 1,000 bonds would be converted to equity share. So plus 1,000 in the denominator. And I don't have to pay interest anymore. So my profit will go up by that much. So how to calculate that profit? Let me show it to you. We had 1,000 bonds, right? Into 100 face value, into 18% interest rate, into tax adjustment 1 minus 20%, because if I'm not paying interest, there would be incremental taxes that needs to be paid. So my net profit will increase by this amount. All right. I hope you're understanding this. I know it's becoming a little complicated, but I'm telling you on the exam, it's not going to be so difficult. It's going to be a sub part of it. So if you're listening to this carefully, you will be able to answer those questions. 1,000 into 100 into 18 percentage into 0.8. So we're looking at 14,400 here in the numerator. And this is my treatment for the bonds. And finally, for ESOPs, I just need to add in the denominator. Okay, for ESOPs, I just need to add in the denominator. So what number will I add in the denominator? Here is the technique. Here's a technique. The formula is, and it's a simplified formula. It's a shortcut formula. You don't have to do that treasury stock method. I'm going to give you a shortcut. Number of ESOPs, okay, multiplied with benefit to employee, because ESOPs you're issuing to the employees, right? So benefit to employee divided by average price. Now, how many ESOPs have we issued? So number of ESOPs that we've issued is 10,000. Number of ESOPs that we've issued is 10,000. What is the average price? 100. We are offering to employee what price? 60. So what benefit are we giving him? 40. So what is the total benefit? What is the number coming out? 4,000. So this 4,000 I'm going to write down here and done. That's it. And then we do the final calculation. I know some of you are little on the edge now. You're finding this difficult. Don't worry, I'll explain this one more time. 500,000 plus 14,400 divided by 11, 12, 16, 16,000. And let's see what answer we get here. I'm getting an answer of 32.15. That is my answer. Now, let's do a super quick poll. Those of you who have completely understood this, can you give me a yo-yo on the box? Those of you who have understood what I went through the whole process, can you give me a yo-yo on the box, please? And those of you who feel, I don't understand what's happening here, give me a no. Let's just understand where people are. This part is important. I want to spend time on this. Be honest about it. There's no shame in it. If you feel you don't understand, give me a no. That's fine. Wow, that's impressive. That's really impressive. Very good. All right. Let me kind of take you through this once super quick. See, a lot of people are asking me, why are we not adding back 12,000? That's because, I'm telling you, don't remember a formula, try and do it with logic. Okay. So see, this black color thing was my original formula, right? This much you agree. 500,000 minus 12,000 divided by 10,000. That was my original formula. Now, you have to run a what if scenario. See, this conversion is not happening in real life. Okay. This is basically, we are running a what if scenario. Diluted EPS is all about telling our shareholders, what if the conversion happens? If conversion happens, do we have to deduct 12,000? No. So we're not deducting 12,000 anymore. Now, what your book says is, your book says like this. Your book says take 488,000. The curriculum says take 488,000 and add 12,000. Isn't that the same thing as 500,000? It's the same thing, right? So the idea is that we take 488,000. Okay. We take 488,000 plus 12,000. Instead of that, I'm simply saying do not deduct 12,000 from 500,000. So hopefully that will kind of solve the query for you. Okay. In terms of why are we not adding back that 12,000? Now, denominator is very simple. Denominator, there is nothing new here. 10,000, 1,000, 1,000. This is a very, very sleek, cool technique. The number of ESOPs into benefit to employee divided by average price. So you get that 4,000 here. You add that here in the denominator. Denominator is straightforward. Preference dividend, we don't deduct. Interest, we add back because we don't have to pay it anymore, but we make sure we take care of taxes. We don't do taxes with preference dividend because they're not tax deductible. That's it. So this is how you're supposed to solve this. Now, I hope you've understood this. And if you have, then more or less, the complicated calculations of income statement is over. Okay, now let's go and do some smaller concepts. Are you ready to do smaller concepts? Should we go to the learning outcomes and start answering them? It will take me another 20-25 minutes, but I want to do this right. I want to make sure that you guys are comfortable with it. Let's jump on to the juice notes. Income statement, it's page number 44 of your juice notes. I'll give you a break once I finish this reading. Will that be okay? I'll give you a break once I finish this reading. But let's finish this now. Let's not kind of stop it halfway. So, income statement format. You would be amazed to know, but when there can be some really easy questions, like just giveaways on the exam. Okay, they do that. Like some of the really easy questions might show up on the exam. So 20 minutes, 100% focus. Okay, let's make sure that we get through these smaller concepts as well. What is the format of my income statement? Sales minus COGS, you get gross profit, minus selling, general and administrative expenses, you get EBITDAs, earning before interest, tax, depreciation. Minus depreciation, you get EBITs. EBIT is your operating profit. Minus interest, you get EBIT. Taxes, you get PAT or EAT. So that's your overall format. Now, this thing is important. Your expense classification. Some of the expenses, you generally classify them based on nature. Some expenses, you classify them based on function. Okay, for example, if I tell you COGS, that's manufacturing activity. It is function. If I tell you selling, general and administrative expenses, it's a function. But if I tell you depreciation, it's not assigned to a particular activity. We can have depreciation on the manufacturing factory, but there could also be depreciation on your office furniture, marketing furniture. So depreciation is classification based on nature. So just know the difference. Easy technique to remember is function is some sort of a function in the business, right? Manufacturing or sales, that is function. Otherwise, it is nature. What is a minority interest? If you remember, I'll give you a super quick overview. We have a large company, okay, and let's say we have a small company. Let me draw the small company smaller. So let's say we have a small company. Now, small company is owned by two guys, okay. Let's say person A and person B. Person A owns 70%, B owns 30%. Now, what large company does is, large company acquires 70% shares of A. Large company acquires 70% shares of A. Then this small company becomes your subsidiary, right? This small company becomes your subsidiary. So what you do then is you prepare something called as a consolidated books of account. Consolidated books of account, where large company and small company books are prepared together. Large plus small. Now, large company is owned by, let's say, Mr. X. So of course, Mr. X is still the owner. But below equity shareholder, he will also have to write name of one more guy now. Okay, who is that guy? That small shareholder of your subsidiary whose shares you did not acquire, right? The smaller shareholders of your subsidiary. So even B's name would be a part of now the overall equity of the business. And that B is referred to as the minority interest, not minority shareholder. Don't confuse the two concepts. This is called minority interest. Now, with the current US GAAP and IFRS rules, minority interest is to be treated as a part of equity. So this is your part of equity. So who is minority interest? The smaller shareholders of my subsidiary. That's it. Those are your minority interest. All right, let's make some progress with this. This part I'm going to skip. It's not really testable. Accrual accounting, I'm going to assume you know it. Recognize expenses when they're incurred. Recognize income when you've earned it. It doesn't matter if you've received cash or not. Okay. Make sure you're comfortable with these basics, straightforward stuff. There's a new standard on revenue recognition, but it is common sense. You don't have to really get into the nitty-gritties. Simply recognize the revenue based on how much service you've been able to deliver. For example, in a very simple language, let's say if you promise that I will deliver you 100 service, 100 quantity of service or 100 quantity of products. And if you've delivered only 20 products, recognize 20% of the revenue. Okay. If you've delivered 50 products, recognize 50% of the revenue. That's it. That's your new revenue recognition standard. If you want to read this in depth, we have good explanation in the juice notes, but logically, if you there's no memorization in this new accounting standard. If you apply common sense, you would get the answers right. Okay, you don't have to memorize anything there. All right, then gross revenue and net revenue recognition. Best example, look at all the air ticketing agents. So for example, let's look at someone like uh, Make My Trip maybe, or Skyscanner, right? So what are these guys doing? When you're buying a ticket, let's say air ticket is worth 5,000. You pay convenience fee of 200, and you pay total fee of 5,200. Now the guys who are on the gross side, the way they will do accounting is they will say revenue of 5,200, and then they will say cost of 5,000, and then they will say profit of 200, which is kind of stupid for Make My Trip type of business. The correct way to do for make my trip would be to simply say that, see, my net revenue is 200, end of the story. Correct. So when I did this with you in the class, I had asked you to read through the Uber case study. Remember, there was a controversy with uh, Uber in terms of how revenue was to be recognized. But in general, you need to know the difference between the gross revenue recognition and the net revenue recognition. Inventory, I'm going to do later on in the inventory reading, so I'm not doing it now. Depreciation in the assets reading, so I'm skipping through it. Some small items important for theory. Discontinued operations. Discontinued operations, show them net of profit at the discontinued operations, show the items net of profit at the bottom of the income statement. Okay, that's your discontinued operations. Extraordinary items do not exist anymore. It used to be the case in US GAAP. They're not there anymore. So unusual or infrequent, unusual and infrequent does not really matter. Don't worry about them too much. Yeah, that's it. And then we are more or less done with the uh, income statement reading. Yeah, all those things are removed. Don't worry about installment and percentage of completion. Those learning outcomes have been removed, so don't worry about that. Installment system, percentage of completion, completed contract, those, instead of them, they've added this new stuff. I mean, the logic is still same, so you need to know those methods. There's no harm in learning them. But instead of that, they've come up with this new revenue recognition principle. They're kind of the same way. They work in the same fashion. All right, guys. So I think we should take a break now. Now is a good time to take our first FRA break. It's going to be 20 minutes. Are you guys comfortable with my speed with FRA? Is the speed all right? Okay, good. Uh, so see, what I'm doing is I'm slicing my time based on my perceived importance of topics. So topics that I'm finding important, I'm taking them a little slow. But the topics that I feel, will, which probably might not be tested, I'm speeding up a little bit. So I'm trying to maintain a balance there. All right, good. Okay. All right then. So we're going to take a break, 20 minutes. After the break, then we're going to start with the next reading on the 10-minute break. Now this one is going to be 20 minutes, but maybe afterwards we'll take smaller breaks. Okay, stay on the link. Just come back on the same link. Any one of you looking at what's happening between India and England? I mean the cricket match. Yeah, it looks interesting, but I don't know. I mean, I don't know how many cricket fans here, but it's definitely an interesting match. Hmm. Okay, all right. That was a good break. Let's start with the next reading now. Let me give you two or three main questions. Nikita, I wish we could do that, but now is not the time. Now we have our own match to play. Okay. All right, let's start. Again, next 30-40 minutes of intense concentration. What we want to do next is we want to work on the next reading, which is balance sheets, understanding balance sheets. Okay, it has 4 or 5 main concepts. I'm going to take you through them one by one. Understanding balance sheets. Let's pick up let's do the first concept. Now this is relatively easier one. This is relatively easier one. Let's say we are using the revaluation model, which is allowed under IFRS. Okay, so we are currently on the revaluation model. You have some asset which has a fair value of 100 at time 0. At time 1, that asset goes to 150. At time 2, it goes to 90. And at time 3, I think this is good enough. Okay. What I want you to do is, I want you to tell me if we are on revaluation model under IFRS, and if that is allowed, okay, then what is the value at which we will show these assets on the balance sheet? What is the value at which we will show these assets on income statement and what is the value at which we will show these assets, or what is the value that we might show under OCI. All right. You have to do it for time 1 and time 2. Don't do it for time 0. Doesn't make sense. I mean, except for the balance sheet value. Parth, the answer is marginal. The rate that you want to use is the marginal tax rate, not the average tax rate. So just replace the average word with marginal and you're covered. Not relevant for others. Don't worry about that. Just focus here. Revaluation model IFRS. Come on, guys, do it quick. Give me the values for balance sheet. Give me the values for income statement and the OCI. OCI stands for other comprehensive income. Okay, I'm doing this for you. Look at this. If you're under revaluation model, you're allowed to show the assets at the fair value on your balance sheet. So you're going to have 100, you're going to have 150, you're going to have 90, right? So as far as that part is concerned, we're done. We don't have to think about it. Now, any profit that you get, any profit, right? That profit you want to put in the OCI, not in the income statement. You want to be conservative. So the simple rule is whatever profits you get, you put them in the revaluation surplus under the OCI. Whatever losses you get, you put them under income statement. And then the reversal treatment goes in the respective account first. So whenever you want to pass a reversal entry, it goes in the respective account. So what does it mean, right? So 100 is become 150. Is that my profit? Yes. Will I put that in income statement? No. I want to be conservative. I will put that in revaluation surplus OCI. Okay. Next, how much loss do I have? 150 became 60. What's my total loss? Loss is 60. But I've already recognized profit of 50 here. So let me pass a reversal entry of 50. So I will put a loss of 50 so that OCI gets 0. And the incremental loss I will put into the income statement. Okay, this is how you're supposed to do it. Profit in OCI, losses in income statement, reversal in the account in which you had posted the number earlier. For example, after having a profit of 50, we had a loss of 60, right? So out of that loss of 60, first 50 we will put in OCI and then the next one as per this rule. So this is how you are supposed to do it. Have you guys understood this? Can you give me a yes? Yes here. Comfortable? Yes, no. Okay, good. So the whole revaluation is out of your way. I hope you're able to handle this. The second concept in understanding balance sheet. And now they might not ask you a calculation question. They might just ask you a easy question. You should still be able to handle it. Yeah, you're right. This should be negative, by the way. My mistake. Thank you for helping me identify. This should be negative. You're right. Thank you. Arnab, Aditya. Let's do one more just to make you a little more comfortable with this. Let's do one more on revaluation. Let's say 100. Okay. This time let's have a loss first. let's say 100 becomes 80, and then it becomes 130. Okay, let's do quickly. This time I'll do it myself. Balance sheet, income statement, and OCI. Okay, I'm doing it myself. I just want you to observe how I'm doing it. So on balance sheet, we just show the fair value. We don't think about it. We just get done with it. Now, 100 to 80 is a loss. Loss should go to income statement, right? So loss is going to the income statement. So 20 negative. Loss goes to income statement. So 20 negative. Now nothing goes to OCI. Now 80 became 130. What's my profit? Profit is 50. But out of 50, 20 is a reversal profit, right? Because I've already booked loss of 20. 30 is the fresh profit. So I'm going to put in 20 here, and then I'm going to put in 30 here. Have I done this right? Uh, yeah. So that's how you're supposed to do it. Okay, that's how you're supposed to solve these type of questions. Now I hope that you're comfortable with this now. I hope that you would not get these easy ones wrong, right? These are very, very simple ones. You don't want to miss on them. Easy questions on the exam. These just giveaways. Grab them, don't let them go. Okay, good. Revaluation model is out of our way. Now my 5-star pick for this reading. My 5-star pick for this reading is going to be impairment. Okay. A lot of people struggle with this. A lot of people struggle with this. We want to get this thing right. The rules in US GAAP and the rules in IFRS are different. So let us say, let me set up the question for you. Let us say we have a gross block of a particular asset. Okay, let's say gross block of PPE, property, plant and equipment, is 2000. Let us say we have accumulated depreciation of 1500. Let us say the future expected cash flows from these assets, the future expected cash flows from these assets is the future expected cash flows from these assets is 1450. The fair value of these assets in the market, okay, the realizable fair value, the price at which I can sell these assets in the market is the realizable fair value, the price at which I can sell these assets is, let us say, uh, is let's say 1350, and let me twist this number a little bit. Sorry, I just want to play around just to show you something interesting. And the present value of future cash flows, the present value of future cash flows is, let us say, 1450. Now, based on this information, what I want you to do is, sorry guys, sorry, I wasn't thinking straight. I need to remove this one here. Now it's okay. So I changed the accumulated depreciation to 500. Otherwise, it would have been an absurd question. Now, based on this, I want you to calculate the impairment loss under US GAAP and impairment loss under IFRS. 5-star, you have to know this. You have to know how to do impairment loss calculations under US GAAP and IFRS. It's done a little differently. Okay, there are different ways, and you want to do the calculations. So let's see if you can handle this. You have a minute to do this. You have a minute to handle this. Get started. Everyone, please post your answers on the chat box. Keep on posting your answers on the chat box, please. I'm going to solve this. Understand how this is to be solved. You have to build flowcharts. Okay, I mean, it's the flowchart way of approaching this a little easier. So I'm going to do it parallelly, side by side. On the left, we'll do IFRS first. We'll do the IFRS first. In IFRS, what you want to do is, again, I want everyone to just stop doing what you're doing and focus here. We want to compare carrying value with recoverable amount. Carrying value with something called as a recoverable amount. Now, what is your carrying value? Carrying value is your gross block or gross block minus accumulated depreciation. So 2000 minus 500. So your carrying value is 1500. Recoverable amount is higher of the following two items. It's higher of the following two items. Number one, net realizable value, which is nothing but your fair value. Net realizable value. Generally, it's selling price minus selling cost, but you can think of this as a fair value, the value at which you would be able to sell it in the market. And second, value in use, which is nothing but present value of all the future expected cash flows from this particular asset. Okay. Now, what is my recoverable amount here? So let's look at my recoverable amount. Let's look at net realizable value, 1350. What is the present value of future cash flow? Present value of future cash flow, 1450. Which one of the two is higher? 1450. So that 1450 is my recoverable amount. Okay. 1450 is my recoverable amount. Carrying value 1500. Do I have an impairment loss? Yes, I do. Impairment loss. Now, my question to you, and a very important question, and I want you to answer that with all your sincerity and honesty. Can this impairment loss go to income statement? Can I book that 50 impairment loss in income statement? What do you think? Yes or no? Can I put this in income statement, the loss of 50? The answer is yes. The impairment loss, I have to put that in the income statement. And on my balance sheet, now the PPE value, the PPE value is not going to be 1500 anymore. It is going to be 1450. It is going to be 1450. All right. That's how we do it. Now, how do you do it under US GAAP? Under US GAAP, you need to do it in two steps. Okay. What are the two steps? Step number one, determine if impairment is necessary. Don't directly jump on to calculation of impairment. Determine if impairment is necessary. How are you going to determine that? By comparing carrying value with the total of undiscounted cash flows. Okay, just expected future cash flows. You don't have to take a present value of them. Carrying value is 1500. The total of cash flows that I'm expecting without really discounting them is 1550. Now, since this is higher since 1550 is higher than 1500. Impairment is not required. Impairment is not required. So you don't even have to go to the income statement. Okay. You don't even have to do the impairment calculations. Now, had there been any impairment, for example, if there was any impairment, uh, can we show impairment loss in P&L under US GAAP? That's a tricky question. Can we show impairment loss? Can we show impairment loss in profit and loss account under US GAAP? What do you guys think? Yes or no? US GAAP, not IFRS, US GAAP. Are we allowed to show impairment loss in P&L under US GAAP? What do you think? Yes or no? Come on, quickly answer me that. Can we show impairment loss in P&L under US GAAP? The answer is yes. Okay. The answer is yes. The impairment loss, whether it's US GAAP or it's IFRS, doesn't matter. It goes to P&L. It hits your P&L directly. If it's an sorry, if it's an impairment loss, it does hit P&L. Now the real question is, and I think where you guys are confusing is, the question is, can we reverse? Can we reverse impairment losses? If we book impairment losses, are we allowed to reverse impairment losses? The answer is under IFRS, yes, yes, up to the original fair value, up to the original fair value. In the US GAAP, the answer is no. Once you have booked, you're locked in. You cannot really do anything about it. You cannot reverse your impairment losses. Okay, but both the impairment losses, they do hit your profit and loss account. So these were the two key main calculations. Rest of the stuff in this reading is mostly theory. I hope you're feeling comfortable with balance sheet. Let me take you through the theory super fast. Okay, let's go through the theory content super fast. Uh, Now, what are the elements of balance sheet, asset, liability, equity? Make sure you're comfortable with doing those basic calculations, right? Equity, liability on one side, assets on one side, profit gets added to equity. I'm going to assume that you would be able to handle those basic type of calculations. Uses of balance sheet in financial analysis. You want to primarily use them for liquidity and solvency. This is important. Classified versus liquidity. Now, liquidity, in what you do in a liquidity format is you show your assets starting from cash, the most liquid, ending at goodwill, the least liquid. Correct? So you start with liquid and then you end up with the least liquid. Popular in the banking world. When we were doing the actual sessions, I did show you a lot of balance sheets like these. Popular in the banking world, allowed under IFRS. Okay, the liquidity based. Otherwise, we always do classified balance sheets, current asset, non-current asset separately. Now, uh, some of the current assets, you guys already know it. How to deal with inventory, we'll be doing that in the inventory topic. So I'm skipping through it. Current liability, uh, you guys probably know which is our favorite current liability. Which is our favorite current liability, the liability that we like to see in the books. The liability I told you as an investor makes me very happy. One of the few liabilities that, as an investor you see and you feel that, it's a good liability to have. What do you think? Which liability is that? A good liability to have on books of account. Correct. You're getting this right. It is the unearned revenue. Unearned revenue. Good. Why unearned revenue, right? Because current unearned revenue becomes future revenue. right? So generally, it's one of those liabilities where you feel happy to have it. You don't have to pay cash for it. You just have to do your business, right? You have to do sales in the future period. So therefore, it's a great liability to have in your books of account. Correct. We did Starbucks example. You're right. Okay. Cost model, revaluation model. I hope you're comfortable with them. Impairment we just did. Look at this sentence. Under US GAAP, impairment cannot be reversed. So once you have done impairment in US GAAP, you cannot really reverse it. Under IFRS, we can to the extent of previous carrying value. We cannot increase the value of the asset, but we can take it back to the original level. Okay, this part is important. So because I want you to remember this, I'm going to take a screenshot and put that into your notes for this session. These notes itself have gone into now 26 pages. Okay, but this stuff is important. Investment property. What is an investment property? Let me give this 3 stars. So in US GAAP, it doesn't exist. We don't have investment property separately in US GAAP. In IFRS, yes. What kind of an investment property it is? The property that you are holding for earning the rental income or for capital appreciation. Okay, so these type of properties are called investment properties. CFA curriculum, end of the chapter questions. I think they have about 3 on them. I want you to do them carefully. This is an important area. Okay, you want to know the whole investment property thing carefully. Now, these investment properties, you want to generally show them, like you have an option. You can show them at cost, but you're also allowed to show them at fair value. So if you decide, it's okay to show your investment property at fair value. All right. Now, when we go to long-lived assets, we will talk a little bit more on this investment property. Right now, I'm going to skip through them further. Let's do one more numerical. Okay, let us do one more numerical now. Now we get into the area of accounting for investments, or the IFRS 9 area. Accounting for investments. Okay. Let us say we buy some asset. Like, I don't want to specify whether it's a bond or it's an equity, because then we'll have to do multiple questions. Let's just call this an asset. Okay. Let's say that at time zero, we buy an asset for 100. Let's say at time 1, the asset value has become 140 in the market. Okay. This is the fair value. Now, the cash flow received, whether it's a coupon or it's a dividend, doesn't matter. I'm intentionally not specifying it. The cash flow that we have received from this asset is 10. Now, let us make 3 assumptions. Let's say we are classifying this investment as a held to maturity, or we are classifying this investment as available for sale, or we are classifying this investment as trading. Okay, one of the 3 categories. Either we are classifying this as HTM, or we are classifying this as AFS, or we are classifying this as trading. I want you to tell me what is the price at which we are going to show them on the balance sheet. If it's HTM, AFS trading, what number are we going to put on the income statement? What number we are going to put on OCI? Remember, the new IFRS 9 nomenclature is a little different. AFS now is called fair value through the OCI, FVT OCI. And trading is now called fair value through the profit and loss account, FVTPL. Just the name is different, but the more or less, mota on a very broad level, the treatment is similar. All right. So start telling me What number do we show on the balance sheet? What number we show on the income statement? What do we put on the OCI? Start. Yeah, this is amortized cost. Thank you. Amortized cost. Amortized cost. So in the context of the numbers that I've given you, so you can say balance sheet 100, 140, whatever your numbers are, just give me the numbers quickly, each one of you. Correct. Correct. You're right. Balance sheet answers are correct. How about income statement? Think about it carefully. HTM is held to maturity. AFS is available for sale. Trading is trading. Path. Okay. All right. Let me show you how to do this. Look at this carefully. If this is HTM balance sheet, we show it at something called as an amortized cost. For all practical purpose, this is just the cost. If it's AFS on balance sheet, we show it at fair value, the current market value. Trading, we show it at fair value, the current market value. Okay. I mean, it's not very difficult. Amortized cost, fair value, straightforward. Now, income statement here in HTM, we show only the realized gain. All right, only realized gain. Then AFS, we show realized gain. And in case of trading, we show both. We show realized gain plus we recognize unrealized gain. Even if I have not received in cash, even if I have not realized it yet, I still recognize that. In OCI, in the other comprehensive income, HTM, nothing goes in. Trading, nothing goes in. But in AFS or in the FET OCI, we put in unrealized gain. Okay, that's how you want to approach this. Unrealized gain. All right. So let's punch in the numbers. Let's see what's happening here. Let me switch my colors. Let's put a blue here. All right. So let's do accounting for HTM. 100 became 140. I don't care. I'm just going to record it at 100. Okay. Realized gain 40 is unrealized. I haven't received in cash. I haven't earned it yet. I'm going to just focus on this 10. So 10, nothing comes in here. End of the story. Straightforward. So HTM is the easiest to deal with. You generally put bonds here, right? You can't put equities in this category. Equities don't have maturity. You put bonds in this category. Let's look at AFS. Fair value. I'm going to put it at market value. So market value is 140. But that 40 is unrealized gain. I'm not going to take that to income statement. I'm going to put that in OCI, other comprehensive income. But this 10 I've received in cash. That's my realized gain. I'm going to put it in 10 here. All right. And the last one, fair value, 140. And I don't care whether it's realized, unrealized, the whole 50 comes in here. That is how you do accounting for the three category facets, HTM, AFS, trading. Are you guys comfortable with this? If you've understood this, give me a super loud yo-yo, please. Highly testable. You want to be comfortable with this concept. Good. Good to know that. You typically put, generally you would have equities in this section, right? You'd put in equities in these sections. Yes, Sarah, this is the table you want to know. Like, this is the table you have to know. You have to memorize this particular table. Okay, so I think we've more or less covered most of our ground in balance sheet. Let me just look at if we are being comprehensive. Yeah. Uh, let's do this table. Okay. Uh, Again, this is something that we will have to remember. This is a new addition to your curriculum, and therefore it becomes a little important. So even if you don't have juice notes, I'm going to take this screenshot for you and put that into our class notes for today so that you don't miss on this important part. This section is important. It's a new addition to the syllabus. So I want you to have this with you. Okay. Differences and similarities between US GAAP and IFRS. Now, the IFRS is the one, US GAAP is the one which is using the old terms, right? HTM and AFS and trading. IFRS is using the new nomenclature. Now, look at this. If you have a loan or notes receivable, okay, if you've given loans or if you have notes receivable, under both, you put them in the same category. Just the different name, but it's the same thing, right? HTM and amortized cost. Now, if you have a category 3 security or level 3 security, let's say in a very simple language, if you have an unlisted security, for which you cannot figure out market value. For example, you have bought shares of a private company. There is no way for you to figure out what's the correct market value. How are you going to do accounting for it? Remember, under both US GAAP and IFRS, you're going to do it under historical cost. Okay. You're going to remember that you're going to do it under historical cost, both US GAAP as well as IFRS. Let me give you an example. If you guys buy shares of, let's say, a private company today, okay, let's say you buy shares of, uh, in India, let's say you buy shares of whatever private company you like, let's say Flipkart. Now, how are you going to value them, right? There is no easy way for you to figure out the good fair value. What you do then, you recognize both of them at the price at which you purchase. That's it. Under US GAAP, IFRS, both. Now, if you have debt security and your intention is to sit on them, you're going to keep them with you. You're going to keep them with you till their maturity. Same accounting, HTM amortized, same, doesn't change. But if you have a debt security with which you are going to sell, you're going to trade on it. You bought a bond today, you're going to sell it tomorrow. You're going to sell it next week. Under both, you do trading. FVPL is just a different name for trading. Okay. Now, if you have a debt security where you don't have an intention to sell, you don't have an intention to hold till maturity, you're in between. It's like you buy a 10-year bond, okay, and someone comes and says, are you going to sell it next week? You say, no, I'm going to keep it. Then the person says, are you going to keep it for all the 10 years? You say, no, I'm not sure. I'm not sure is your answer, right? You're neither this side, you're neither that side. Where do you go? You go in the between, AFS or FVOCI. If it's equity, what do you do? In US GAAP, you have to go trading. In IFRS, you get a choice, but an irrevocable choice. That means once you decide, you cannot change. Irrevocable choice. Either go FVOCI or you go FVPL. So remember this, please. If you're buying equities, you go trading. Here, you go either of the two side. And other financial asset, again, you get a choice, irrevocable choice to use between choice to use FVPL or you can go the other two. Now, observe this table carefully once, let it sink in. It's not possible for us to memorize all of it. See if it's logically fits you. I'm going to answer maybe one or two questions on this. If you want to ask anything, you can put it on the chat box. Generally, I have not been taking your queries today, but this one I want you to let it sink in properly. If you want to ask anything, ask me now. You don't have to type in the whole thing. You can just say first line, second line, third line, fourth line, fifth line, sixth line, seventh line. If you want to ask anything, ask anything. Yeah, try and understand as much as you can, Anisha. A lot of this is logical, but if you feel you're struggling, then you don't have a choice but to memorize it. But this is an important one. Okay. We're doing at least, okay, seventh line is what you need. See, what is the meaning? What is this? Any asset, right? Any asset. Let it be bond, let it be bond, let it be preference shares, let it be equity. US GAAP, as you know, is a rule-based accounting standard. So US GAAP does not give you flexibility with financial asset. Okay. But in IFRS, a company has a flexibility that they can put any financial assets under FEPL. They can put any financial asset under FEPL. Of course, they can go by the rule and they can say, no, we want to go trading. Okay. We want to go OCI. Okay. We want to go amortized cost. Okay. But if a company wants, they have a choice to put it in FVPL. But can they change the irrevocable means? Irrevocable means, once you say that I have accepted a choice, you can't change it. You can't go back from there. So once you have chosen FEPL, you're stuck with FEPL. You cannot go back to trading again for that particular asset. Okay, so that's what it means. So remember that IFRS gives you flexibility. US GAAP doesn't. US GAAP says, if this is the asset, put it here. If this is the asset, put it here. I'm going to leave this table in your notes. Look at this carefully once. You should be able to answer the questions. All right, moving on. I think we're more or less done with this now. Balance sheet should be done. There's smaller parts that you should be able to handle. Okay. Balance sheet, more or less we've done good. I think I'm confident most of the questions you guys should be able to answer them. Are we ready for the cash flow statement? Cash flow statement is is a massive reading. Cash flow statement. How's the Josh now? How many hours into the class? This is now 7 hours, 15 minutes with few breaks in between. How's the Josh? Don't lie to me. Really? Medium? Hmm. Lower than at 2 p.m. सुबह तक चलने दो वाह. Reminds us of the classroom session. Yeah, I know. Head is full till the time you're not tired teaching. How can we get tired? Wow, wow, Garvit. Semi high. Okay. There's no other option than saying hi. Tell us about the mock exams. How much time left, please? 2 to 3 hours. Feeling drunk. Okay. Parth, yes, you can. Can stay here till exams. My Josh is good. I think before lunch, just before lunch, I thought my energy levels were dropping. I have been trying this stupid intermittent fasting for last few months. It works pretty well when I'm not teaching, but if I'm teaching, my energy kind of just trips down. But after lunch, I think I got pretty good. And then coffee helps. So I would say my Josh is pretty good. Not as good as not as good as when we started, but it's still good. I think I can do another 4 or 5 hours. So let me tell you. I know I want you to take a break. Let me tell you a story. Let me tell you a little story. Rajiv, no, that's no me. So it's actually like a real story, okay? And I no, it's not like a finance story, though I have lined up a lot of finance stories for you. But today I'm just being a little conservative with time. But I'll tell you a story that might help you a little bit. Your story and my story of CFA level 1 exam is it's kind of same. Okay, I know you guys have an option to defer your exams, correct? I think you're allowed to defer your exam till 10th, right? Till 10th, I think you're allowed to defer your exams. And you you've been going through this uncertainty of whether exam will happen or not happen, correct? That is happening in your mind. So I'll tell you what happened during my times. It's really stupid. Yeah, I'm, it's really stupid. Yeah, it's So what happened is when I signed up for the exams, and that time what used to happen, there was some sort of a legal issue happening between CFA Institute and some regulatory body in India, I think called AICT. Okay, I don't remember, but some legal body in India and CFA Institute, they had some sort of thing going on. So a few days, before the exam, uh, I got a call. A few days before the exam, I got a call from a lady. Okay, and she said, "Hi, I'm calling from Economic Times," and I was like, "Economic Times, really?" So she was like, "What's your name? Hi, hello, general conversation." And then she was like, "What is your opinion about exam deferral or exam cancellation in India?" I think exam deferral in India or cancellation about India. Now, I said, "What deferral?" I was like, "What deferral are you talking about? मैं books लेके बैठा हूँ सुबह से. I've been studying since morning. Uh, what do you mean by exam deferral?" So then that she explained me. She was like that this thing is happening with CFA Institute in India. So I think there's a stay by, or for the timing your exams are cancelled in India or something like that. Okay, and I had no idea about it. Uh, and apparently the next day, it's really stupid, but she actually printed this in the newspaper saying there's this guy called Utkarsh who didn't even know that the exams were deferred. Okay. And I was very happy my name was going to come in the newspaper. But when I read the newspaper, I was like, what the this, like, he didn't even know the exams were deferred. But anyways, the main story now. So the CFA Institute wrote us emails. They were very nice. They were like, if you don't want to write, you're from India, you don't want to write, you get your money back. Okay. Or you go to any of the foreign destination and we will pay you some money. I don't remember how much, but we'll pay you some money to cover your cost, like traveling cost. So when I think of that time, right, where I had to choose between whether I should write or I should not write the exam, uh, whether I should write or not, you guys are same. You guys are same, right? You are also faced with the same thing, that should I write or should I not write? So I'll tell you what was my driving factor that time. I didn't have a passport then. Okay, you were not required to have a passport to write CF exams that time. But what I got to know is, I got to know that, like, I thought that if I go and write the exam in some other place, uh, then I would get to travel. And the only place you can travel outside India without a passport was Nepal, right? I mean, there's no other place you can travel. So I spoke to my parents. I told them, you know what, I'm very serious about these exams. Uh, I have to, like, I didn't care. I just had to travel, right? That was my main thing then. So I went to my parents. I was like, look, this is a very tough exam. I want to prepare. I have prepared for it. I want to go to Nepal and write. And they were like, इतना sincere हमारा लड़का है, हमको पता ही नहीं था. They still think that. So they booked tickets for me. CFA Institute paid money. The tickets were booked. I think you go from. I booked from Pune to Delhi, and Delhi to Kathmandu. That was my flight. So when I reached Delhi airport from Pune, that time I got to know that you don't need to have any passport to travel to Nepal. You don't need to have any passport to travel to Nepal. But if you want to fly there, Then you need to have, I think, passport or a voter's card. Okay, like one of the two documents. I didn't have either that time. I just had a PAN card or a driving license, something like that. So after reaching to the Delhi airport, I realized I cannot fly. Okay, so the only thing that I can do is the only possible way is train. So from airport, I went to, I think, Nizamuddin railway station. I booked a train. Like I had to do a general ticket. Okay, in India, general tickets are the worst. Like they treat you like insects, especially the UP trains, the trains that go in that direction from Delhi. You're worse than insects. So it was miserable traveling from Delhi to the UP border, and it took me some time to reach Kathmandu. I was sleeping on the floor, what not. Like that was probably like really bad travel experience. Uh, so I somehow managed to reach Kathmandu, and it was raining heavily there. Got done with the exams. It's like fine, exams are no big deal. Like, I didn't care. Just get done with the exams. And then with the money that institute gave, like I traveled for quite some time. From Kathmandu, I went to Nagarkot. There was a nice place called Nagarkot there, and then I went to Pokhara. Tried doing a little bit of Annapurna. I couldn't do the whole, but I tried doing a little bit there. So yeah, 1 month. So when my money got over, then I came back. So for me, in for my three results, right? Level 1, level 2, level 3. For me, level 1 would always be special, not because I studied or I did something great. In fact, I was like never really good student, but level 1 will be special because it was not easy to that mental process of traveling, writing the exam, and going through all the circus. And it's probably the same for you, isn't it? It's probably the same for you. uh, it's you guys are going through that mental challenge of whether exam will happen, exam will not happen. You're putting in so much of efforts for it. So I'm telling you this, if you'd ask me in the hindsight, like, Utkarsh, out of all the exams and all the things that I've done, which one is the most special one, I'll tell you it is always going to be that level 1 exam I took in Nepal, because I remember everything, like my experience of where I was sitting and how I was writing the exam, my experience of how the results came. Maybe I'll tell you that story again. Like where I was sitting when I saw the results, how did I react? I remember everything about level 1. I don't remember that about my CA exams. I don't remember about, FRM. I don't remember about level 2, level 3, nothing, just level 1. Because of, that whole entire experience. Same case with you. So it's going to be worth it. Okay. It's going to be worth it. Let's give our 100%. And let us start with cash flow statement. Maybe in one of the breaks, I'll tell you uh, how I got the level 1 results. That was also very interesting. Um, just to give you a teaser, my level 1 results are associated with Altaf Raja. Altaf Raja is Altaf Raja. You look him up online, but I'll tell you the story later on. Let's focus on cash flow statement. I'm going to give you a few questions, about 4 or 5 of them. If you're able to solve them, more or less cash flow statement is under control. Okay. Here's your question number 1. This is some year 2001, 2002. This is your current year. inventory 500, 700, COGS 1000, 1500, sales 2500, 5000, no, 2500 and 3500. Accounts receivable accounts receivable 1000, 1400, accounts payable 800, 600. Actually, this one question will cover all those 2-3 questions that I wanted to touch base on. Yeah, we've pretty much done everything. I want you to calculate cash paid to suppliers, okay, and cash received from customers. Cash paid to suppliers and cash received from customers. Let's start. This you're doing calculation for year 2002, by the way. You're doing this calculation for year 2002. Cash paid to suppliers, cash received from customers. Let's see if you can do this. All right. Do you want me to solve this? I'm going to solve this now. Questions like these, where you have inventory, accounts receivable, accounts payable. You have three things, right? Questions like these, you want to solve with the help of flowcharts. I would recommend try and not memorize those formulas. Those formulas could, what no? No, what no? I'll recommend try and not memorize those formulas in the curriculum. Do not make sense. Instead, solve with the technique that I'm showing you. This is an easy technique. It will always ensure you get your things right. Okay. So what you want to do is you want to build these inverted Y flowcharts. And you, in this instance, you want to build three flowcharts. Okay. Now, of course, how to make the flowchart, that's a little bit of skill that comes with practice, but let's see if you can pick it up. It'll be very nice if you learn to do these flowcharts, especially the ones who are doing it for the first time. If you've done this with me before, of course, it's going to be a little easy, but try and pick this up. Okay, try and pick this up. So three inverted Y flowcharts, three inverted Y flowcharts. All right. Now, the first flowchart is going to be for inventory. Okay. Second flowchart, you try to build for accounts payable. And the third flowchart, you do for accounts receivable. Okay. And there is a rationale for it. Generally, you do inventory and AP flowcharts next to each other. Now, look at how I build the flowcharts. Okay. Opening inventory, opening inventory, opening inventory, opening AP, opening AR. So your starting point is opening values, opening AP, opening AR. Then you say plus here. Why would my inventory increase? Total purchase. Why would my accounts payable increase? Credit purchase. Credit purchase. Why would my accounts receivable increase if I make credit sales? So the plus values that come in the first arm of that flowchart before X comes in. X is essentially the total of these two numbers. Okay, X is just the total of these two numbers. Now, what happens to your inventory when you buy it? Like, how do you use it? So it goes into your COGS or it remains in your closing. The total of these two is also X. So the thing with this inverted Y flowchart is the job is to reach at X either by starting at the bottom or starting at the beginning. So what happens to inventory? COGS closing. What happens to accounts payable? You pay cash, cash paid or closing. What happens to accounts receivable? They pay you cash. So cash received or closing, right? So all that you want to do is to be able to solve these questions is to learn to make these flowcharts properly. You practice them 2-3 times and your life is sorted. You would be able to do them just like this. Now, this is a simple fill in the blanks question. Okay. So opening inventory 500. Let me put in 500 in this flowchart. Closing inventory 700. Let's write down 700 here. My COGS for the current year 1500. Okay, so observe how I'm doing it. I just did fill in the blanks. Okay. Now, since I have these two values available, I can reach X from the bottom. So what would be X value? 1500 plus 700 is 2200. And if X is 2200, can I find out the missing number? Yes, I can. The missing number is my total purchases. The missing number is going to be the difference between 2200 and 500. The missing number here, the total purchase is going to be 700. Now in questions like this, you can simply assume total purchase is credit purchase. So this is 1700. So this number is available. Let's start doing fill in the blanks for accounts payable now. Opening accounts payable 800. Okay, 800. Closing accounts payable 600. Then ask yourself, do I have any two values on one side? Yes, I have these two values. Can I find out X? Yes, of course I can. 800 plus 1700 is 2500. Now, if I have X, can I figure out what is the cash paid? Because even these two need to total to 2500, right? So how much is that going to be? Difference between 2500 and 600. We get 1900. So there you go, the first part done. Now accounts receivable. What's my opening AR? Opening AR is 1,000. Opening AR is 1,000. What is my closing AR? Closing AR is 1,400. What is my credit sales? Total sales. Total sales this year is how much? 3,500. So total sales 3,500. Can I find out X? Yes, I can. 4,500 total of these two. If I have X, can I figure out what would be cash received? Yes, 3,100. Job done. That's your answer. 1,900, 3,100. Okay. And of course, it requires a little bit of practice. If you're looking at for the first time, you might find this slightly strange, but you do use this technique and do 2-3 questions, you would realize you would never make a mistake with any of the indirect cash flow statement type of thing or direct cash flow statement type of thing. You'll be able to get them through very, very easily. Now, those of you who've understood this and who got this right, give me a yo-yo, please. Those of you who've understood this and who've got this right, give me a yo-yo on the box. So 1,900 is the cash paid to the suppliers and 3,100 is the cash received from the customers. Nice. Good. Yeah, assume all the sales is trade sales, Samit. You're right. Okay. Let me give you one more different variety of this. Okay, one more. Even these ones you can do with inverted flow charts. A slightly different variety of these questions. Again, same. By the way, on the exam, okay, be careful. Like CFA Institute does strange things. They've done the strange things even in the curriculum. At times, they would write 2001, 2002 like this. At times, you would see 2002 and 2001 like this. You never know. Okay, you never know which one would go in where. So you want to be very, very careful when you're reading the column headings. Okay. So this time I'm going to do it inverted intentionally. And of course, they don't write 2001. They write this 2xx2, 2xx1. It's the same thing, right? So let us say we have data like this. We have opening tax payable. Opening tax payable. Not opening, let's just say tax payable. Tax payable 700, 600. Interest payable 1,800. Salary payable, you can do as many payables as you want. Salary payables, let's say 0, 900. Now tax expense during the year, tax expense 500, 600. Interest expense 1,400. And salary expense during the year is 2,000 and 1,000. Now, based on this information, I want you to figure out what would be the cash paid towards taxes, interest, and salary. I'll give you a minute. Do inverted Y. I mean, after a little bit of practice, you can do this orally. But right now, it's fine to do your inverted Y flowcharts. You have a minute, guys. Okay, I'm going to do this now. Again, the same technique. Those of you who got the answer right, I'm very happy. Those of you who haven't, this is an easy technique. Look at how to do this. Again, just do your inverted Y's for each one of them. Okay, so since we have 3 items here, we're going to need 3 inverted Y's here. So we will say opening tax liability plus tax expense, which kind of leaves you in the middle, like that's your total payable. So tax paid and closing. And same story repeats everywhere. Opening salary plus the salary expense, paid, closing. Same story here. Opening interest payable, interest liability plus interest expense. Okay. Cash paid, closing. That's it. Okay. And then it is a straightforward fill in the blanks question. There's nothing that you need to really worry about here. So what's my opening tax liability? My opening tax liability here, opening means the beginning of the year, 600. Now see here, this is where the confusion comes, right? uh, 2002, 2001, you want to be very careful on the exams with these small things. So 600. So opening tax liability is 600. What is my tax expense during the year? Tax expense during the year is 500. What is the closing value of tax liability? 700. Now, is there a way for me to find out? Is there a way for me to find out the X value? Of course, yes. 600 plus 500, 1100. So if I have X value, can I find out tax paid, like a balancing figure? Of course, yes. 1100 minus 700, that's going to be 400. That's my answer number 1. Okay, I hope you get this right. I hope you're getting the logic of this flow chart. Very simple. You don't have to think about any formulas whatsoever. Let's look at salary. Opening salary liability, 900. Closing salary liability, 0. What is my salary expense during the year? My salary expense during the year is 2000. So 2000. Is there a way for me to find out X? Of course, yes. 2900, 2900. That's my X. Now, if X is 2900, this is 0. Can I figure out how much cash I have paid? Yes, I can. 2900. That's my second answer. Let's look at the third one. Opening interest liability. Opening interest. How much? 400 and 1000. So this is 400. This is 1000. Is there a way to figure out interest expense? Yes, it's given. Interest expense is how much? 1000. So can I find out X? Yes, 1400. So what should be this number? 400, the closing number. Job done. Now, those of you who have understood this and who've got this right, a yo-yo, please. Is everything okay? Opening interest. Wait. Did I make a mistake? This should have been 800, right? I made a mistake here. Opening interest liability was 800. This was 1000. Now, don't give me yo-yo just yet. Wait. Wait. Opening interest liability was 800. Closing was 1000. And interest expense was 1000. Actually, I made a mistake. I wonder why would you guys give me a yo-yo if my answer itself was wrong. this this was 800. Now that tells me you're tired. All the yo-yo guys, had you been in my class? आप सबको मुर्गा बनाता मैं यहाँ पे. Now, people who are not from India, I don't know how to explain that in English. Yeah, the credibility of yo is going down. I agree. How do you say in English murga banana? Yeah, this is easier. I hate those tea things. Cooked chicken, stationary squats. Make a hen. Okay. Lean down. Rakesh, you're going somewhere else. Lean down. Shall we make flowcharts on the exam? Yeah, why not? They'll be giving you rough papers. You can do your work there. You can do your work there. Okay. I have not finished it yet. Can I do one more question, please? One more question, and then I'll be more or less done with cash flows. Then just the theory. Okay. One more numerical. One more numerical. All right. Let's say we have an asset. Okay, guys, look at this carefully now. Uh, Once cash flow statement are done, I think we'll feel a little lighter with FRA. We'll start feeling a little more comfortable with FRA. Let's say opening book value of asset is 100 and the closing book value of whatever asset, right? PPE maybe is, let's say, 150. Now, depreciation charged during the year. Depreciation charged during the year is 20. At the end of the year, an asset with book value of 20, no, not 20, let's make it 30, with book value of 30 was sold at a profit of 15. At a profit of 15. All purchases are made at the end of the year. All purchases, sales are made at the end of the year, so that depreciation is not complicated. Made at the end of the year. At the end of the year. Okay. From this information, I want you to figure out what's the CFI, cash flow from investments. It's going to be fun. It's a beautiful question. You can do this with inverted Y, but the inverted Y is now a little different. Okay, you can, but it's a little different. Let's see if you can handle this. We have opening book value of asset, we have closing book value, we have depreciation charged. Had I stopped the question here, it would have been very easy, but this thing kind of adds a little bit of zing to our question. At the end of the year, an asset with book value of 30 was sold at a profit of 15. And then do the math. Let's see if you can do it. I'll give you a minute, otherwise I'll solve it myself. But if you want a hint, the hint is inverted Y might not be sufficient. What you need is now an inverted trident. Trishul. You need an inverted trident to do this. Start. I want you to give me CFI, cash flow from investments, a net value. Don't mess this up. I'm expecting you to give me cash flow from investments. Last 30 seconds, otherwise I'm doing it. These are the type of questions which are really going to challenge you on the exams. But if you get this right, you're going to feel happy about yourself. Zayan, don't worry. There's no need to defer. Just learn. Just learn. Push yourself. Okay. Let's solve this. Let's solve this together. Here's how you build your flowchart in this case. Okay, it looks a little different this time around. Now your flowchart is going to look like this. You're going to do the same beautiful inverted Y, but not Y. This time you're going to build a trident. Okay, and if you learn to think like this, trust me, it becomes really easy to solve these questions. So inverted trident now. Now, how to decide it's a trident? That requires a little bit of practice, but you'll understand once I explain. Now here, it starts with opening value of asset. Of course, your value of asset will increase by the amount of new purchases you've done. This is the number we're seeking right now, right? Once I figure out what purchases I've done, CFI is easy. I will get my X. Now, three things can happen with my assets. What can happen? I can depreciate them, or I can sell them, right? So I can sell my asset, or they remain in closing. So because three things can happen with my assets, I had to have a trident here, not an inverted Y. We needed those three folks here. Now it's a fill in the blanks question, really. If you just do fill in the blanks, what is the value of opening asset with me? It was 100. How much new purchases I did? I don't know that. What was the closing value? 150. How much depreciation did I charge during the year 20? What amount of asset did I sell? Book value of 30. I might have sold at a different price, but the book value is 30, right? 30 worth of asset went. So 30. Can I find out X? Yes. 150 plus 30 plus 20, my X is going to be 200. If my X is 200 and if my opening asset is 100, can I figure out what is the amount of purchases I did? Can you guys help me with this number? This has to be the balancing number, right? What number is this going to be? This is going to be 100. Once you have this 100, then how easy is your CFI? Now what you need to do is to calculate your CFI, you just say, I need to look at two things. One, what is my PPE purchase for CFI calculation? What is my PPE purchase? And what is my PPE sell? PPE sales. Because sales is an inflow, purchase is an outflow, money is going out. Now, what would be my PPE sales? So I sold worth 30, but remember I sold at a profit of 15. So I must have sold it. I must have sold it at 45. Agree? 30 is the book value, but 15, I must have sold it at 45. So my inflow here is 45, but my outflow is 100. 100 is negative. So net answer is negative 65. How many of you, I don't see a single correct answer on the chat box. Where? 55, sorry. 55, my mistake. Time for a cup of coffee now. This is the correct answer. I think there's just 3 or 4 correct answers on the chat box. अब सब 55, आप सब शेयर बनेंगे. How many of you got this right? Come on, the yo-yo gang. How many of you got this right? How many of you have understood this? How many of you have understood this? Give me a yo-yo. You would give me a no-no only if you've not understood this, even now. Kaushik, depreciation is 20. Let me explain this one more time. Some people are struggling, so let me do it again. See guys, opening asset was given. Okay, don't overthink these type of questions. It's easy. Listen to this carefully. Opening asset was given to you. So you start with opening 100. Closing is given 150. You're being told that you sold worth 30. So 30 worth of asset will go, right? And depreciation, you charge 20. So you get your X of 200, you figure out purchase of 100. Now purchase of 100 means money went out. So that's a negative number. So negative 100. And how much money came in? 30 worth of asset I sold at a profit of 15. That means I sold for 45. So I sold for 45, I get net 55. Okay, go back and practice this. You should be all right with this. I don't see you struggling. Just practice a little bit. And I'll tell you which questions to practice, of course, towards the end of the session. So now let's do very important theory. My, again, 5-star, 6-star, 7-star pick. I will buy 7-star pick for this reading. It's a theory concept. Okay. You have to remember it. US GAAP, and IFRS. Come on, let's build some speed, please. We have few items that we have to take care of. Okay, interest paid, interest received, dividend paid, dividend received. Then taxes with respect to investing, taxes with respect to operations, taxes with respect to financing. I'm not writing it properly because I'm just trying to optimize on our time. Okay. Now, these are some of the specific items that under US GAAP and IFRS, I want you to remember. Okay. This is one of those things that we want to remember. This is one of those things that we want to be alert with. Now, I'm going to help you do this in US GAAP. In US GAAP, for some strange reason, everything becomes CFO except one. I'm going to write CFO. You tell me where I'm going wrong. Okay. Everything I'm writing is CFO, but I'm making one mistake. You're going to figure out for me where that mistake is being made. So I'm writing CFO, CFO, CFO everywhere. In US GAAP, I'm writing CFO, CFO, CFO everywhere. I've made one mistake here. Please help me figure out where is that. Please help me figure out where that mistake has been made. I'm waiting for you. Where is that mistake being paid? Yeah, you're right. Dividend paid. This is the only item in US GAAP that we do differently. Dividend paid, we do this as CFF. Dividend paid, we do CFF. Everything else is CFO. Everything else is CFO. End of the story. So US GAAP, actually, these items are very easy. You don't think CFO, 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 end of the story. IFRS, 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 the IFRS, the logic is CFO or what is logical. Okay. So in IFRS, for the first four items, CFO or, CFO or, CFO or, IFRS is giving you choices, CFO or something that's logical. Okay. Something that's logical. Now, what is logical? So here's your intuition. Here's your intuition. Okay. Your intuition is interest paid. Interest paid is you're paying interest because you've taken a loan, right? You're paying interest because you've taken a loan. So therefore, interest paid is going to be CFF. Because you took a loan and taking a loan is a financing item, so it's CFF. In the same way, interest received. Why are you receiving interest? You're receiving interest because you made investments, correct? So because you made investment, you're receiving interest. So therefore, this should be CFI. You're paying dividend because you raised money through equity, CFF. Dividend received because you invested in shares, CFI. And in IFRS, respective taxes go in the respective account. So in investing tax goes in investing account, operations goes in operations, financing goes in financing. That's your memory trick. You want to remember this thing. Are you okay with this? Are you comfortable with this? Correct. Paid generally CFF, received CFI. Jignesh, you're spot on. Yeah, that's how you want to think of it. Good job. All right, good. So more or less we're done. More or less we're done. Let me just quickly Let me just quickly take you through finish. Let's finish cash flow statement. Uh, let's finish cash flow statement and then I'll give you a break. Okay, guys, please, let's do the theory. And not everything, but I want to do the important part with you. So inverted Y is okay. See, I'm not covering FCFF and FCFA right now because this part is anyways repeated in the equity. Okay, so we will go to equity and we will deal with FCFF, FCFA then. So right now we take it easy. These ratios are fine. It's no big deal there. So I think more or less we are all right for this. Okay, more or less, I think this is how you want to do it. I think our cash flows are done. Just one small item. One last item, and then I'm going to let you go. I'm going to be going to take a nice break. I'm going to give you certain items. Okay, you just have to tell me whether they are CFO, CFI, or CFF. That's it. 5 or 6 at most, and then you've earned your break. First item. First item. Let's say salary. Where did this come from? First item. Let us say salary paid. Where do you think this item should go? Should I put this in CFO? Should I put this in CFI? Should I put this in CFF? Salaries paid. CFO or CFI or CFF? Come on, quickly. Salaries paid. Correct. You're right. This goes in CFO. Second, let us say cash received, from accounts receivable. Cash received from accounts receivable. Where do you want to put this item? Cash received from accounts receivable. This is going to be, come on, CFO. You're right. Third. Okay, this one gets a little tricky. I want you to think through this. Machinery purchased by issuance of shares. Machinery purchased by issuance of shares. Give me 3 and then answer. Machinery purchased by issuance of shares. What do you think? Where do you think this will go? Machinery purchased by issuance of shares. Machinery purchased by issuance of shares. Come on. What's your answer? Machinery purchased by issuance of shares. Think about it. Machinery purchased by issuance of shares. If you answer this right, I'm going to be very, very happy. Machinery purchased in exchange of issuance of shares. Is it CFO? Is it CFI? Is it CFF? CFI, CFF, both. You can also answer both. Machinery purchased by issuance of shares. Correct. Smart people. This will not be recorded in the cash flow statement because there's no cash here, right? Will not be recorded in the cash flow statement. There's no cash transaction here. You're getting machinery, you're issuing shares. Where is the cash? It's not anywhere, right? So you just mention that in the notes to accounts, but you don't really enter this into your cash flow statement. Number four, bonds issued. Number 4, bonds issued. US GAAP, IFRS, both. Bonds issued. Where will you record them? Number 4, bonds issued. Bonds issued. Bonds issued. Where? Bonds issued would be CFF. Cash flow from financing activity. Bonds issued would be cash flow from financing activity. And number five, uh, equity shares purchased. You're investing, so you're buying equity shares. Where will you enter equity shares? Number five, equity shares will be equity shares would be cash flow from investing activities, CFI. Uloma, got it. I know your YouTube username now. Good job. All right, one more break. One more break, but we're maintaining good momentum. I'm happy with how things are going so far. One more break, 15 minutes, and then we continue with more technical parts. Are you guys enjoying it? Do you want to continue? Are you having fun with these sessions? I know the session is getting longer, but we want to push ourselves as much as we can. Let's try and finish FRA. Okay, let's push ourselves. Let's see what's our limit. I know you guys are tired. I know you guys are tired, but let's push ourselves a little bit. Maja yete very nice, man. Uh, so I'm going to continue. Here's what we'll do. Okay, we'll take a 20-minute break. After the break, we'll continue with the sessions. I'll also tell you the story of the results maybe. Okay, once the subsequent session starts after 20 minutes. My estimate is I will take about two to 2.5 more hours. I will need about 2 to 2.5 more hours, 2.5 at least. So I'll see you in 20. भारी वाटतंय. All right, then I'm ready. We're playing cricket here in the office. We tend to do that once in a while. All right, let's start then. Next reading. I'm not doing analysis technique right away. We'll worry about that a little later. Let's jump on to inventories. Inventories. Are you guys ready? Last 2 hours of the session, but let's try and make the most of the time that we have. Oh yeah, okay, story. Yeah. Story. Yeah. It's a quick 5-minute story, I'll tell you. So the story was like this. I told you I gave the exams in Nepal. Then I came back to India, traveled a little bit, came back to India. Then I think after a couple of months, I don't remember, but after a couple of months, the results were to be announced. So like there wasn't like during those days, internet wasn't so popular, right? So what I did not have internet at my house. Like very few people used to have internet at that time. So that those were the days when internet cafes were very popular in India, right? So there was an internet cafe at some place in Baner. So I went there, and generally, what CFA Institute does is they give the result timing. I think as per Eastern time in the US, I think so. I did not read that correctly. So what I thought results were in the morning hours India time, whereas they were supposed to be in the evening. So um, I got up, like went to the internet cafe around 10 or 11 in the morning, thinking results have come. Those days, they were not used to send emails. Like today, you get emails, right? That time it used to be opposite. You have to go to the CFA site. You have to go to the CFA Institute website, log into your account, and keep on hitting the refresh button. Okay. And because every other desperate guy like me was doing the same thing, going on their website and constantly doing refresh buttons, their website used to crash once in a while. And then, you have to do that till the time you don't get your results. So you be mentally prepared. Like we knew that this happens. I'd heard that from other people. So I went to that internet cafe. It used to be expensive. You had to pay per hour. So I had limited budget to check my results. And I'm constantly, hitting that refresh button. Results are not coming. Sorry, just a minute. There's a little noise in my office. Just a minute. Thank you. Yeah. So, uh, so interesting. Listen to me carefully. So I'm constantly doing refresh. The results are not there. Okay. And it was strange because those days, Orkut and those things were popular. Uh, and then this guy at Internet Cafe, he's playing this song. Okay, so the song was "Pehle to kabhi kabhi gum tha." You must have heard this song somewhere. It's an Altaf Raja song, and Altaf Raja even then was like the worst the worst song that you want to listen to. Okay, even in those days, it's like you don't want to listen to Altaf Raja, and this guy, the Internet Cafe owner, is a bald, tall fellow. He's constantly playing Altaf Raja on full volume, and I am getting frustrated to my core because on one side the results are not there, right? So I'm constantly hitting the refresh button, waiting for results to come. On the other side, the Altaf Raja volume is increasing, and and the song is "Pehle to Kabhi Kabhi Gum Tha," and this kept on happening for some time, and finally, I hit that enter button, uh, and finally I hit that enter button, and then results are there, and now the whole environment, right? So I overreact and I shout there, like there are other people in the cafe, and I shout, and yeah, it was an auto wala song. Yeah, I shouted there, and like that was the euphoria moment. Seeing that congratulation, like that felt quite a bit. So my memory association of result is Altaf Raja. So for me, CFA level 1 result is every time I say CFA level 1 result, I think of it. I think of Altaf Raja, and I think of Pehle to Kabhi Kabhi Gum Tha. Okay. All right. So inventory. Let's start. Let's make the let's start. Inventory, 2-3 items we need to work on. First item is the how do you recognize inventory? Let me just bring that thing in. Okay. Let's work on LIFO, FIFO, and weighted average. LIFO, FIFO, and weighted average. These three methods. Right? I hope you know that basic that this is the one that's allowed under only US GAAP, but other methods are allowed everywhere. So LIFO is more like a US thing. Now, let's say that this is what you've done during the year. You have opening quantity of 100 at 20 per unit. Then you make purchases during the year of another 100 at 30 per unit. Okay. Now you have sold 100 at whatever price. What I want you to do is I want you to find out what would be the COGS under LIFO FIFO weighted average. What would be the closing inventory under LIFO FIFO weighted average. Okay, get started. Opening quantity, we have purchases during the year. We sold 100 quantity. Figure out the COGS and closing inventory, please. Come on, guys. Last 2.5 hours in the session. Let's make the most of it. We've already worked really hard today. 2 more hours and you're going to sleep with a smiling face. Calculate COGS, calculate closing inventory under each one of them. Okay, here's how it works. Here's how it works. The way you're going to do the math is like this. You're going to say in LIFO, last in come first out. So whatever I purchase last is going out. So 300 is my COGS. In FIFO, whatever I purchased first is going out. So that's going to be 200. Weighted average, you hit the golden mean, it's 250, right? It's you do it on an average basis. Sorry, 3,000, 2,000, and 2,500. Now, closing inventory, whatever is left, right? So in LIFO, the last in first out is gone. So this 3,000 is gone. So you're left with 2,000 here. In FIFO, first in first out is gone. So you're left with 3,000 here. And here you're left with again a weighted average, right? That's how you want to do. That's how you want to do the LIFO and the FIFO stuff. Are you guys okay with this? Did you get this right? Give me a yes on the box if you're comfortable. Now, what we learn from this, I hope you've got this part right. This is easy, right? Now, what is important from an exam perspective is when I'm comparing LIFO and FIFO, when I decide to do that comparison, the way we want to do this is going to be like this. The way we're going to do this is a little bit like this. Let's assume that you're in a inflationary environment. Okay, you're in an inflationary environment. Then in an inflationary environment, what happens is the items that you've purchased last, turn out to be higher. So therefore, LIFO COGS becomes higher. LIFO COGS becomes higher. LIFO COGS is going to become higher. Therefore, LIFO closing inventory would be lower. Okay. Now, because LIFO COGS is higher, LIFO gross profit margin, GP, will become lower. I hope this is making sense to you. LIFO gross profit margin is going to become lower. Now, let's think of current ratio. Okay, let's think of current ratio, right? How do you calculate current ratio? You have current assets in the numerator, current liabilities in the denominator. So what happens is because your closing inventory is lower, your current assets are lower. So under LIFO, your current ratio will also become lower in an inflationary environment. Then what would be the impact on your, let's say, debt to equity ratio? So under LIFO, again, what's happening is, so let me write down inflationary and LIFO. Okay. So under LIFO, what's going to happen is your profits are lower. Right? Therefore, your equity is lower. Correct. And if your equity is lower, your debt to equity ratio is going to be higher. So there could be all these analytical type of ratio related questions asking you to compare LIFO and FIFO. You should be able to answer them. And if they ask you deflationary, exactly opposite of this. So for me, within inventory, this is one of my picks, asking you to compare the impact on ratio depending on whether you're going inflationary or deflationary type of environment. Okay, I hope you're comfortable with this. Now I'm jumping on to the next concept in the reading. Okay. Now let's jump on to the next concept, which is going to be on LIFO reserve. Now, here there could be some numerical questions. Most of the candidates struggle with this. This is not an easy part. but we have built a flowchart to help you kind of conceptualize this. The flowchart is like this. You have a row for opening, you have a row for closing, and it's connected by those LIFO cogs and FIFO cogs. Remember these questions that we did? Now let me show you how the whole calculation works. So imagine we have a opening LIFO inventory. Okay, that we add opening LIFO reserve. Okay, do you guys remember LIFO reserve? LIFO reserve is the difference between LIFO and FIFO inventory. And then we have a FIFO inventory here. Okay, this is also going to be opening. Now you want to write a row like this. Then you also want to write a row here which says closing LIFO inventory plus closing LIFO reserve is equal to closing FIFO inventory. Closing FIFO inventory. Now what you want to do is uh, you want to connect these opening LIFO reserve and closing LIFO reserve by, you want to connect this by delta COGS during the year. Okay. Now, what do you mean by delta COGS? That's the delta COGS as in not the increase in COGS, but the LIFO COGS minus FIFO COGS. It's kind of a strange flowchart, but it simplifies an extremely complicated topic for you. So you want to know this flowchart well because there could be questions. I'll give you an example. I will do it myself, but I'm still going to show you like the thought process here. Okay. So, so let's say we have data like this. Okay. So we have a 2001 data, and let's say we have a 2002 data. Now we have a LIFO inventory of, let's say, LIFO inventory of 5,000. We have LIFO inventory of 7,000. Then I have LIFO COGS, a LIFO COGS of 3,000, and I have 5,500. LIFO COGS of 5,500. Let us say FIFO inventory here let us say, had we used FIFO COGS, then my COGS would have been, let's say my COGS would have been 1,800. Okay, my COGS would have been 1,800, and let's say my COGS would have been 3,900. Okay, let's make this 4,000 round figure. Calculations would be easy. Let us say FIFO inventory here is 9,000, and the question says calculate FIFO inventory for 2002. Now, this question requires you to think quite a bit, like in terms of multiple formulas. Okay, now if I decide to do this orally quickly without making a use of the flowchart, here's how I'll do it. Okay, but the thing is, most of us, if you have not practiced it, you'll not be able to do it orally quickly. So the way I'm going to think of this is, first, I know my opening LIFO reserve. My opening LIFO reserve is 4,000, which is a delta of 5,000 and 9,000. Now, I want to add that by delta COGS during the year, and delta COGS during the year is how much? 5,500 and 4,000. So that's going to be 1,500. So my closing LIFO reserve, okay, is going to be 5,500. And then I want that difference between my inventories. So my closing FIFO inventory is going to be 7,000 plus 5,500. So it's going to be 12,500. Okay, that is a very fast way of achieving this answer, 12,500. But the thing is, most of us would probably struggle a little bit with this, at least initially. So I'm going to show you how to do this step by step with the help of the flowchart. With flowchart, it becomes a little more easier. So let me take a screenshot of this. Okay, in fact, let's plot the numbers here itself. So in this context, what is my opening LIFO inventory? So opening LIFO inventory is 5,000. What is my opening FIFO inventory? Opening FIFO inventory is 9,000. I'm just doing fill in the blanks. Okay. What is my closing LIFO inventory? Closing LIFO inventory is 7,000. Closing FIFO inventory, that's what I need to find out. Okay, just simple fill in the blanks. What is the opening LIFO reserve? What is the LIFO COGS for this year, the current year? Current year LIFO COGS is 5,500. What is my FIFO COGS for this year? FIFO COGS is 4,000. Can I calculate a delta COGS? Yes, as in delta COGS as in the differential between LIFO and FIFO. So that's 1,500. So what we've done is we've basically set up data for our flowchart. Okay, now what I need to do is just start doing the fill in the blanks work. So look at this. If this is 5,000, this is 9,000. Can I figure out what would be my opening LIFO reserve? Yes, my opening LIFO reserve here is the balancing figure of 4,000. Correct? Now 4,000 plus 1,500. Can I figure out what would be my closing LIFO reserve? Yes, closing LIFO reserve would be 5,500. And then 7,000 plus 5,500. What would be my closing FIFO inventory? It would be 12,500. That's the way you can do this with the help of flowchart. It's a little difficult. I've seen, over a period of time that no matter how much we practice, candidates still struggle with it. So if you're someone to whom this is coming naturally, do it. If you feel that this is too tough for you, let it go. All right, don't stress over it. Just figure out if you can handle it. If you feel it's too difficult, let it go. It doesn't matter. Okay, good. Are you guys comfortable? Like, do you think you've understood what I'm trying to do with this? Can you give me a yes, no, please? I wouldn't give this a lot of stars, to be honest. I mean, LIFO reserve as a concept is okay, but this calculation to me, uh, maybe, maybe it will come up, maybe it will not. I'm not really sure about that. I mean, so I will recommend, at this stage, a few days before the exams, if you have already studied this, then do this. But if you've not done this before, then it doesn't make sense. Then probably you don't want to do it. Okay. All right. So this is out of the way now. This is what I think is even more important. The next concept is LIFO liquidation. Okay. I want you to kind of know this concept really well. I will probably give it, 3 stars. I think this one is important. Now, what is LIFO liquidation? Okay. What is LIFO liquidation? If you're not in deflationary environment, okay, that means you're in inflation. If you're not in deflationary environment, and it seems unlikely in the US that we go in that territory, looking at how interest rates have been. So if you're not in deflationary environment and your LIFO reserve is decreasing, okay, these two conditions are made. That not in deflationary means inflationary, you're still in inflation, and even then your LIFO reserve year on year is decreasing. That type of situation could mean LIFO liquidation. Okay, and what happens in LIFO liquidation is, like, what is really happening? It is some sort of a manipulation technique It is some sort of a manipulation. It could be accounting manipulation. It could be manipulation. It could be company would get a one-time jump in numbers, one-time jump in profitability. Company could get one-time jump in profitability, but it will not be sustainable. You will not be able to sustain that. It will happen just once, but it will not be sustainable. Okay, this is referred to as LIFO, liquidation environment. And how does it happen? Like, how does company achieve that? They simply defer purchases. Okay, they simply defer purchases. So by deferring purchases, you end up accessing the old inventory, and that old inventory helps you reduce your COG a little bit. All right. Again, I know I don't have time to explain you the whole concept. When I did a actual class for this, I spent about 40-45 minutes just on this. Today, of course, it's a crash course. We can't do it. But this is what you need for the exams. Okay, I want you to listen to this very carefully. What is a LIFO liquidation? How do you identify it? You see LIFO reserve year on year is falling down. LIFO reserve is decreasing. What is the meaning of that? It could be a manipulation technique. Company can have one-time jump. Company can have one-time jump in profitability. And how are they having that one-time jump in profitability? Simply by deferring their purchases. Okay, that's how this is going to work out. So I hope you've understood this. And now the last part in inventory. And then, of course, we do smaller theories as well. But the last part in inventory is this section. This flowchart is important, so I'm going to bring it on your screen directly. Okay, so even your class notes, you will get access to this flowchart. Even if you don't have juice notes, that's okay for this particular flowchart. All right, let's see what's happening here. This is about inventory write-downs. Okay, again, this one is important. I'm giving you too many stars here because this is a probable area. Inventory is kind of the core of this reading. Even as an analyst, you need to be good with inventories. Let's see what's happening here. We have cost of inventory at 100. Okay, I'm just going to do the juice notes example directly. We have inventory that we bought at cost is 100. We're selling the inventory at 90. We're selling as in this current selling price of the inventory is 90. But if I sell it at 90, I have to pay commissions of 10 maybe. So that's my selling cost. But if I decide to buy the same inventory from the outside market, the replacement value is 95. And generally, when I sell this inventory, I try and maintain a profit of 20. Okay, so this data would be given to you in the question. Now, they will ask you whether you should write down the inventory. So IFRS and US GAAP is different. IFRS is very simple. Let's look at IFRS first. So what you do in IFRS, you compare cost versus net realizable value. What's your net realizable value? Selling price minus selling cost. Selling price is 90, selling cost is 10. So this is 80. So 100 versus 80. Now, is this value lower? Yes. So should we write down? Yes. Write down how much? Write down should be how much? Write down should be worth 20. Correct? Because the delta is 20 here. So as far as IFRS is concerned, it's very, very simple. Simply cost versus NRV, end of the story. Are you allowed to write up subsequently? Are you allowed to write up subsequently? The answer is yes. To the extent of write-up is allowed. Write-up is allowed to the extent of previous write-down. Please remember this. IFRS is generally a little liberal. It will let you reverse your losses to the extent of previous losses booked. Okay. US GAAP, slightly more complicated. You do something called as cost, okay, versus market or replacement cost. These are interchangeable words. Now, what does it mean? So your replacement cost has an algorithm. Okay, so look at this. Cost is 100. Your replacement cost has to fall within a logical price band. So there's a condition on this replacement cost. It cannot be a random number. It has to fall into some bracket. What is that bracket? Net realizable value minus normal profit margin. So we had a profit margin of 20 here. So we have 60. Or net realizable value 80. So the condition is your replacement cost has to fall within these two. If not, you pick up the boundary. So here you pick up 80. And then what is the write down you're going to have? Same write down. So the write down here is again going to be 15. Sorry, write down here is going to be 20. And is the write up allowed further? No, not allowed. So this is your inventory measurement technique. Have you understood this? So remember IFRS, cost versus NRV. In US GAAP, cost versus market. But market needs to fall into a price band. What price band? NRV minus NPM or NRV again. Let me give you one more example. Maybe you feel comfortable. Let's say we have a cost of 500, and let us say we have a net realizable value of 400. Let us say we generally have a normal profit margin range, normal profit margin of 50, and let's say my replacement value is, let's make up, let's say 420. Okay, what did you do in IFRS? Look at this. In IFRS, it's very simple. You compare 500 with the 400, okay, which is the net realizable value, and you would say, fine, you know what? Let me write down of 100. Let me write down worth 100. Okay. In US GAAP, it's different. In US GAAP, it doesn't work that way. I hope you guys are listening. Please, everyone, this is important. There could be potential questions here. US GAAP. Come on, we're in the final 1 hour, 30 minutes of the class, or little less than that. Let's make the most of the time that we have. In US GAAP, what we do is, we will say 500 versus the replacement value of 420. But there is a check on this number. You just don't accept that 420 blindly. You ask yourself, is it within a reasonable price band? Is it within a logical price band, 420? What is the boundaries of that price band? On the lower side, on the higher side, it is NRV. On the lower side, it is NRV minus the profit, 350. So your replacement has to fall between the two. Is it falling between the two? No, it's falling outside. So what do? You select the upper bound. Okay, you select 400 here, and then you write down worth 100. You write down worth 100. Now, what if 420 was given as 380? What if 420 was 380? Then can you use 380? Yes, because 380 is between that. Then write down would have been 120. What if 420 was 250? Can you use 250? No. Then you use 350. Then you use the lower boundary. The idea is your replacement falls in a range. It has to be between that range. What is that range? What is that range? That range is your NRV minus net profit margin, or NRV. Net realizable value or net realizable value minus the normal profit margin. Have you guys understood this now? So on one side we have NRV, on one side we have NRV minus normal profit margin. It has to be a range of that thing. Okay, I'm leaving this flowchart in your notes. Okay, let me just also erase this. I'm leaving this flowchart in your notes. Read through it carefully. Read it once or twice. You'll be okay with it. All right, so all the major part of inventory we've done. Let me just make sure. Let me just make sure that we are uh, covering theory as well, so that we don't miss on the theory parts. Let me check here. A lot of questions on your exam are going to be theory, okay, but it's going to be conceptual theory. So if you understand, I'll just pull that mic a little closer to me. If you understand like what's the background logic, it becomes a little easier. So uh, this part is okay. This part is okay. Inflation, deflation, we've done. Is one concept left. This is also important. We have something called as uh, we have something called as the the periodic inventory management system versus the perpetual inventory management system. Okay, it's theory concept, but you want to know it. Now, what does it mean? I'll give you a super quick example. Okay, let's say on 1st of January. On 1st of January, I have 100 units which I purchased at rupees 10 per unit. Okay, Indian rupees 10. Then on 25th of January, I purchased another 100. Uh, I purchased another 100 at a quantity of, let us say, 15. Then on, let's say, uh, somewhere in between, let's say on 7th of January. Okay, on 7th of January, uh, I sell sold. I sold. Sorry, wait a minute, guys. I have to write one more thing here. Okay, on 7th of January, now 27th of January, I have sales of 100 quantity. Of 27th of January, I have sales of 100 quantity. And on 1st of Feb, I have another purchase of 100 quantity at 20. Okay. Now, let's do periodic first. Now, in the memory technique is that the way I want you to think of this, in periodic, your accountant is one big lazy fellow who doesn't want to do accounting the whole year. He just wants to do accounting. He just wants to do accounting at the end of the year. Okay. So periodic accounting happens at the end of the year. Whereas perpetual, your accounting will happen on the date of transaction. On the date of transaction. Okay. So in perpetual, just think that your accountant is on Red Bull. Here your accountant is on Red Bull, and here your accountant is on substance. You figure it out. Okay, here your accountant is like how we are right now. Here your accountant is where energy is completely drained out. He doesn't want to do it right away. So so again, let's focus. Okay, let's make the most of the time that we have. Now let us calculate COGS for each one of them. We'll just do LIFO and FIFO. Let's do periodic LIFO. Okay, periodic LIFO. Now, what quantity we've sold? We've sold 100, last in, first out. You guys tell me, what would be his COGS? You guys tell me, what would be COGS? The periodic LIFO, what would be COGS? What would be COGS? Last in, first out, right? So remember the sales happened on 27th of January. What do you think should be COGS? His COGS, you'll be surprised to know, would be 2000. His COGS would be 2000. This 100 into 20. His COGS would be 2000. Okay, this is LIFO method, last in first out. Now you would say, Utkarsh, how is that possible? It has to be 1500. No, even though the inventory was purchased, see, from an accountant perspective, he's doing accounting at the end of the year or at the end of the season, whatever is the accounting period. So he doesn't worry about the dates. He just looks at the last purchases and he passes the entry. Now, can you tell me FIFO COGS here? If he's periodic and he's doing FIFO COGS, what would be the entry? FIFO COGS, what would be the entry? First in, first out, right? So you want to do 1000 into 10, isn't it? You want to do 1000 into 10, it would be 1000. Okay. Now, let's jump on to perpetual. Okay, let's jump on to perpetual. Let's go to LIFO. LIFO COGS. Okay. Now your accountant is hyperactive, right? The Red Bull is working for him. My coffee stopped working for me now. I think it's my throat primarily. But your accountant is hyperactive. Okay, your accountant has to pass the entry on this date itself. Now, if he's passing the entry on 27th of Jan, he doesn't even know that there's going to be a purchase on 1st of Feb, right? He doesn't even know that there is going to be a purchase on 1st of Feb. So, so when he does LIFO, he will say, my last purchase is 25th of January. So this is going to be 1500. This is going to be 1500, correct? And when he's doing FIFO, my first purchase was here 1000. What I want you to notice here, okay, and that's very important. I don't want you to lose on this. I want you to notice, I want you to observe this, and this is a potential theory question for us. We don't want to let it go. FIFO COGS and periodic and FIFO COGS perpetual is same, right? This is a theory question for me. If I were to write your paper and I really wanted to test candidates' knowledge, I would test them on this concept, right? Because you require slightly deeper understanding to answer this. That when you're using periodic or perpetual, the LIFO might get you different answers. But if you're using FIFO, the answers are going to be same. Okay, it could be a trick question on the exam. Know this, that periodic or perpetual, if you're using FIFO, doesn't matter. The answer is going to be same. But if you're using LIFO, the answers could be different. I hope you've understood this. Come on, show me some Josh now. At tops, last 1 hour of the class, last 60 minutes. Let's make the most of our time. Inventory is done. Now just we're left with smaller areas. We'll be able to wrap them up fast. Show me some Josh now. Give me some yo-yos. Jos. Okay, good. Let's maintain the momentum then. Yeah, I know. Yo-yo would be replaced tomorrow. Okay, let's go. Let's finish this. So inventory is over. Inventory is over now. We've covered most of the important concepts. Then there's smaller theory parts. I want you to look them carefully yourself. But we've touched on main topics. Let's start with long-lived assets. Okay, again, I'm going to optimize on the time. By the way, LIFO to FIFO conversion, if you guys have done this before, then do it. If you've not done this before, drop it. Okay. If you have done LIFO to FIFO before, then probably just go and revisit my video. Otherwise, drop it. It does not make sense. But I'm going to jump on to long-lived assets. Let's start. Long-lived assets. Long-lived assets. Again, I'm going to first do the important concepts and then we'll start doing the smaller sections. Luckily for us, all key areas we've already touched on. Here is my pick in the reading. Let us say we have acquired a new PPE. Let's say we've acquired property, plant, and equipment for 1,000. Okay. The estimated useful life, let's say is 5 years. Estimated salvage value is, let us say, estimated salvage value is, let us say, 200. What I want you to do is, I want you to calculate depreciation for year 1 to 5 under straight line method and double declining. I know it's a very basic question, but I've seen people struggling here, okay, with double declining, and these are probable things on the exam. This is my 1 star here, or maybe I'll go 2 star with this. The double declining balance part. I want you to be able to do this correctly. Get started. DDB. Okay. I'm going to do this for you. Very simple. Straight line method. Your depreciation is same every year. How do you do the depreciation? 1,000 minus salvage value 200 divided by life 5. So 160. Double declining balance. First year 1,000 divided by 5. 1,000 first year, 1,000 divided by 5 into 2. So 400. Second year 600 divided by 5 into 2. About 240. Third year, how much are we left with? 360 divided by 5 into 2. How much is this? 72, 144. How much depreciation have we charged over? 640, 680, 780. Fourth year, yeah. Let's look at the total depreciation so far, because I can't go beyond 800, right? So my total depreciation so far, 640, 680, 684, 684. Fourth year, I will do the remainder 16. Fifth year 0, or 8 and 8. Got it? Understood? Important. You need to be able to do this properly. Are you okay? Comfortable? Good. Good. Okay. Y multiplied by 2, it's double declining. SLM इस पे तो बंधा है yo, sir, we cannot decrease the value beyond 200, is it? Yes. So you have to stop. You cannot allow the value of the asset to fall below 200. Okay. So up to first 3 years, I followed the formula. But in the fourth year, if I follow the formula, I'll end up charging too much of depreciation. So I'm just going to do remainder 16. Now there are two ways in which I can do it. I can go 16.0 and I can go 8.8. Both the methods are acceptable. Okay, either ways. So I don't think they will test you on 4 and 5. Okay, I don't think they'll test you on 4 and 5. You probably have to do, or if they test you on 4 and 5, they'll tell you which method to use. If nothing is mentioned, which is very unlikely, you use this. But this is also acceptable. Your curriculum says that. So either way, it's fine. All right, DDB is out of our way. Let's jump on, guys. Impairment we've already done. Revaluation we've done. This one is again, this one is extremely important. The next one. And I'll give you a practical example also. It will help you recall better. The impact of capitalization versus expensing. It's not a calculation, but this is an important part. Okay. It is so important that I'm going to give it as many stars I can give. How many have I given? 5, 7. So out of 5, I'm giving it 7. Okay, it's that's important. This thing is important in practice, but this thing is also important in theory. I mean, if see, like I've used this knowledge extensively when I analyze companies. Okay, my most recent example where I had to use this knowledge. There's a company in my portfolio called Tejas Network. It's a company which kind of builds the backbone for your telecom network. It's a very small company. Now this Tejas network, this Tejas network, this is so what this company does in a very simple language is when we use our mobile phones, right? There's a lot of communication happening between towers and the centers. So it kind of builds that communication backbone, and they spend a lot of money on R&D. Okay, so they have expenditure on R&D. Now, what I learned is when I was researching the company, I learned that those guys capitalize their R&D expenditure. Okay, and for me that came as a big surprise because as an investor, a company capitalizing R&D expenditure is a red flag. But then I realized that they capitalize and then they amortize in 2 years. So then I was like, okay, fine. It's still not the best practice. It's not the best practice, but it's fine. At least something is happening. So they amortize over a period of 2 years. So this part that way is very important. And in the juice notes, we have built a very beautiful table for this. Okay, my guess is that on the exam, you might end up doing one of these items. Okay, you might end up doing one of these items that I'm going to put on my screen now. Now, let's do it this way. Let me hide these. So let me hide this and let me hide these ones. And let's see if we can answer them ourselves. Okay, so that we don't cheat. I mean, there's no point cheating. You want to learn to think about it. Okay. So imagine, you guys help me with this, okay? Everyone. We are, I think last 30, 40 minutes, that's it. We're going to finish this very fast. Come on, let's be focused. Impact of capitalization. So there is a company which has capitalized, there's a company which has capitalized as against expensing it. Capitalizing means creating asset. What do you think will happen to total assets? What do you think will happen to total assets? What happens to total assets? Goes up. Easy, right? Because capitalization means creating an asset. So total asset goes up. How about total liabilities? Nothing. It's got nothing to do with liabilities. How about equity? So if I'm capitalizing it, then my expenses are lower, my profits are higher, my equity will go up. Will it be the same case in subsequent year? Yes. And my profit will remain higher because of capitalization. How about my net income in the first year? Of course, higher. I'm capitalizing it. But how about subsequent years? Lower. Why is that? Because of depreciation. Because of depreciation, this becomes lower. How about my cash flow from operations? So I'm capitalizing it. So I'm deducting it from CFI, correct? That means my CFO becomes higher. Why is that? Because the expensing firm deducted it from CFO. I am not deducting it from CFO. So CFO goes up. I'm deducting it from CFI. So CFI goes down. CFF no impact. Total cash flow no impact. Interest coverage, EBIT. Now EBIT in the first year, my EBIT goes up higher. Subsequent year, EBIT goes down because of depreciation, lower. Debt equity ratio, equity is higher. This is lower. Done. You should be able to think and answer this. If you're able to think and answer this, phenomenal. You've really reached a level where level 1 exam is going to be easy for you. If you can think and answer this. Comfortable with this? Good. If you're not, spend some time. Okay. Like today, if after the session, if you have still a little bit of entry left, please spend some time. Make sure you work through this well. Okay. So I'm building on to the momentum now. This is done. Revaluation we've already done. Good for us. Impairment we've already done. So that's good. De-recognition is not worth our time here. The straightforward stuff. Investment PP theory questions. Investment PP for theory questions. Let's have that in our notes. Let's make sure we know this part well. Let's see what we have here. Okay. So you know what PP is. You know what investment PP is. That part we've done. You're holding that property. You're holding that property for earning, capital appreciation. US GAAP does not. IFRS does. Okay, so in US GAAP, we don't have a concept of investment PP. That could be one theory question. Now remember, in IFRS, okay, you get two choices. You get a cost model versus a fair value model. Okay, now this fair value model is same as your revaluation model that we studied earlier. Remember, revaluation model, show everything at fair value, show everything at, there's a parallel class happening on the chat box. Guys, listen to me. Whatever you're struggling with, type it in the comments later on. Someone from my team will help you understand that better. Even other candidates will help you out there. Okay, but when I'm trying to explain something, I want you to focus on this, please. So cost versus fair value model. This fair value model is same as the revaluation model. Okay, but the difference is, remember in revaluation model, if we had a gain, we took that to OCI, and if we had a loss, we took that to income statement. Here what we do is, even the gain we take to income statement. Okay, so look at this. Fair value model is same, except even the gains you take them to income statement. Just remember this small theory factoid. Maybe it gets tested. Maybe we get that extra point here. Okay, maybe that's our competitive edge over other candidates. So in a fair value model, even the gains go to income statement, whereas in revaluation model, gains went to the OCI. Okay, and with this, this reading is also over, and we are ready for income taxes. So what I will do is, I will do income taxes with you, and after that, I will do a small concept for 5 minutes, and then we will close the session. Okay, then we have done a good job. We've covered good grounds today. Let us focus on income taxes. Are you guys ready? Sorry, I forgot. Income taxes, my mistake. Then a break. Then we'll do bond liability and leases. Okay. Uh, and then we will do that small concept, and then we will close the session. Paris, you're persistent. Yeah, it remains on YouTube. We will go early. Let's finish it. If you started it, let's finish it today. It's fine. It's going to trouble us a little bit, but we'll sleep with happy faces. Maybe sore throat, but happy face. Let's try and finish it. And see, the videos will remain for you on the YouTube. I know some of you are tired. Uh, some of you are tired. What? Some of you are tired. What you guys can do is later on you can also, come and revisit some of these videos. In fact, I'll recommend you to watch these videos uh, one more time in the final week before the exams, because we are hitting all the key concepts, right? We're hitting all the main concepts. If you go through them, you're going to feel very comfortable. All right, income taxes. Let's start. Uh, I'm going to give you probably 3 or 4 questions, and with that, income taxes would be done. Okay, 3 or 4 questions, and you'd feel very comfortable with taxes. Someone WhatsApped me yesterday saying income taxes is difficult. It's not. It's not. Just do these 3, 4 examples properly, understand the concept, you'd be able to solve questions very easily. Here's your example number 1. Income tax. Let me just delete this unnecessary stuff. Let us say you purchase an asset, okay, at 100. Now in the accounting, as per accounting standards, you're allowed to charge 20% per annum depreciation. As per the taxation law, the depreciation would be, let's say 40%, 20%, 0. Okay. Tax rate is 30%. Assume sales of 100 every year. Assume sales of 100 every year, and no other expense apart from depreciation. No other expense apart from apart from depreciation. By the way, is my audio okay, or should I increase the volume? Like, I cannot increase my volume, but I can change settings on my mic. My volume is at threshold now. Is the audio all right? Okay, let me know. Okay, good. Good. So this is the data. Now, very nice. Here's what I expect you to do. What I expect you to do is I want you to build a schedule of accounting book, like the book that you prepare as per accounting standards, versus a book that you prepare as per taxation laws, so that you can figure out what is the DTA and DTL every year. Okay, so that's my question number one. This will take you time, but once you do this, you would start feeling very confident about this whole tax business. Second, uh, after the part B, second, figure out what is the carrying value. Figure out what is the carrying value and tax base every year. Okay, and build an expression, a shortcut. Build an expression, a shortcut to estimate DTA or DTL. Now, there's a direct formula, right? Some of you might remember it. I taught you this in the class, and of course, I'll be showing it to you one more time today. See, once this is done, then build an expression for determining income tax expense using build an expression for determining income tax using taxes payable and DTA DTL, deferred tax asset, deferred tax liability. D, if tax rate goes up, what happens to DTA DTL? That's it. 4 questions built into one. You do this well, you're comfortable with this reading. Okay, you should be able to answer most of the questions on the exam very, very easily. I'll give you 5 minutes to play around with this. I doubt like how many of you would have the energy to do it by yourself, but make an attempt. And if you feel that it's not happening, let me know. I'll do it for you. Start. Guys, are you making progress or you want me to solve this? Yeah, I think, we can save time. Is it okay if I solve this now? That's a good one. Sarah is saying, I wanted to do it. My body and brain both said no. Okay. Let me solve this. Let me solve this now. It's 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 easy, and the thing is, if you learn taxes like this, right, it becomes very easy. Like if you learn to answer these 4 questions, more or less, we've covered the whole taxes thing. So let me quickly start doing it for you. Right, so let's build a nice table. So what I have to do now is divide the book in 2 parts. Okay, for simplicity, I generally call them as tax book and accounts book. I think I just find it a little easier to think of them like that. So this is year 1, year 1, 2, 3. Sorry, presentation is taking a little time, but it will be worth it once we finish. 4, 5. All right, so let's start. What I'm going to do is on the left hand side, I'm going to plot, I'm going to do calculations in something called as an accounts book. Okay, this is my own term. I mean, the idea of this is we are maintaining this book as per taxation laws, right? That's how I want you to think of this. That we're building the book as per accounting laws or accounting rules. And here we will build the book as per tax laws. So I'm going to call it as tax book. Okay. And this is my year 1. So this is my year 1, year 2, year 3, year 4, year 5, right? 5 year. Now first, sales. So we are going to assume sales of 100 every year. So we assume sales of 100 every year. Then depreciation, because depreciation is the only expense, right? So what's the depreciation? Let's look at that. 20% per annum for 5 years. What is the value of asset? The value of asset is 100. So 100, 20%. How much is the depreciation? 20 each. So depreciation 20, 20, 20, 20, 20. You deduct depreciation for each of the year. What are you left with? You're left with profit before taxes. How much is that? 80, 80, 80, 80, 80 each of the year. Let's calculate the tax expense. Okay, tax expense. How much is that going to be? So my tax rate here is 30%. So if my tax rate is 30%, our trick shows for each of the year, my tax expense in my books of account goes out to be 24. Let's look at taxation book. Again, year 1, year 2, year 3, year 4, year 5. Sales. Now, here the sales are assumed to be same. 100, 100, 100, 100, 100. Depreciation Tax depreciation is going to be different. I need your help now, please, everyone. Depreciation for the first year, you tell me how much depreciation should I take for the first year? So depreciation for the first year, we take it as 40. This is called as a temporary change. Remember this word, temporary change. That's the reason why we're going to have, uh, that's the reason why we're going to have this DTA or DTL, whatever we're going to bill now. Depreciation 40, depreciation 40, no, 40, 40, and then here we do 20, right? And then we do 0, 0. The depreciation is different. Then we do profit before taxes. Profit before tax 60, 60, 80, 0, 0. Okay, profit before tax 60, 60, 80, 0, 0. Let's calculate tax payable. Okay, taxes payable. Like how much amount do I have to pay? So again, 60 multiplied with 30 percentage. Okay, please help me out. 60 multiplied with 30 percentage, 1.8. 60 multiplied with 30 percentage, 1.8. 24. I made a mistake here. This should be 100, 100. So this goes 100, this goes 100, and this becomes 30, this becomes 30. All right. Now guys, what happens is, look at this carefully. What is happening here is in the first year, my accounting book says, my accounting book says that depreciation is 24. Okay. But taxes payable, or the taxes that I've actually paid, are 18. So the question that you want to ask yourself, and it's a very important question, and I want you to listen to this carefully. Okay. The question that you want to ask yourself is, if my tax expense is 24 and if I'm paying 18, am I paying more or am I paying less, right? That is the determinant here. Okay, that's the determinant here. That you want to think from the tax book and you want to ask yourself that, am I paying more or less? This kind of simplifies everything for us. Because if you're paying more than, and when I say more or less, compared to what? Compared to accounting. So if you're paying more, you end up creating a DTA, deferred tax asset. And if you're paying less, then you end up creating a deferred tax liability. Correct? It's that simple. So if you look at this now, we have to create a deferred tax asset or a deferred tax liability in this book. Okay, so deferred tax asset or liability. For the timing, I'm writing this as liability. So first year I was supposed to pay 24, but how much did I really pay? As per my taxation law, I paid 18. So I paid less. If I pay less, I create a deferred tax liability of 6. Second year, the same story repeats. I pay less of 6. So less of 6 last year, less of 6 this year. How much? 12. So 12 here. Third year, it's same. It's same. So this gets carried forward. 12 remains a liability as it is. But see what happens next year. Next year, it gets reversed. Next year, I was supposed to pay 24, but how much do I really pay? 30. Now I'm paying more. Okay. Now, when you pay more, at times you're creating a DTA or at times you're reversing a DTL. In this case, जो पुराना उधारी बाकी था वो मैं pay कर रहा हूँ. In this instance, whatever was I was supposed to pay earlier, I'm paying that now. So now what happens is my DTL from 12 becomes 6. Okay, because we are paying 6 extra, and in the final year you do the same thing. You pay 6 extra and your DTL becomes 0. This, by the way, we called it as reversal in the class, if you guys remember it. It's called the reversal of DTL. At some stage it reverses. The funny thing that you would see is, if I take vertical totals of this column, my sales here over the period of 5 years is 500. Total depreciation is 100. Total profit before tax is 400. Total taxes paid, Chatrik Bara, is 120. My sales here in this book is 500. The total depreciation is 100. The total profit before tax is 400. And this is 120. So at the end of the fourth year, right, the amount that I've paid in either books is same. Like the amount that I have on a totality basis is same. It is just the timing difference. Because I got depreciation faster in the tax book and slower in the accounting book, it created a difference. That's it. Okay, this is the whole business of deferred tax asset and deferred tax liabilities. So what you're going to remember for the exam, we create deferred tax asset and deferred tax liabilities because of temporary or timing difference. Okay, uh, temporary or timing difference results into creation of DTA or DTL. Do we create them for permanent difference? Do we create them for permanent difference? The answer is no. You don't create them for permanent difference. You create them for temporary differences. You create them for timing differences. So this answers first question, which is the accounting book versus tax book. Now, second one, carrying value and tax base for each of the year. So what does it mean? Carrying value means as per your asset, value of your asset as per, tell me which book, value of your asset as per which book, value of your asset as per accounts book, right? Books of account, that's your carrying value. What is your tax base? Tax base is value of your assets as per taxation laws. So that's your tax book. Okay, so let's look at this. Accounts book, tax book. This is called carrying value. This is called tax base. Now, year 1, year 2, year 3, year 4, year 5. Now, look at accounts book, what you did. Accounts book, you charge depreciation of 20 every year, correct? So, 100 minus 20, value of asset must have got 80. Value of asset must have got 60, 40, 20, 0. Deduct 20, 20, 20 every year, simple. Look at tax book. First year, you charge depreciation of 40, so your asset must have become 60. Second year, you charge 40 more, so it became 20. Then you charge 20, it becomes 0, then 0, then 0. Okay, now here's a beautiful trick. Calculate the difference between the two. Don't worry about the sign, take an absolute value. Okay, calculate an absolute difference. So difference is 20, difference is 40, difference is 40, difference is 20, difference is 0. Now take that difference, okay, and multiply that with tax rate. Take that difference and multiply that with tax rate and see magic happens. When I take the difference between carrying value and tax base and multiply that, see what happens. 20 into 30%, 6, 40 into 30%, 12, 40 into 30%, 12, 20 into 30%, 6, 0, 0. And you'd be happy to know that this number is nothing but your DTL, deferred tax liability. Make sense? Do you agree with this? So that's your shortcut. What is your shortcut? The second formula in this reading, the kind of one of the main key formulas. There could be, very easy to do theory questions on this. What you need to do is take the difference between tax base and carrying value, and take that difference and multiply that with tax rate, and this will give you your DTA or DTL. Now, how to determine whether it's a sorry, how to determine whether it is a DTA or DTL. So simple logic, think from tax book. Okay, think from tax book perspective. Okay, let's say you have an asset and your asset tax base is lower. Now, what do you mean by tax base is lower? Value of asset is lower. That means depreciation charged in the tax book must have been higher. Now, depreciation charged in the tax book is higher, which means my profit in the tax book must have been lower. And if my profit in the tax book is lower, that means I have paid less. And if I have paid less, then what is it? Is it my asset or is it my liability? If I have paid less, then it has to be a deferred tax liability. Look at this logic, see if it works here. Your tax base is lower, right? It creates a deferred tax liability. So if you think from tax base perspective, you don't have to remember the direction of the formula. just think from the depreciation context. It becomes a little easier. All right. So I hope you are okay with this also. That answers second part. Now, third part, income tax expense. Income tax expense. So here's the logic. Income tax expense, that means accounts book. Your formula is taxes payable plus minus. Okay, taxes payable plus minus. Now, what is a plus? When deferred tax liability goes up, that's a plus. Deferred tax asset goes down, plus. Deferred tax asset goes up, minus. Deferred tax liability goes down, minus. What is the memory trick here? The memory trick here is, for asset, we kind of go in an inverse way. What do you mean by inverse? When the asset goes up, minus. When the asset goes down, plus. For liability, we go the direct way. Direct way means when liability increases, plus. When liability decreases, minus. Okay. Now, if you keep this in mind, then look at whether this table works for us. Okay, let me take a screenshot of this and show it to you. Okay, so see how beautifully this thing works. Let's say we want to calculate this 24. Okay, we want to calculate this 24, but we don't know anything on this side. Okay, except the liability part. What we can always do is we can use this formula. We can say taxes payable 18 plus my deferred tax liability went up by 6. So my DTL went up by 6. Correct? My deferred tax liability went up by 6, 24 in the first year. Okay, does it work in any other year? Yes. Look at this. If I want to calculate this 24, I can start with this 30. So I can do 30. And this time my deferred tax liability went down. So minus. Deferred tax liability went down by 6. So from 12, it came to 6. So 24. So that's your third formula in this process. Okay, that's your third formula in this process where you can simply build a DTA DTL relationship. Okay, with the help of that formula. And the last thing, if tax rate goes up, what happens to DTA or DTL? So when the tax rate goes up, both DTA and DTL will increase, and they will increase proportionately. So you should be able to do some basic maths there. Now, what do I mean by that? Let's say if tax rate is 20% and your DTA is, let's say, 500. Okay. Now, if tax rate changes and becomes 40%, what would be the value of DTA? The proportionate calculation works. So you can do the cross multiplication, you would get 1000. So this calculation is acceptable. Are you comfortable with this? Like, is this coming back to you? Do you remember that we've done this, and are you feeling comfortable with this type of stuff? Current, I did proportionate calculation. So for 2500, right? So how much for 40? You can do cross multiplication also, like this. Put 20 in the denominator. So even that works. Cross multiplication. Okay. Then few more concepts. Okay. Few smaller concepts. This sentence is again. This sentence is again important. Tax base. Tax base for provision related liabilities, like for example provision for bad debts, provision for doubtful debt, provision for, you know uh, let's say provision for uh, warranty, guarantee, anything. So tax rate for provision related liabilities, unless otherwise mentioned, is going to remain zero. Why? Because generally Income Tax Act will not allow you to record expenses unless and until you've actually incurred them. Okay. So tax base for provision related liabilities will be zero. Remember this part. Then we have a concept called valuation allowance here. Okay, that's again a potential theory question for you. Now, how does valuation allowance work? It's a easy concept. I'll show you how it works. Say that you have a deferred tax asset. Okay, it's a balance sheet. Let's say this is the asset side. Okay, you have a deferred tax asset of 1,000. Now you figure out for some reason you will not be able to take benefit of the whole 1,000. You figure out that maybe in future 200 will not reverse. Will not reverse means you will not be able to take benefit of it. Okay, maybe 200 will not reverse. So what do? You create a deduction here. You say fine, a contra account. Let me create a valuation allowance. Let me create a valuation allowance of 200. And when you create a valuation allowance of 200, you're left with 800. What is the second entry of this 1,000? The second entry of this 1,000 is, sorry, second entry of this 200 is you take this to P&L account. So you go to your income statement, and in income statement you show an expense. What is it expense? Expense is that valuation allowance, and how much is that going to be? That is going to be 200. Okay, so when you feel that DTA will not reverse, you will not be able to take benefit of the DTA. That time you want to deduct those type of expenses. Hopefully you've understood this. And then there is one more last concept. Okay, we are almost there. The last concept is for analytical purposes. For analytical purposes. For analytical purposes. Okay. For analytical purposes, if you have a DTL, and if that DTL is expected to reverse, if that DTL is expected to reverse, then you're going to treat that as a liability. But if it is not expected to reverse, if it is not expected to reverse, then you're going to treat that as equity. Okay. Now, it's very rare that it will not be expected to reverse, but if that happens, remember I gave you example of you taking a bank loan, and suddenly the bank manager tells you it's fine if you don't pay it, right? Remember that example we did. So if DTL is not expected to reverse, you treat that as equity, and if it is expected to reverse, you let it remain as liabilities. Okay, easy theory points on the exam. You don't want to lose on these easy theory points. And then there are a few small concepts that you can look through the juice notes. Good. Comfortable? Okay. So what I suggest is, and I know you guys don't want to do it, what I suggest is take a small break. Okay. uh, 10 minutes. It's not great session yet. I know, don't pressurize me like that. Please, last 30 minutes, let's finish this. let's get let's finish this properly, so that tomorrow then we don't have to worry about FRA, then we can attack a new subject. So here is what I suggest. Okay, here is what I suggest. We will take a small break, 10 minutes. Okay. And that this break is as much for you as much for me. For you, maybe, do something. I just need to rest my throat a little bit, so that I'm doing it at full intensity. And then after the break, we would enjoy that liabilities reading. And I have to do DuPont. Yes, Omkar. So we will enjoy the liabilities reading. We will do DuPont, and then we will say good night, and then we will get done. We'll be done with the day. Okay. So 10 minutes break, come back, and let's get done with it. Come on, last 30 minutes. Let's make the most of this day. Don't say bye. Please come back. 10 minutes. Ready to start? This is reminding me of the uh, days in which, like early days of my teaching career, when I started teaching. That time I used to do like a small group, right? We were 6, 7 people, and we were just trying to have fun with the syllabus. So we used to do the whole night sessions. We like so start at 8:30 in the night, and then used to go on till mornings. Okay. All right, let's start. Let's start. Thank you, Anisha. So now the last few concepts. I mean, the last reading and then few smaller concepts. So now we work on accounting for long term accounting for long term liabilities. I'm not going to rush through it. We'll do justice to the topic. It's an important one, and we'll go through it. We'll enjoy, but we should be able to wrap up in 20-30 minutes. I know you guys are tired, but it makes sense to just finish it properly so that you feel well prepared for this section. There would be 1 or 2 questions from this reading. Three parts to this reading. We have to work with how do you do accounting for bonds. We have to work with how do you do accounting for leases. This area is new in the syllabus. There has been a lot of changes in this section. So uh, this area we'll have to do carefully. I think there could be some theory questions that show up on the exam. Okay, because there have been so changes, and these changes have been widely talked about. These changes have also made a lot of difference to how financials are prepared. So we'll spend some time on this. And then what? Then we have to do a little bit of theory on your pensions. Okay, so that's roughly the 3 pieces that we have in this reading. Now, I'm going to get started with bonds. And bonds is easy. Bonds is straightforward. Here's the sentence that I want you to remember. Value of a bond liability. Okay, value of a bond liability in books of account is present value of future cash flows discounted at YTM at issuance. We are not calculating current market value. We are calculating the liability that I should be showing in my books. And for that, I don't use current YTM. I use the YTM at issuance. Okay. So this is something that you're going to remember. Now, there are 3 things that play out here. If you remember, I gave you a trick to handle this. So you have some sort of a upward sloping structure, you have a flat structure, you have a downward sloping structure. Now, typically, if you have issued a bond at a discount, that bond will behave in this fashion. Okay, so bond liability will increase year on year basis. If you have issued a bond at a premium, the liability will behave in this basis. And if you've issued a par bond, then your liability would be like this. Now, if you remember these 3 graphs, most of the questions on bond liability could be answered. For example, number 1, the interest expense. In fact, first, bond liability. Okay, bond liability. It will increase year on year. Look at this discount bond. It will remain flat. It's a premium bond, so it will decrease year on year. Okay, so as you go downwards, your bond liability will decrease. Second, how do you what happens to your interest expense? Interest expense increase year on year. This will remain flat. This will decrease year on year. Easy theory questions to be picked up. Okay, straightforward questions. Number 3, let's say we have how do you calculate interest expense, right? Interest expense calculations. So first method is opening liability into YTM at issuance. And does it work everywhere? Yes. Opening liability into YTM. This is called the effective rate method. Opening liability into YTM. Okay. But you have a second method as well. And what would be that second method? That second method would be coupon paid plus discount amortized. Okay. Here we will just have the coupon. Here we will have coupon minus the premium amortized. In case of a premium bond, it goes minus, it goes plus. Now, fourth, here the coupon amount is going to be lower than the interest expense. Okay. Here coupon amount is going to be same as the interest expense. Here coupon amount is greater than interest expense. If you have this conceptual framework, right? If you know these 4 points, I think you've scored yourself 1 potential point on the exam. Okay, because this is how theory question could be structured around. Now they might not ask you directly bond liability, but they'll probably ask you something like let's say debt to equity ratio. Okay, so they will say you've issued a bond at a discount. What happens to your debt equity ratio over a period of time? So your answer is it simply increases. Let's do a super quick numerical. I want you to do this. Let's say we have a bond with a face value of 1,000. Let's say we have a coupon rate of 10%, a maturity of 5 years. And let me make this a discount bond. Let's keep YTM as 15%. Okay, what I want you to do is calculate bond liability every year. Okay, calculate interest expense every year. Interest expense every year using both the methods. Which 2 methods? The opening liability into YTM method, YTM at issuance, or coupon plus discount method. All right, get started. Let's see if you can handle this. I'll wait for a couple of minutes. Please try. Otherwise, then I'll do it. Yes, Rajesh, you're correct. Bond liability is your carrying value. You can, Panthini. I just prefer TVM row because it's easier and faster rather than making it so complicated. But yeah, even amortization box. It is amortization. So it's the same thing. Rishikesh, for the US bonds, yes. What is the bond liability to understand in layman terms? I'm just answering some queries on the chat box. So Shashank, you're borrowing money, right? But you're borrowing money by issuing bonds. So that's your liability, right? And that liability needs to be recorded till the time you don't pay it off. So that entire journey of the day you issue the bonds till the day you pay them back, that accounting is what we're trying to learn here. Okay, so in the interest of time, you know what? I'm going to do it myself. I just want you to observe how I do it. So I'm going to build this downward sloping arrow structure. These visual aids help you a lot in the exams, especially when a lot of questions you can answer just graphically by looking at things. So, so let's say this is 0, this is 1, this is 2, this is 3, this is 4, and this is 5. Have I drawn the other way around? Discount bond, no? It's a discount bond. My team is higher. I should have drawn the other way around. I should make it go upwards. Okay, here it goes. So let's go 0, let's go 1, 2, 3, 4, 5. Now, let's do it on the TVM row, second clear TVM. You guys help me out. Where is my mobile phone here? Okay, I don't have my mobile phone with me. Where did it go? You guys help me out, please. Second clear TVM, 1000 future value, 100 payment, 5N, 15 IY, compute present value. How much is that? Someone please help me out here. Is it 832? So 832 and something, 39. Now just make 4 as N. Okay, so let's ignore decimals. 857. Now make 3 as N, compute present value, 885, 886. 4 as N. 4 as N, you get 9. Sorry, 2 as N. So you get, my mistake, 2 as N, you get 919. 1 as N, 1 as N, the final one. I'm looking at some of the answers on the chat box, 957. And then you get, of course, when you keep 0 as N on maturity, it goes 1000. Okay. Can you guys please confirm if the numbers are correct? Right. We've got them from the TVM row. Now, how do you get your expense, right? How do you get your expense? So first observe how liability is going up every year. Now, how do you get your expense? Very simple. Just do what is the coupon I'm paying every year. Every year I'm going to pay a coupon of 100, right? 100, 100, 100, 100, and 100. So I'm going to pay a coupon of 100 every year. Now when I'm paying coupon, my liability is also increasing, correct? So my liability is also increasing. So someone please post all the amortization of discount here. Okay, someone please post amortization of discount here, the delta between the numbers, So this should be 25. Correct me if I go wrong anywhere, but it looks like 25 to me. 60, 26 and 29, this looks like 29 to me. So this is 129, 886. 14, 19, 33, this looks like 33. So 133, 919, 957. 38, this looks like 38. 138. And this looks like 43, 143. Please confirm if the numbers look all right. Okay. Now, this is one way of doing it. Or is there a shortcut for me to do it? Yes. Is there a shortcut for me to do it? Of course, yes. How am I going to do it? Opening liability, 838 multiplied with what is my YTM at issuance, 15%. Same story here, 857 into 15%. Same story here, 886 into 15%. Same story here, 919 into 15%. And finally, 957 into 15%. So if you do it this way, whether you do it this way, you do it this way, the answer is going to come out to be exactly same. Every year your interest expense is increasing. Look at this number. 125 became 129, became 133. Every year this is increasing, right? And every year your liability is increasing. These are the 4 points you want to remember. If you remember these 4 points, bond liability part done for you. There's nothing to worry about here. Are you guys comfortable with this? Come on, last few yo-yos of the day. Last few yo-yos of the day, we're done. We're done. We've kind of done it. We're almost there. We can see the finishing line. I'm going to go for a nice ride after this. Some wind, fresh wind on the face. Good. Very nice. So more or less, yeah, Rajiv will try. Rajiv says, try and be alive. I was like, I'll try, Rajiv. So this part is out of way. Let's go to leases thing. Okay, leases is a little technical. I want you to look at the leases part carefully. Let me just fire up our juice notes. They'll help us do that. Liabilities, okay. Now leases. Where is the leases part? Okay, this is leases. Um, this is leases. Let's see what happens now. Now in leases, things have changed a little bit in terms of how accounting is to be done. So we have this table, okay, that we need to go through carefully. Some of you might have seen those complicated accounting videos for leases. Have you guys seen those, especially on the FinTree LMS? Has anyone seen those complicated accounting where I make 6, 7 balance sheets and we make 6, 7 balance sheets and we try and do that? So you don't have to do that anymore. Okay, no complex calculations, just concepts, theory, but important theory. So this is your learning outcome G and H, and it's good that those complex. Of course, in order to appreciate those this theory, if you know background of those calculations, you're comfortable. Okay, which means those calculations are still important. Those calculations are still very important. If you know them, you feel very comfortable. But if you do not know them, that's okay. Now we're closer to the exam. There's no point doing them now. But I want you to do this table properly. This table is, we're looking at potential 1, maybe 2 questions on the exam if things go well for us. Okay. So let's start doing it step by step. Let me take a screenshot of this and put that in your notes so that those of you who do not have juice notes, at least you would have something to work with. Okay. Now, let's look at the books of leasing. Who's leasing? Who's leasing? The one who has taken the asset on rent, Lessor is the one who has given the asset on rent. Okay. So leasing. Let's look at what we have here. All IFRS and US, all IFRS leases, all IFRS leases and US finance leases. So in the first stroke itself, see what we did here. That under US, we stick to the finance lease. So remember, we have an operating lease, and then we have a finance lease. Now, operating lease is where you're kind of temporarily leasing the asset, right? You don't want to create an asset or liability. But things change in IFRS, and IFRS actually made things very complicated. So all IFRS leases and the US GAAP finance lease. So we are going to look at these two. What do? You do the same stuff that we did. You create an asset. You create a liability. Okay. So you recognize a right of use asset, and then you create a new liability. So how do you do that? You simply take present value of the future cash flow, create an asset, create a liability. What do you do with the asset? You charge them depreciation. What happens to the liability? It reduces, but you end up generating an interest expense. Remember how we created asset, liability, depreciate asset every year. Liability will reduce because there would be some interest payment. Now, statement of cash flow. So think of it, reduction of lease, financing. You're paying back a loan. So reduction of lease is a financing thing. Interest portion of the lease could either be an operating or financing under IFRS. We did this just a few hours back today, right? When you pay interest in the US GAAP, versus in the IFRS. Remember what we did a few hours ago? I in fact gave you plenty interest expense, interest paid here. I give you a few stars as well here. I told you if it's US GAAP, we go straightforward CFO. IFRS, we go CFO, we go CFF, right? So interest portion, uh, interest portion could either be operating or financing under IFRS, operating under US GAAP. Now this is your row number one. Please confirm if you've understood this. If not, I can explain again, but this section is important for us. We want to be good with this. Have you guys understood this? All IFRS leases, and the all IFRS lease and the US GAAP finance lease, the treatment is similar. Have you guys understood this? No. Okay. Okay, fine. Fine. Let's go a little bit in the background. Take it easy. Let's understand a basic concept of what's an operating lease and what's a finance lease. So simplified, okay, without getting too technical. Imagine we have an asset, okay, which has a life of 5 years. Okay, there's some asset which has a life of 5 years. Now you make a lease agreement. And you say that okay, this, I'm going to lease that asset for 2 years. So then that is kind of an operating. You're not buying the asset. You're not going to use it for all its life. You're using it for a short period of time. So generally, like a genuine lease agreement, right? That is operating. Whereas generally, what is a finance lease? A finance lease is where, let's say you say that I'm going to lease this asset for 4.5 years. It's as good as you're buying it, isn't it? What used to happen earlier in US GAAP and IFRS, we treated operating lease and finance lease separately. How did we treat operating lease? Both. This was true in both US GAAP and IFRS both earlier. Okay, not now. And now I'll tell you what happens. Operating lease, just think of it as a genuine lease transaction. Okay, very broadly, think of this as a genuine lease transaction, and think of finance lease as as a purchase transaction disguised as lease. Purchase transaction disguised. Disguised means it looks like a lease, but it is not a lease. It's actually a purchase disguised as lease. All right. Now, how would you do accounting for operating lease? Even school kids will do it. It's simple. No asset, no liabilities, right? No nonsense here because that's not your asset. You're renting it. You just pay rent, pay lease, right? And what is that? That is your expense. What kind of an expense? It's an outflow from CFO. Is operating lease okay to everyone? No asset, no liability. You pay rent. You pay rent. That's your expense. No asset, no liability. You pay rent, which is your expense, and it is an outflow from CFO. Yes, no, on this part, on the operating lease part, like a rent transaction, no complication. Is this okay? Yes, no, come on, quickly. Operating lease part. Great. So operating lease, we all understand, right? That's very intuitive. There's no complication there. What happened in finance lease? You're a company who's actually buying an asset, but you're showing it as if you're leasing it, because think of it. If asset life is 5 years, you're renting it for 4.5. Correct? So what accounting standard said, okay, fine, you're being smarter. Let me be smarter than you. So how you do recording is you call it as a lease, but we are going to call it as a finance lease. Okay. And then what you have to do is on your balance sheet, we will force you to create an asset. On your balance sheet, we will force you to create a liability, even though it's a lease. It's just a lease, but we're going to force you to create an asset, force you to create a liability. But then you would say, how can I determine the value of the asset? So your value of asset is going to be present value of all future lease payment. Present value of all future lease payment. Okay, so whatever lease you're going to pay, take the present value of that. That's it. That's your value of asset here. What would be your value of liability? Same. So you create an equal value of asset, equal value of liability. What is this called? This is called ROU, right of use asset. Okay. And what is this liability called? It's called a lease liability. Then what do you do? Then what you do is depreciate this asset every year as if it's your own asset, right? On legal terms, you signed a lease agreement, but you would be forced to charge a depreciate this asset every year. Okay. Then this liability you have to pay back, right? Now, how would you pay back? Because you're making a lease payment. So that lease payment that you make, that is not thought of as a lease payment now. That is thought of as a repayment of loan. Okay, so that is thought of as a repayment, just like our EMIs. Okay, the EMIs that we pay on a loan. Now, some part of that repayment is going to be interest, and some part of that repayment is going to be principal. Now, when you pay principal, when you pay back a loan, when you pay back a principal from a cash flow perspective, it is an outflow in CFF because I have taken a loan, that's a plus CFF. When I pay back a loan, that's a minus CFF. When you pay back interest, interest could either be CFO under US GAAP, under IFRS, it would be CFO or CFF. We did this in the morning. I hope you remember this. Okay, so this is how you do accounting for a finance lease. Have you understood this now? The finance lease framework? Come on, give me a yes or no. Come on, guys, last 20 minutes in the class. Yes, no. Good. Very nice. Great. Now, what happened is IFRS came up with new rules. Okay. Um, IFRS came up with new set of rules, and what IFRS said then, IFRS said that, see, no matter, IFRS said, let's cut down on this BS of operating lease and finance lease. Now, no matter what lease you have, all lease in IFRS as of now, with the new accounting standard, you have to do accounting like this. Okay. The all the lease now, in the new IFRS standard, you have to do accounting as if it's finance lease. Whereas US GAAP, we still have a separate operating lease, we still have a separate finance lease. Now, I don't have time to do calculation, otherwise that will take me 1 hour. But then you guys would have really loved it, but this is not the time, maybe some other day. Okay. Uh, so here, look at this. IFRS, all leases. IFRS, all leases. US GAAP, just the finance lease. Okay. How do you do accounting? Create an asset, create a liability. On asset, charge a depreciation, and uh, interest you have to pay on your lease liability. And cash flow statement, principal payment, CFF, interest payment, CFO or CFO/CFF. That's it. That's your row number one. Now I'm going to assume that you've understood this. US GAAP operating lease. US GAAP operating lease. Okay, so now we're looking at US GAAP operating lease. This has gone wrong. This is gone wrong. No recognition of asset or liability. Okay, this thing is wrong here on the juice notes. There has to be no recognition of asset or liability. We don't create asset, we don't create liability. We create a single lease expense, and the entire item we show as an operating cash outflow. Okay, so this is your US GAAP operating leases. Now let me just pull out the whole section from our juice notes. Just give me a minute. Okay. So US GAAP, we treat as if we have just simply rented the asset. Now going further with this, what are the exceptions? Theory question, guys. 1 point on the exam, focus for next 5 minutes. If you have a short-term lease, right, for a very short, generally less than 12 months, then under IFRS, or if you have a very low value asset, then don't create an asset, don't create a liability, just show a rent expense and get done with it. Okay. This is true only for short-term leases. So remember these exceptions. Now, this is your accounting in the books of Leasy. I hope you've got this part of accounting right. Let's jump on to books of Laser, the one who's rented the asset. Now, if it's an operating lease, okay, under both IFRS and US GAAP, operating lease asset remains with you. You have to charge depreciation. You get a lease income. Lease income could be your operating cash flow. So this is straightforward stuff, right? Operating lease is like, it's my own asset. I'm getting a rent income. I have to charge depreciation. End of the story. Now let's look at balance sheet income statement for finance leases. Finance leases. And within US GAAP, we have something called as a sale time lease now. Again, so under US GAAP, okay, within finance lease, we have two types of leases. We have something called as a direct financing lease. We have something called as a direct financing lease, and then we have something called as a sale type lease. Now, what is the main difference between the two? In a sale type lease, okay, how do you identify I have a sale type lease? You will have a gross profit there. Okay, how do you know I have a gross profit? Very simple. Imagine I have an asset, okay, which is worth 500. I give it on lease. The present value of lease payment that I am going to receive is 550. So it's as good as your sale value, right? Present value lease payment is nothing but your sale value. So this is your, cost. So something which is worth 500, you're selling it for 550. That means that's going to be your gross profit. So your gross profit is 50 here. Got it? So your gross profit is 50. That tells you you're dealing with a sale type lease. A direct financing lease, you will have no gross profit here. That is how you distinguish between a sale type lease and a direct. I know you guys are tired. Probably, 70-80% of what I'm telling you right now is, completely evaporated even before YouTube, plays it for you. Just remember this, please. How would you identify a sell type lease? Look for gross profit. Okay, look for gross profit, please. Now, I'm going to still finish this. Uh, I know you're not probably absorbing everything, but I still need to maybe, tomorrow morning you can review this part of the video again one more time, but let me just get done with it. So we're almost there. We're almost there. Okay. Like last 10 minutes, I would say, or less than 10 minutes. We're just there. Now, if you have sold the asset, remove it from your balance sheet. Okay. And you have a receivable coming in your way. Asset went, a receivable came in. Income statement, this receivable will get you interest revenue, correct? And importantly, you will have a profit here, the selling profit. Why? Because it is a sale type lease. So you're going to have a selling profit here. Cash flows you can do later on. Cash flows are not that important. And here, financing lease, same treatment. Nothing changes except that there is no profit. Except that there is no profit. Everything else from a treatment perspective is same, but there is no profit. That's it. That's how you do accounting. That's how you do accounting for these different type of leases. Okay. Now, I'm leaving this in your notes. Notes will be available in description. Hopefully, uh, once the video is, I think YouTube is going to take about 30-40 minutes to process this. But once the video is live, we'll try to put notes in the description. Okay. So this is out of our way, and then we're done. Now for the last part, pension, this is couple small things that I want to show you. We're done, almost there. Okay, last 5 minutes. Pension plans. Pensions. Now, two types of pension plans. We've something called as a defined contribution. A defined contribution. We do a defined benefit. Okay. Now, defined benefit. Now see, these contribution plan, right? You don't create an asset here. You don't create a liability here. In a contribution plan, no asset, no liability. The only thing that you do is expense. End of the story. Whatever money you paid, expense. You don't make any promises to the employee. You just give him a contribution. In a defined benefit, it doesn't work that way. In defined benefit, you do create a plan asset. Okay. You do create a plan liability. Now, this liability is given a name. It's called present benefit obligation. Okay, present benefit obligation. Now, I don't want to grill you too much on this, but I just want to give you a sweet, easy brownie point, a low-hanging fruit. If you listen to next 30 seconds, probably you get that 1 point for yourself. I hope you're listening. Under US GAAP and under IFRS, the amount that you show in defined benefit is the net amount on your balance sheet. Now, what do you mean by net amount on your balance sheet is that if you have, let's say, a plan asset of 100 and you have a PBO of 120, what you show on balance sheet is just the liability of 20. You don't show both. You just show the net amount. In the same way, if you have an asset of 100 and you have a liability of 70, then you just show a asset of 30. You show the net amount. So So what I'm trying to say is that under both US GAAP and IFRS now, you're not supposed to have one asset and one liability. You're just supposed to have the net amount of the two. Okay, so that is your accounting for pension. Now, I would recommend you not to spend too much of time on the income statement part of the pension. Okay, that's extremely complicated. We have that for level 2. We'll probably worry about that then. At level 1, I don't think it's really worth spending too much of time on this. Okay, just look at the balance sheet treatment and then more or less you're covered there. Last point. Since I have 5 minutes, it's a different reading, but I just need to do this. Then we've covered the whole syllabus, and then we're going to sleep very happy today. DuPont analysis. Okay, DuPont analysis. Just last 5 minutes, we're done. I just want to show you the formula. You guys probably know it, but I just want to do it once. It's a formula that allows you to decompose the ROE. ROE is calculated as net profit divided by equity. Okay, so how do you decompose? So your first decomposition is a 3-part decomposition. So you say ROE can be calculated if I multiply 3 numbers. Which 3 numbers? Net profit divided by sales. Come on, help me out here. Net profit divided by sales. What next? We have sales divided by assets. And then we have assets divided by equity. So what is this net profit by sales? This is net profit margin. This is called net profit margin. And sales divided by asset is your asset turnover ratio. Okay. And finally, assets divided by equity. This is called your financial leverage. So when you multiply these 3 numbers, you get your ROE. Now remember the first 2 numbers here. Okay. The first 2 numbers here in this formula, when you multiply just these 2, that's actually your ROA, return on asset. So they might play around a little bit, and on the exam, they'll probably give you ROA and give you financial leverage. Easy. Just take ROA, multiply with financial leverage, you would get your ROE. That's your 3-part DuPont decomposition. Now what we do is we take this net profit by sales. And we further break it down into 3 parts. Okay. So we can take this and we can break it down into 3 parts. Now what are the parts? So first part is EBIT divided by sales. Second part is EBT divided by EBIT. And the third part is EAT divided by EBT. Now, what is this called? This is called operating profit margin. Operating profit margin. What is this called? This is called interest burden ratio. Even though they call it burden, you actually want it to be higher. Okay. Now, I hope you're listening to it. You want this number to be higher. You want it to be higher, even though they call it burden. It confuses some people because see, it's a multiplier. You want to increase your ROE. And finally, this is referred to as your tax burden. Okay. So we have the 5-factor DuPont ready with us. You have to multiply operating profit margin with the interest burden with the, okay. Oh, something wrong with my computer. Just a minute. Operating profit with interest burden with tax burden, and that's it. Job done. So three factor DuPont. It's like this. It is ROE is equal to net profit margin into asset turnover ratio into financial leverage. What would be a 5-factor formula? Operating profit margin into interest burden into tax burden. This 3 terms is net profit margin into asset turnover ratio into financial leverage. There you go. Done. Yeah. So finally done. if you're okay with basics, if you guys are comfortable with basic accounting, I think FRA is done for you today. This much is good enough. You do this and you practice questions, you're going to be happy. So congratulations to all of you. It's not easy. When I started the day, there were 600 people. Right now, we're left with 318 people. And this is exactly the passing rate of CFA level 1, right? This kind of divides the people between the ones who can take it and the ones who cannot. It was fun. No, thank you to all of you as well. I know that, I know it's not easy for you to sit through the whole thing. So you guys really stuck through. So that's impressive. And this will materialize, right? I mean, all the work that you guys are putting in, you will see the word congratulations. That will come your way. Thank you. Thank you to all of you as well. So again, a quick reminder, tomorrow morning we start. Okay, tomorrow what subjects we have? Tomorrow we do equity and derivatives. Now, if you have some energy left, maybe today, tomorrow, or people who are watching this video in the future, go and practice some questions. I know today probably, we would not be able to do it, but tomorrow morning when you get time, go and practice questions. Practice few questions from CFA curriculum. You'd automatically start, feeling much more confident. And tomorrow when we start the session, try and keep post-its with you. Okay, that's it. Nothing much. We would be attacking equity and derivatives tomorrow. We'll be starting at 10 a.m. India time, and we will wrap up. Tomorrow we should be able to wrap up in time. Okay, today was intense, but tomorrow we do finish in time. So don't worry about that. All right, so that's it from my side. Thank you very much. All your queries, doubts, if you have anything left in the subject, you can put them in the comment section once the video is live. Thank you. Bye-bye and good night.